What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims?
Welcome, you're watching India Market Open, and I don't know if you're feeling this morning like Mr. Too Late to the party, but the party is probably going to continue here. 10 points to everyone who got that, referring to the now famous post on Truth Social calling the Fed chief Mr. Too Late, and I don't want to say it, but loser.
Yeah, big loser, he said, big loser, and because he's not cut rates. I mean, so you talked about a party, you got to get gifts to the party, right? So if you don't get gifts, then you get called a loser, unfortunately.
Yeah, Indian investors are not complaining with all of that that's happening, because we are kind of shining like, a beacon in an otherwise dark, dismal atmosphere around.
We are in our own party, and everyone's invited.
Sure. Yeah, so two things. One, there's this really funny image, right, that came across on WhatsApp. It just shows, a horse, the nifty horse, running after it's consumed so many bears. But
don't miss the rainbow in the background.
This was hilarious. But this actually, you could argue that it's something like this, right? It's eaten all the bears and kind of moving around. But the other was something that a global fund manager pointed out, and what Donald Trump is doing and what it's leading to, right? That the last time the S&P 500 was down circa 8-9%, the dollar was lower, but the 10-year treasury yield rose. Right? This is dichotomous because usually there is a clear sync correlation. The last time that this happened was in August 1990. Since then, they moved in tandem. The first time in 35 years that we're seeing. This is the extent of the damage that is caused to the US markets.
And so much so that you're talking, and those correlations extend to the gap between the dollar and the Swiss franc, which is widened even further. We've been speaking about it in recent weeks. So people are not using dollar, people are not using treasury as safe haven. Everyone's piling into gold, and that's why gold is above 3,400.
Gold is on another level altogether. All right, so let's give you the setup very quickly. What's happened overnight? US markets have slumped in trade after US President Donald Trump has targeted Fed Chief Powell. Remember, this has been going on for a while. At this time round, there's a post on Truth Social that has riled up the markets. Dow, in fact, dropped 900 points as investors are fearing upheaval at not the White House really, but at the Federal Reserve. Dow down 2.5%, NASDAQ down about 2.5%, S&P 500 as well. So all-round pain points there. Now, what has Trump said? He has said, and I quote, preemptive cuts in interest rates are being called for by many, with energy costs way down, food prices, including Biden's egg disaster, I'm quoting everything here, substantially lower, and most other things trending down. There is virtually no inflation. With these costs trending so nicely downwards, just what I predicted they would do, there can be almost no inflation, but there can be a slowing of the economy unless Mr. Too Late, a major loser, lowers interest rates now. Europe has already lowered 7 times. Powell has always been too late, except when it comes to the election period, when he lowered in order to help sleepy Joe Biden, and then it goes on and on. But essentially the fear that the Federal Reserve will lose its independence, because remember last week noises from among the Trump administration saying that he's looking at the rule book to see if he can replace Joe Biden, he has replaced Joe Biden, Jerome Powell. Jerome Powell coming and saying that no, he's going to finish his term till August 2026 because that's what the law says. So bond yields anyway have spiked as Trump has called Powell a major loser. The 10-year was at 4.4. Gold has surged to record highs of 3,400 as fears about the Fed's independence grow, and Asian markets have opened weak following US cues as well. I wonder if you can pull up some of those for you. Yeah, there you go. Mixed bag there, but Gift Nifty and implied open looking at an positive point there. in the green. So a lot of things have been happening domestically, and we'll talk about some of those factors. One of them, of course, was the US Vice President J.D. Vance, who is in India. He's here for 4 days. And one of the big focus of his trip are conversations about a trade deal. He met Prime Minister Narendra Modi yesterday, spoke on some of these critical themes. In fact, Rishabh joining us, he's been tracking the story very, very closely. Rishabh, any headway on a possible trade deal between India and the United States?
Right, Tamanna, what we're seeing from this visit by the US Vice President J.D. Vance is the fact that the two countries remain committed for somewhat of an early harvest deal or a tranche one of this multi-sectoral bilateral trade agreement within this year. That is what the statement from the United States trade representative also sort of confirms, is the fact that both of them are moving towards something, some sort of initial outcomes by the end of this year. Remember, the BTA or the bilateral trade agreement, the first tranche is expected by the fall of this year, by September or October. That timeline has also been accelerated given the fact that tariff pauses have come in. So a lot of Indian officials very bullish on achieving something within this 90-day period as well. So within 3 months is also when we can expect some sort of a deal coming in, maybe not focusing on non-core issues like technology or IP or immigration, but focusing purely on reducing tariffs, tariff rationalization, as well as reducing the sort of non-tariff barriers that come in, while also granting market access to US products.
Thank you for that, Rishabh. In fact, we're going to take that conversation forward with Michael Kugelman, foreign policy author and expert specializing in South Asia. Michael, great to speak to you after a while, and great to have you on our show here this morning on NDTV Profit. What do you make of the J.D. Vance, conversation with Prime Minister Modi?
Well, I mean, it's very clear from the Indian government's readout that the trade issue did come up, no surprise there. And also no surprise that there was an indication that each side thinks that things are on track. Trade was not the only issue that was discussed between the Vice President and Prime Minister Modi. I think it's very clear that another key objective of Vance's trip was to prepare the grounds for his boss's expected visit to India later this year, when President Trump is expected to be there for the Quad summit. But, we know that the U.S. and India have been talking for quite some time about starting talks on a trade deal. When Modi was in Washington to meet Trump back in February, that's, of course, when they decided to pursue talks. And it seems like only in the last few days, in the days leading up to Vance's visit, did they set the terms of reference for the talks, and have they really positioned themselves to actually begin in earnest. But as was noted before, with this pause on the tariffs, I think that there's some breathing room here. But I think that there's still a lot at stake. And I think that both sides, particularly India, will want to move as quickly as possible to at least get to some type of initial agreement on an accord. And of course, the original plan back in February was for there to be some type of phase one deal by sometime this fall.
Any sense of what that will entail? Michael, hi, morning. I'm just wondering because seemingly the question mark, I think, in the US is whether or not these deals will be tied up by the time the deadline is over. And what you're saying seems to be that maybe the framework will come through, but we're far away from the complete picture. So what form will that initial agreement, if at all, take?
Well, we're swimming in a lot of uncertainty here, right? I don't think anyone really knows what the time frame is going to be and what the trajectory is going to be. I do think these will be very difficult negotiations. You're going to have very tough negotiators on both sides. U.S. officials have said in recent weeks that every issue is on the table, and that suggests that the U.S. will want to discuss with India loosening protections in some sectors that are very politically sensitive, and that includes, for example, agriculture. So it's going to be very difficult. But I would say this: I think India has an advantage that many, if not most, other countries do not have, and that is that the process did begin earlier. I think one could argue that so many countries are still looking to try to get the Trump administration's attention to try to get it to commit to begin some type of negotiation. Whereas, as I said before, the U.S. and India have been talking since February about starting something. So the process is further ahead with the U.S. and India than it is with the U.S. and many other of these countries. But as I said before, it's going to be a very difficult negotiation, and we've seen, even though India has preemptively eliminated some tariffs and pledged to import more American goods, even though India has been importing more American goods at an increasing rate for a number of years, it wasn't enough to prevent it from getting slapped with that initial 26% reciprocal tariff, which means that India will likely need to make a lot of concessions in talks in the coming weeks.
Michael, good evening, of course. Do you reckon that if there is a bilateral trade agreement reached, which is good for both sides, let's assume, because that's why agreements are reached in the first place, does it give an edge ahead into key sectors that India would have represented and China and US would have wanted? I'm guessing that LPG imports would form a part of such a deal, and India would be happy to do that, as would be the US. But some of the key sectors wherein inquiries from US companies have heightened in the last few weeks, textiles, for example, select chemicals, etc. Do you think India stands to get an immediate benefit if such a deal is reached soon?
Yeah, I mean, it's just very hard to say. And I would argue that the pause that we're experiencing, the tariff pause that we're experiencing for the next few months, could have some immediate term benefits for some Indian exporters, such as jewelry exporters and auto parts supplier exporters. They're looking to be able to get their products into American markets before prices go up. Though if the U.S. experiences a recession, which I think there's a fair chance that'll happen, that could impact those types of exporters deleteriously. But as I said before, it's just really hard to know how this is all going to how it's all going to play out. But I will say this: I think that there is a genuine desire in Washington with the Trump administration to get a deal. You've got a lot of folks at very high levels in Washington, including the president himself, who really want the relationship with India to work, who recognize and appreciate that India has been investing very heavily in the U.S. economy over the last few years, and this has led to tens of thousands, actually several 100,000 American jobs, thanks to Indian investment. So I think this is something that'll help India along, and as this difficult negotiation moves forward, may make it more likely that the U.S. would be willing to make some concessions to India that it might not be willing to make as quickly or easily with other countries that it's talking with.
Fair point. Michael, thanks so much for joining us this morning and for providing the context and the perspective that you did.
Thanks for having me.
All right, let's talk about what happened in trade yesterday and the reason why the image of the horse is doing the rounds, because you had gains once again across the board. First, let's talk about some interesting data that we pulled up on foreign institution investor behavior. They bought once again yesterday to the extent of close to 2,000 crore rupees, and domestic institutions also bought about 250 crore. They have now, foreign institutions, remained net buyers for the fourth straight session. And in fact, over the course of those 4 sessions, have net bought equity to the extent of 16,640 odd crore rupees. Now, it's interesting because before that, for 9 straight sessions, they had been net sellers and they'd sold about 39,000 crore rupees in just those 9 sessions. Monday's run was bolstered by banks as well as, surprise, surprise, at least it was at the start yesterday, IT. But take a look at the sectoral contribution. And usually we talk about companies, but take a look at this, right? So 273 odd points of gains for the Nifty 50, 116 points accounted for by the financial services. IT up next with about 50 points. So it's a considerable portion, practically half of those gains accounted for by those 2 sectors. Oil and gas, auto as well, gaining to a certain extent. And on the other end of the spectrum, very small declines for FMCG. In fact, I only pulled up FMCG because it was the least or rather the worst performer and only contributed about 15 points on the downside. Now, the Nifty 50, by the way, has moved well past the 200-day moving average of 24,050 or thereabouts. It did so at the start yesterday. And in fact, it has gained 9% since the April 7 low of 22,161. And in that time, the Nifty Bank has gained close to 11%. This is barely a few sessions. Yesterday, of course, you know, and we spoke about this, it hit a all-time high of 55,461 during trade, and it has given up a little bit from that point. Just a few more points. Energy, PSU banks, oil and gas, IT, realty, auto, metal, all of those indices gained over 2%. The Nifty Bank was close to that with gains of about 1.9%, and pharma gained about 1%. FMCG was the sole underperformer, losing about 1%. The market breadth was very strong, with 4 stocks gaining for every decline, and IT cooled off, remember, towards the end of the session or in the second half by about 1% or so from the day's high. Monday saw companies with weak earnings as well gain, and this is something we marked for you. Tata Elxsi, for example, was not the best earning. It gained about 9% in trade yesterday, and Infi as well, up about 2%. Neeraj.
Yeah, so, I mean, I think one of you will talk more about this, but if you just purely look at the trade setup, and we know banks and IT did well, so trying to focus on both of those. So I think the RBI measures continue to aid BFSI sentiment, and we'll talk about more of that in detail, but keep in mind that there is a bit of a tailwind to BFSI in the session today as well. But I just feel that the bounce in IT, it's very difficult to call it sustainable, simply because usually if the fundamentals are in place and sentiment changes on the upside, then you feel that it could be a sustainable bounce. Currently, the fundamentals certainly not in place. There is a bounce because maybe the space was oversold, and therefore it becomes very difficult to call this bounce as sustainable. In fact, I would suspect that because Infi commentary maybe led this bounce, today what HCL Tech says becomes extremely important, because then you would know that if HCL Tech doesn't quite echo what Infi has said and echoes what TCS or Wipro said, then maybe Infi is the outlier, or else the screen is divided. So I think very, very crucial to see that. The select chemical and pharma export data is looking very promising for Q4. So do watch out for this one. And, you know, guys, just a moment on whether this time is different for IT, because a lot of parallels being drawn to 2008, 2020, and how during both of those crises periods, the stocks went down only to have a furious bounce back. And Nirav Sheth of MK wrote this lovely sales note, and that got me thinking about maybe the 3 or 4 factors which might be different this time versus the last time. So clearly, both 2008 and 2020, there was a put, right? There's a fiscal and monetary put for the US economy, because the central bank acted, the government acted through stimulus at the largest, and this time around it's anything but that, right? It's different. Central bank is not quite acting, and the government is also saying that we're not going to put in money behind the economy per se right now. If anything, it's the other way around. So therefore, that is different. European auto is struggling, even if other sectors are picking up, and European auto never struggled in 2020 or in 2008, and that's a big contributor to ER&D, if anything. So that is part 2. The weakening DXY, and that adds or weighs in on the constant currency growth numbers for sure, as well as the margins for IT companies. So that's different again from 2008 and 2020. And lastly, for the first time, we heard an IT company, Cognizant, calling out that GCCs are taking business away. And if all of those global companies are setting up shop in India, great for Indian employment, but it's a business being taken away from IT service companies, right? And if GCCs, which have shown a 59% growth in calendar year 24, are taking that business away, then that's also a problem. So there are a few factors which are different than the previous crisis levels when the Nifty IT corrected 30%. So therefore, difficult to call whether this is a sustainable bounce. We've had one good bounce. One hopes it continues, but difficult to call it.
Dollar index, by the way, at 98.3.
98.3, yeah, 19.4 overnight, yeah.
Yeah, that's what one statement, one post can do. And that also shows the kind of credibility that Jerome Powell has. He's not even responded to this, but one attack on him, and bond markets and your currency markets are all in flux, saying that no, don't touch this guy. But just one quick word on IT, because I had a very detailed conversation yesterday on exactly this question, that are the heydays for Indian IT over? And it was a harsh kind of a push out there, but one point was that they need to do something. You can't just sit and have business as usual to survive in the time that's coming. GCC is one factor, AI is one factor. I mean, how many coders are you going to need? You know, and are you really up to the mark? So, I mean, one guest, CP Gurnani, was on the show, so he described it as, this is a sneeze, not typhoid, we will recover.
Okay.
Let's hope that.
Let's hope it is that.
It is that. Very quickly, other factors to watch today, and quite a few listed out by Neeraj, but one I would say is, do watch out for what comes out of the Modi-Vance meet. If there is some kind of a substantial, you know, take out there of a bilateral agreement, or what a bilateral agreement can look like between India and the United States, it will be a huge boost for the markets, even further than what we are seeing, because we're already ahead of the curve of inking a deal. That's what Washington wants. We seem to be 3 steps ahead of doing that. So if there is anything that shows that at the end of that 90-day pause, which we're in right now, India is coming out of this relatively unscathed, another boost to markets. RBI, of course, another day that it's the knight in shining armor, comes in with a liquidity push, giving further momentum to banks which are already on a roll. More and more brokerages are also turning bullish on India, and I know Neeraj is doing a detailed piece on it, but just one point that stood out from the Morgan Stanley note, where they say their early signs view on India is shifting. So that becomes important. Now, technically, you have seen Nifty gains for 5th consecutive session. Nifty has been up 2,400 points since the recent swing low of 21,743. So clearly, there's an immediate support at 24,000. 23,900 is the next level you need to watch out for. Key short-term resistance is about 24,550. In terms of Bank Nifty, that's in another stratosphere, has crossed 55,000 mark for the first time. Resistance, I would say 55,448 short-term, and support levels at 54,846. So a lot of action which we've set up for you, Puneet, before you tell us what's happening in the F&O space.
Well, definitely, you know, the key levels you mentioned about the Nifty, 24,200 will be one which I'm also watching out for. If we can close above that today, we'll continue the bullish momentum on the index. And as you rightly said, the Nifty Bank also crossing 55,000 mark. We actually spoke to Gautam Shah last Thursday. He's actually looking at 55,000 as the first level. He expects it to go to 60,000 as well in the medium term. So another key aspect to watch out for overall. When you look at the open interest gainers and losers in terms of stocks, that's one very interesting one. Pulled out a lot of interesting stocks yesterday, because we saw a huge move in IT stocks yesterday, despite, you know, poor show in Q4 earnings for Tata Elxsi as well as Infosys. If you can look at the open interest gainers first, let's go back to the previous slide. So open interest losers, we've seen an open interest change across, you know, the IT pack, specifically the Tata Elxsi. We've also seen some pressure on AU Small Finance Bank as well as Bajaj Auto. But I want to pull up the delivery data as well, and, you know, had a lot of help from my colleague Chinmay on this specifically. Delivery data on something like an HDFC Bank, 67% yesterday of, you know, whatever, and we've seen roughly about 1,900 crores of buying from the FIs. That could be one indicator, while the rest are indicating, you know, not too much in terms of delivery. And I just want to specify Tata Elxsi as well. While we saw a very sharp move yesterday of 9% despite very poor results, the key aspect is you would look at delivery data and indicate that, you know, it's not too much to look out for. But interestingly, we saw the open interest for the April expiry, which is on the 24th, fall by 99%. Now, this could mean 2 key things. One, we had a really high short covering yesterday. Traders shorted stock, covered the short covering essentially, bought it and then sold it off immediately to not reflect in the delivery data. We've also seen the May as well as the June expiry specifically have a slight bump up as well. So while the IT stocks yesterday could have some short covering, essentially that's one of the things which we are watching out for, you know, today for HCL Tech as well. But overall, you know, very interesting aspects that the delivery data is pointing out, that it's not so much that deliveries have been taking for the IT stocks. Essentially, it could mean that it has been either rolled over to the next month, or that they were short covered, bought as well as sold immediately in trade yesterday.
Justile delivery is also very, very stark, right? One of the outperformers in trade yesterday on account of earnings, but only 4% delivery is quite stark. Based on the numbers that you pointed out. It was up 11.5% yesterday. Tamanna?
Absolutely. But a lot of news to cover this morning as well in terms of stocks. So steel stocks first, of course. It's a demand that was made for a while by steel companies, and India has now followed suit, imposing a safeguard duty of 12%. It's a temporary tariff for about 200 days on 5 categories of steel imports. The reason that the Indian government is doing this is to protect the domestic sector from cheaper imports, and that's the threat, right? As a global tariff war rages on and the US is blocking imports from China, there is a fear that they will dump some of these products into India. Which is why this becomes important. This imposition of safeguard duty removes a key overhang on Indian steel stocks, and most analysts are expecting a positive reaction today on it. So watch out for a JSPL, watch out for a Tata Steel. In fact, there are statements coming in from both those companies welcoming the moves from the Indian government. So that's important. The other one is the RBI. Like I said, watch out for financials once again. RBI has said that banks are required to set aside less funds against retail deposits than anticipated. That's called the liquidity coverage ratio. So they have reduced that. RBI has in fact given adequate time till April 2026 for compliance. Banks must assign an additional runoff rates of 2.5% for internet and mobile banking enabled retail deposits. Draft guidelines had proposed a 5% additional runoff factor. They had also proposed differentiating between stable and less stable deposits. But final guidelines are suggesting a flat structure. So the RBI is expecting the new framework to improve the bank's liquidity coverage ratio by around 6 percentage points. And the new LCR norms will align with the global standards in a non-disruptive factor. These come into effect from the 1st of April of 2026. So this is something that's being viewed as positive. Morgan Stanley has come out and said that this is a material positive. Unlike the draft, this should help improve system LCR, that's liquidity coverage ratio, by 6 percentage points. Banks that have higher shares of trust deposits will likely be key beneficiaries. So watch out for the large ones. 6 percentage points would help the banking system accelerate loan growth by 1 to 2% and improve margins by 2 to 4 basis points on implementation in the next year. Although the guidelines are effective 1st April, we expect some benefit in FY26 earnings as well. Macquarie says it's a liquidity bonanza that's continuing, improving liquidity to support 140 to 160 basis points increase in credit growth. Back of the envelope calculation that they have done indicate a 2.5 to 3 crore rupee increase in liquidity deployable. The move is welcome in the current environment where loan growth is relatively weak. So that's a big boost as well. Pitti Engineering is the third one that I've chosen, a thumbs up there. Sales volumes have increased 50% this quarter. This is basically their results have come in, which are pretty decent year-on-year basis. There has been a net profit impact because of lower other income, and interest costs have gone up 36%, but revenue is up nearly 40% at 469 crores. EBITDA is up 54%. Margins have gone up as well from 15.5 to 17%. Net profit, like we said, other income has impacted it. That's why it's down from 36 crores to 21.5 crores. But all in all, a good set of numbers from Pitti Engineering. So expect some movement there.
Yeah, it's short in the arm, particularly for the banks. I think they're going to be in focus. They have been, as we've all pointed out. Let's talk about my first stock. Himadri Specialty is a thumbs up. And take a look at the numbers first, right? Because you have a revenue decline of about 3.6%. And this is on account of continued decline in sales volume. It's once again declined by about 3%. And this has been the case for the last 4 quarters at the very least. But what is improved is the operational metrics, where you're seeing an uptick of about 30% on a year-on-year basis in EBITDA to 233 crore rupees, and the margin has come in quite substantially better at 20.6% versus 15.3%, as a result of which there is an increase of about 35% in the net profit to about 156 crore rupees. There's only one line in the investor presentation that I read, which has to do with a probable improvement in the mix of products that the company is selling. It says that it is focusing on high value specialty products. But one more thing that you need to bear in mind for this company is the fact that CapEx is underway to expand both carbon black capacity, and it's going to double that capacity effective the 3rd quarter of the current financial year. And there's also another project that is underway to increase the production of high value specialty products, and that will come through in FY27. So if those two, I'd be curious to find out what the contribution of carbon black is to total volumes. 70,000 units of carbon black will be added as of the 3rd quarter of FY26 in terms of capacity. So certainly something to bear in mind. Now, of course, I would love to speak to the company to find out how this is going to contribute to the mix going forward, because clearly the operational metrics have improved on account of a better mix. The second counter is HG Infra Engineering. This is also a thumbs up because it has emerged as a qualified bidder to set up a battery energy storage system, and this is on the back of a tender that was issued by Gujarat Urja Vikas Nigam. It was a total of 1,000 megawatts or 1 gigawatt hour, and the win for this particular company, HG Infra, is a part of that, which is 600 megawatt hours. This is going to be completed in a period of 24 months. More details are awaited, but the fact that they won this project is certainly an important step, considering that we're looking at more renewable capacity that is being created, and of course battery storage becomes very important from that perspective. The third is on the back of an initiation of coverage by Kotak on Dr. Agarwal's healthcare. Remember, it's a newly listed company and it has lost ground. In fact, actually it's flat since its listing, but over the last month it's down 9.5% or thereabouts. And the upside potential based on the target price is not very much. It's only about 5% or thereabouts. 425 is the target. The stock is at about 400. But what are they saying? They're saying that the company is setting its sights on profitable growth. They're expecting that the return on invested capital is set to improve to around 12% in the financial year ending March 2028. And they're also expecting a 23% improvement in EBITDA, 27% improvement in EPS over the course of FY24, which is the year gone by, to FY28, which is a decent run rate. And it also says, Kotak in the note, that Dr. Agarwal has an early mover advantage over organized peers in the space, and the acquisitions that have been made are a key driver for growth going forward. As I said, the stock was listed in February. It is unchanged from that price.
Okay, very quickly, 3 stocks from my end. Watch out for SRF and Gujarat Fluorochem from amongst the chemical names, because the month-on-month and YOY export data for the month of March, as per notes, shows a very strong uptick. So there are a clutch of them. For example, Brujet has a very strong YOY growth, 104%, but not quite month-on-month. Both of these have both MOM and YOY looking number looking very impressive. So keep an eye out for these two if there is a reaction. I will watch out for Anantraj from amongst the numbers. Revenues were up 22%, margins at 26 versus 23. I mean 26.3 versus 23.6 essentially, and net profit up 51% at 119 crores versus 78 crores. So may keep an eye out for that, and won't dwell too much on these brokerage notes, but just the stocks within them. So consumer stocks are a favorite right now for brokerages. Goldman's note highlights companies like Godrej Consumer, Tata Consumer, Marico, Titan, Trent and Pidilite. These are the 6 names from Godrej's side. Because they say that these are bottom-up drivers. UBS note on FMCG or consumption effectively highlights, saying that they say they prefer DMart and Trent as income stimulus plays. They see HUL and GCPL as turnaround stories, and they view Colgate and Britannia as companies where the earnings are at an inflection point. Godrej Consumer is the common name between both of these brokerage homes.
Okay, very, very interesting, and it has been a sector that everyone's been waiting to take off. And if at all if at all in the last few sessions, it's actually underperformed when everything banking finally coming to the party, right? So let's see if that comes through. But a whole sector, of course, and we've already mentioned it, Tamanna mentioned it, steel players in focus on the back of the decision by the Indian government to impose a 12% safeguard duty on steel imports. The duty has been the talk of the town since the last year, and the 12% number was first recommended in March this year. Mika is joining in because she tracks this very closely. Mika, this has been an ask for the industry. What are the key details here and what are the implications?
So the government has announced a 12% temporary tariff or a safeguard duty on some steel imports, and this duty is effective for a total of 200 days, effective today. Now, it is a positive development for the steel players, and it removes a key overhang that we've seen on the stocks for a couple of months now, and analysts do expect a positive reactions on steel stocks today. In terms of the duty, well, it will be imposed on the following products if the import price is below the specific threshold. For hot roll coils, it stands at $675 per MT. You also have hot roll plates and cold roll coils where the threshold stands at $695 and $824 per ton. Your metallic coated steel coil and sheets, the threshold is at $861 per MT, and colored coated coils and sheets, it stands at $964. In terms of the impact, well, one is better steel prices. Currently, domestic steel prices are at an 18% premium to the import prices, and Morgan Stanley expects the duties to lower this premium between domestic and import prices to 5%. In terms of for the businesses of the steel companies, well, it's a positive development, and it's positive for the EBITDA of the steel companies, and analysts had expected a 7 to 15% EBITDA gain when the duty was proposed in March of 2025, and we did see some estimate increases that time. Lastly, in terms of how the industry has reacted, well, JSPL's Naveen Jindal has stated that he welcomes the government's decision to impose the duty on certain steel products, and it's an important step to protect Indian manufacturers from unfair imports as well as boost domestic production. Even the CEO and MD of Tata Steel has stated comments on the similar lines. He says that we welcome the government's decision to import the duty, and it's a critical step in addressing the surge of unfairly priced imports to India.
Thank you for that, Mihika. Now, what is the extent of benefit that we'll see? Aditya Velekar, Senior Research Analyst Metals at Axis Securities, joining us this morning. Aditya, very good morning to you. You reckon a sentimental positive definitely this morning, and what is the clear advantage, quantifiable advantage you see for domestic steel companies?
Yeah, good morning. So, from the date of March, means when this DGTR announced this safeguard duty of 12%, when it proposed, so now that is a formal announcement is coming. So that is a relief, but most of that positive was already factored in, and steel mills have taken price hikes just prior to the DGTR announcement itself, and the price hike quantum was in the range of 2,000 to 3,000 rupees per ton for HRC prices. And if you see currently on an import parity basis, the discount to Chinese imported steel, the domestic steel prices the discount is not very significant. It's just 1 or 2% discount. So and this is after even the 12% safeguard duty. So what essentially we need to see is that if the Chinese steel prices comes down further, then this discount will vanish, and the risk of cheaper Chinese imports will still persist despite the 12% safeguard duty. So although it's a sentimentally positive news for today, and the overhang is gone with this formal announcement, so that's a positive. But going forward, if you want to take a medium-term look, then the critical data which comes from China, especially with respect to their steel exports and their domestic steel production, that will be a key monitorable. We will not pay much attention to the data up to March because they might have preemptively they have exported more steel in anticipation of enforcement of tariffs from April. So the data from April will be a key monitorable. If the steel exports continue to remain high and they continue to produce large quantum of steel, then the regional steel prices will continue to remain under pressure, and the domestic steel mills will find it difficult to increase the prices from this level.
Extent, Aditya, of a price decline by Chinese steel producers would be the worst outcome, and what can be absorbed? Can you quantify that?
Yeah, so in terms of absorption, I will comment on that. So if you see the price hikes taken by steel mills since the first announcement by DGTR, so the quantum was, as I just said, it was 2,000 to 3,000 rupees per ton, and that I am getting a feedback from my channel checks that even that price hike is not getting fully absorbed by buyers, and the sellers are struggling to pass on that price. So as I said, means up from this level, the price hike looks slightly difficult unless we see increase in Chinese HRC prices. So that is our view. So on the flip side, the positive thing for the steel sector is that the coking coal and iron ore prices have remained soft, and that has conserved the spreads. So that's why the stocks are slightly in a range-bound region, and they have not reacted very negatively. But overall, I think clear demand indications from China or any stimulus from China will be the key trigger, and that will provide a fillip to the domestic steel names.
Aditya, just wondering that would SAIL, by virtue of the highest capacity, so to say, impacted, be the key beneficiary for this move, even as you say that things may cool off a little bit later on?
So this move is beneficial to almost all the steel players. Specifically, if you want to classify, then the flat steel producers, for which this duty is applicable, because long steel production and long steel producers, the duty is not really of any impact, because long steel is a highly regionalized play, which is used in the domestic construction. So the players like Jindal, JSW Steel and Tata Steel will be more benefited, because their flat steel contribution over to the overall product mix is higher, and also the sensitivity of steel prices and coking coal prices is very high for players like Steel Authority of India, where the fixed cost is quite high. And with a high fixed cost, their sensitivity to these coking coal and HRC prices remains very high. So any fluctuations on that will also move their stock price relatively faster. So for SAIL, Tata Steel and JSW more positive. JSPL, Jindal Steel and Power has more proportion of long products, so may not be that beneficial. So that is in general I can say.
Aditya, with this context, then, if I were to ask you, not just in steel but also in the broader metal space overall, what would your recommendation, or what would you be positive on based on all the information that we've just discussed? Would it be ferrous or would it be non-ferrous, and which would the pick be?
At this point of time, ferrous looks slightly more supported because of this government policy action. And also, as I just described, the lower coking coal prices, which is supporting and conserving their spreads. So ferrous is our pick amongst the metal pack. In the non-ferrous, the issue is basically both LME, aluminium and zinc. The prices have come under pressure since the 2nd of April reciprocal tariff announcement. And in the medium term, because of these reciprocal tariffs and the trade negotiations, the question mark on the demand, industrial metals demand, is emerging. So at this point of time, steel being a localized commodity, and given India's domestic steel production and consumption, especially domestic consumption growth is quite strong, which we have seen in last couple of years. It's growing in double digits. So that is supportive for steel players. Non-ferrous metals, it's non-ferrous, as you know, it's traded on London Metal Exchange, and we are the price takers. So a lot of pain is there and uncertainty is there. Although the thermal coal prices for these aluminium smelters, that has remained quite soft and is conserving the spreads for non-ferrous metals. But the LME aluminium prices have declined from the peak, and the medium-term prospects are slightly uncertain. So that's why we prefer steel over non-ferrous at this point of time.
Okay. Point well made on ferrous versus non-ferrous, but then within that pack, within steel makers, then, which would you prefer? What would your top pick be?
Our top pick will be Tata Steel, followed by SAIL, and then JSW Steel and JSPL in that order. And in non-ferrous, most of these companies, they are going for a big expansion. So it's a function of LME aluminium prices. So in terms of the expansion capabilities and execution capabilities, Hindalco screens first, followed by Vedanta and then Nalco.
All right, thank you so much, Aditya, for all of those views. And I think it's important to note that we'll have to wait and see what the April uptake is before we know that this is beneficial. Sentiment upside today could be seen. Here's what's on our watch list this morning, and it's all green. So that's interesting. Coal India up there, they've signed an MOU to set up a power plant in Jharkhand. Brigade Enterprises will be developing a project worth 175 crores. HG Infra wins bid to set up battery energy storage system. Himadri Specialty Chemicals has a good set of numbers, likewise for Pitti Engineering.
Okay, and you've got Anantraj as well that is in focus on the back of earnings. The profit has risen as much as 50%, and so therefore it's a thumbs up. Tata Steel, GSPL sale, we've just spoken about this. The imposition of 12% safeguard duty is seen as a positive for the domestic steel makers. HDFC, Kotak, Axis, and a whole host of banks. The RBI has in fact aided system liquidity. The norms on liquidity coverage ratio have come through and they're viewed as broadly positive. Dr. Agarwal's healthcare is in focus on the back of a Kotak initiation with a coverage with AD, in fact. 361 WAM has approved a strategic collaboration with UBS AG. It's an acquisition of a business which is a positive.
All right, let's go across to our first set of conversations this morning. Kunal Rambia, founder of The Street, and Neerav Ashar, head equity research analyst, Latin Manharlal Securities, with us today. Very good morning to both of you. Kunal, up and away for the Nifty. Do you see that upside, or a bit of pressure maybe coming in? Implied also showing a muted opening, but then to be fair, it did so yesterday as well.
Good morning to everyone. Thanks for having me on the show. So yes, as you rightly mentioned, it's crazily up. But if you look at the overall trend, this is what we were discussing since pretty long time, that it's been 3 months of sideways consolidation and Nifty has finally given a breakout of that consolidation. And this rally was almost like 11.5% on the index in last 8 trading sessions. So kind of sideways with, positive bias is likely. But seems that Nifty is heading for 24,750, 24,800. That's the first target to watch out for. Buy on dip can be a good strategy. 23,500 to watch out as a support level on Nifty.
Hi, Kunal, morning. What about Nifty Bank? Because ultimately that's what everyone's talking about. Does the outperformance continue? We've already breached 55,000 on the upside. Does a cool off happen? What are the key levels here?
So, that's the point to, always note, Alice, that people it's very difficult for most of the guys to change the mindset from bearish to bullish. And that's why trend following always works well. So yes, Bank Nifty rallied from 49,000 to as high as 55,000. For now, I think more or less upside seems to be muted now from here on. 54,000 is something to watch out as a support. 54,000 by any chance, if we see in next 1 or 2 days, I'll think of initiating fresh buys. But as of now, there is no need to take contra bets, and I think more or less Bank Nifty is likely to outperform Nifty even in the time to come.
Okay, and you've picked up or you've identified 3 stocks this morning. Could you tell us about the top picks that you have, Kunal?
Absolutely, Alex. So again, I'm not picking up any counters mainly from a large cap or index as such, but yeah, the counters are those which have really performed and which are showing good strength. The first is Kaveri Seeds, which is looking very attractive to me. We have been discussing this counter since quite a long time. It's trading at 1554 right now. I think this momentum is likely to continue. With the stop of 1500, one can initiate a buy and the target can be 1650. The second is Adani Green. This entire pack is looking good to me, but Adani Green seems to be showing good pattern formation to me. So with the stop of 940, one can initiate a first trade and the target can be 1000. And the third is DAM Capital. Now this counter is right near to extreme low levels and showing good inverse head and shoulder formation. So with the stop of 220, one can initiate a long on that also. Target can be 260. And in all 3 counters, it's advisable to keep trailing the stop loss rather than booking profits. I think if the market continues, then these 3 counters might outperform.
Neerav, let's come to specific sectors which could be in focus. And I'm going to start with financials. Another booster shot coming in from the Reserve Bank of India. Do you see that uptrend continue as far as financials are concerned?
Well, good morning and thank you for the invite. We did see, we've seen consistently a very good set of measures being taken by the Reserve Bank of India, the rate cuts which have taken place. And subsequently, I think all the policy actions which have come in yesterday about the liquidity coverage ratio. So I think this augurs extremely well for the financial space, and we've seen the banks beginning to perform quite well. Although there was a doubt that the repricing of the deposits and the repricing of the loans, I think as we know that the repricing of the loans happens faster than the repricing of the deposits. So the transmission is likely to take some time, and I think the logical action should have been an immediate impact on the net interest margins. They should have been on the downward side, but very surprisingly, we've seen the net interest margins improve. So this is very positive. There's been an improvement in the asset quality. And of course, we are seeing NBFCs also beginning to perform extremely well. We are seeing good action across the board, whether it is Bajaj Housing Finance or a Bajaj Finance or an L&T Finance Holdings, Cholamandalam, etc. Apart from this, we are also seeing capital market participants begin to perform very well. We've seen a few numbers, Anand Rathi Wealth, we've seen Angel One numbers. So there also we are beginning to see traction. So I think the entire trajectory, the entire ecosystem is performing quite well. And finally, not to miss the AMCs also. After a strong performance coming in from HDFC AMC, we are beginning to see positive impact on UTI AMC, Nippon Life AMC also. So I think it's quite positive.
Any of these, Kunal, that you would pick? But before I get to you, Kunal, on that, let me go across specifically on 361 in the news this morning. And by the way, any of you who heard on the street segment yesterday on India Market Close would have seen that we did report this. Harsh, we talked about 361. Swami Sarkar did that in his segment. And it has been confirmed now. The wealth management firm has approved an exclusive collaboration with UBS. What are the details?
Well, yes, it's a big one here, and it's a three-part transaction. If I were just to simplify it, break it up. First one is they've agreed to an exclusive strategic collaboration with UBS AG. This will, of course, allow clients of UBS access to wealth management services of 361, which is obviously a big positive in itself. As part of this exclusive collaboration agreement, they've also allowed UBS a preferential issue at 1,030 rupees a share, which is at an 8% premium to yesterday's close and roughly a 14% odd premium to the 3-day volume weighted average price of 361. So 1,030 being that price, 2.05 crore shares to be issued. So the consideration, cash consideration which 361 will receive as a result of this is around 2,100 crore, which entitles UBS to around a 5% stake in 361 post money. So that's post the raise. And this is, of course, post conversion as well. So it's currently a convertible instrument which they are investing in. Now, so these are the two key pieces. The third piece is with regard to the acquisition of the India business of UBS AG, and this includes everything from the portfolios that UBS handles all the way to the Credit Suisse portfolio, which UBS India also owns. All of those will be transferred for a consideration of 307 crore by UBS to 361. So they'll acquire all of those India businesses as well as part of this entire collaboration, come acquisition, come share issue. So three-part transaction, roughly, that's how it's playing out.
Okay. Let's also look at how the share prices moved. And let's just pull up the 2025 move for 361, because it's been a bit of a bumpy ride. 24% or so declines at this junction. It has bounced just a tad bit from the low point. But Neerav, on the fundamentals and also on this latest development, how would you rate it? Would you go out and buy? And I know that you spoke about a few of the capital market plays coming back into focus, right?
Yeah, well, that's true. Most of the capital market players have been making a comeback after having a turbulent couple of quarters. And I think hopefully things should improve from here. And this is also being reflected in the kind of deals which are being worked out. We did not hear about any deals, any significant deals taking place in the last one quarter. But I think hopefully things are beginning to look up with improvement in the market situation also.
Kunal, you spoke about Adani Green, and I think a few days ago, maybe on April 17, there was this note from Jefferies. You spoke about how the global market, capital market access is easing for the group, and they have given a note on most of the names. So is Adani Green the only one in the pack, or is that the favorite one, but some of the others could also do well?
So yes, Neeraj bhai, the entire pack is looking actually attractive as I mentioned. But why Adani Green specifically is because from November 20 so far, this counter has multiple times tested 850 mark, and right now it's trading at 950. So risk reward ratio is extremely favorable on this counter. So that is a reason to pick up Adani Green. But otherwise, if you look at Adani Port, again, that's trading near to the high itself. Support is far away. Risk reward ratio is not favorable, though it might have good momentum. But from longer term perspective, if we give importance to risk reward, I think Adani Green is looking attractive.
Okay, so viewers, just for clarity, on 17th of April, I think the brokerage house Jefferies came out with this note wherein BlackRock, they cite BlackRock subscribing to Adani Group's 750 million bond issuance in April, as per media reports. Now, this was the group's largest fundraising after the US Department of Justice indictment news in November 2024, which means that effectively for a lot of people, this highlights the group's ability to raise foreign capital for growth, which will be a big thing. And I think which is why maybe Adani Green is doing what it is doing. The executive order is seeing some relaxations in the DOJ cases as well. Hence, Green and some of the others might actually be interesting. Adani Green's capacity, by the way, is up about 30% YOY in FY25 to 14 gigawatts. And some of the others are also doing well. So keep that in mind. Add to that the fact that if we do see the airport getting launched in June, then that puts Adani Enterprises, the holder of Adani Airport Holdings, also firmly in play. So keep an eye out. And standard disclaimer, of course, the Adani Group owns NDTV as well. Do we need to slip into a break? Okay, one more question here. Nirav, the other piece is around what banking name would you prefer, if you haven't spoken about that already? Because, I mean, the RBI relaxations, one more, yes, which aids sentiment in BFSI, but a lot of people are talking about buying the second-rung banks now, the first-rung banks having rallied. So what to your house, in your house, which is the second-tier bank which you guys like the most?
Well, I think we've discussed earlier also, and I think we'd like to reiterate that we like banks like Federal Bank in particular. We like CSB Bank, Catholic Syrian Bank. We like Karnataka Bank. So these are some of the preferred names in the tier 2 category. And now we are closely looking at some other banks like DCB also, and on certain select NBFC names too.
All right, we have to slip in a very quick break, but let's see how the second-rung banks that you've just mentioned, Federal, I think is something we've spoken about a lot in the recent past, and I think we will focus on it at the start of trade as well. But slip into a very quick break, more on the other side. Do stay tuned.
The second buyback is in Naukri Info Edge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
The first stock on the list is it's IGL now. If you see the stock that has perked up around 4% in trade, and this is largely on the back of the buzz that is on the street, that the company might announce a price hike of anywhere between 3 to 4 rupees from the 1st of April. Now this might as well happen in phases, so keep an eye out for IGL. Now this stock had to, the company had, in fact had to take a price hike post the Delhi election because the cost of gas had increased for them, and because of that the margins had come down, but they had not taken any price hike so far. So the street is expecting a price hike announcement to come in, which will be effective from the 1st of April, and it could be around 3 to 4 rupees, and it could well be implemented in phases. So keep an eye out for IGL.
Do you really know the company?
Back with India Market Open right here on NDTV Profit. Now, I mean, there are a few names or a few stocks which, of course, will be in focus today. We've spoken about some. The interesting one, I mean, steel and metals having been discussed from a stock-specific perspective. A clutch of reports that have come in on the FMCG names. And Kunal, the common one amongst a few of them seems to be Godrej Consumer Products. Now, it's a sector that's not lent itself to giving great trading ideas in the last few days or weeks or months. But is there a trade in GCPL?
Absolutely, Neeraj bhai. So if you look at GCPL, this counter has already rallied significantly in the recent times. Just a month back, it was trading near to 985, and now it's at 1200, and the trend still remains very, very strong. So the further breakout will be placed at around 1275 kind of levels. So from 1215 to 1275, this 50 points, I would stay cautious. I'll stay away from this. But if the counter gives a breakout about 1275, I think then we can expect the levels of 1400 also. And rather than going for GCPL, I think the other counters are well poised for the short term as well as the momentum trade.
Okay. Well, the pre-open rates kicking in, and of course we'll revisit them at 908, but just the initial rates. Remember, the US markets ended about 2% apiece down. We are saying we are in our own land right now. If we were punished very brutally, then currently we deserve the right to actually go up while the world markets may be floundering, if you can use that term. Not as strongly, really.
We are saying menu ki. Whether US markets are down or not, we're doing our own thing at this point.
But remember, like a month ago, right? Everybody was saying that US markets upar jayega, fir bhi India corrects. So India is being meted out special punishment. So now the reverse is happening.
So I read something this morning that talked about the fact that maybe something of what Donald Trump has been doing is maybe to bring the dollar a little lower because it benefits exporters. Again, conspiracy or theories, right? But the line was, be careful what you wish for, how far can it go? And ultimately, if you're saying that the dollar is weakening, there are no takers for US treasuries, stock markets are falling, where does that money get deployed? Gold, yes, but also in attractive looking capital markets.
Yes, most certainly. India fits the bill out there for sure. Well, lots happening on the global currency side as well. At some point of time, we'll do a conversation on that too. But for now, focus on stocks that might be moving. Now, because a lot of queries yesterday that came that if you missed out on the Bank Nifty rally, what do you do, right? And we've spoken about what some of the large banks or the mid-sized banks, I mean, Nirav spoke about Federal Bank, etc. A small tilt, Nirav, towards what can you do in second tier NBFCs as well? So everybody speaks about Bajaj Finance, and that's the easy answer, right? I want to ask you if the recent upticks in MFIs have enthused you enough. By upticks, I don't mean price upticks, but you would be happy if the price is lower because you get to buy it at a lower price. But the numbers at the margin seem to be improving. So anything out there, Fusion, Credit Access, etc., that you like?
Well, I think all these companies have been through a turbulent phase, and I think now, of course, the next round of fundraising also could be around the corner. So I think we are seeing some improvement in the results, but I think we need to wait for a couple of quarters, because a lot of all these things could be tied up to the state of the economy also. And one very positive thing which we are noticing is the improving health of the rural economy. I think rural economy is the place to be at this point of time. So I think somewhere we could link this to the performance of the microfinance companies also. So I think, but we've not looked at anything specific over there till now. But maybe this space is poised for better times.
Okay, all right. Kunal, I'm coming to you. Anything interesting that is playing out? I just want to pull up some of the names that we've discussed. Maybe something like an HG Infra, something like a Himadri Specialty. Can we pull up those and see what's up? Okay, HG Infra only about 1% or so. Let's pull up Himadri. Okay, Himadri is doing reasonably well at the start. Let's see where it moves. Dr. Garwal as well. Okay, it's not moving too much, but Himadri Specialty Chemicals, apologies for that. Kunal, anything here that would cause you to say there's a trade here?
So Alex, I think Himadri Specialty Chemical is looking good only because the overall trend on the weekly chart still remains positive, though it came down substantially from the highs, but after consolidation from Feb till April, it is now showing the signs of breakout. And that breakout happened day before yesterday, which was placed at around 455, 460. It's trading right now at 480. I think this momentum is likely to continue. 515 to 525 can be the first target range. And if someone is playing the trend, I think one can stay invested with the trailing stop loss. Right now, the stop loss is 450. Hold on with that particular stop loss, and buy on dip can be a good strategy for the long-term investors, because this counter has a positive trend.
Positive trend for Himadri. Nirav, any view on this stock? Because we're talking about a decent performance, at least on the bottom line front. Margins have expanded, and they're also building capacity quite significantly. Carbon black, they're going to double by third quarter of this year. What would you say about Himadri?
Well, yes, we've been tracking both the companies in this space, Himadri Specialty and Philips Carbon Black. Himadri Specialty Chemicals, as you rightly pointed out, they are doubling their carbon black capacity, and carbon black, mind you, it's a key raw material for the tire business. Another important factor is the acquisition of Birla Tires, which they have done. That is progressing quite well, and that is likely to go on stream very soon. And the third important aspect is that most of these companies, they have invested heavily in specialty chemical businesses. So lithium active material is something which they have been focusing on. That there's a big expansion going on over there also. So all that is likely to give the results in the time to come, and then we'll be having a very, very different kind of a margin trajectory. Yeah, the margin trajectory is likely to improve as we have a better share of specialty chemicals kicking in going forward.
Okay, I want to take a look at some of the financials in the first few minutes of pre-open. What's happening right now with an ICICI, with an HDFC, financials back in focus as well. You were speaking about 361 WAM and the likes, Nirav. Let's take a look at some of them. 361 WAM, of course, in focus because they've inked that deal with UBS. That's why you're seeing that kind of a move over there. What would be your top pick, Nirav? You think there's still an upside there left to an ICICI Bank and HDFC?
Well, we continue to hold these stocks.
No, but if you were not in it right now, would you go ahead and buy?
No.
Sorry?
No.
Okay, that was quite succinct there. Any view you have, Kunal, on a 361?
So yeah, if you look at the trend is definitely negative so far. It's clearly making lower top, lower bottom even on the daily chart. But the breakout is placed near 1050, 1025. So if the counter manages to close about 1025, then with the stop of 950, one can initiate a buy, and the targets can be 1175 to 1200 levels. But again, I'll just have to, I mean, we'll have to wait for a day's closing about 1025 to initiate a trade.
Okay, let's look at the big brokerage call for the day this morning. Kotak has initiated a buy on Dr. Agarwal Eye Care. Let's go across to Harsh for getting some synopsis of that note. Harsh, why have you chosen this one today?
Well, there's been plenty of coverage. In fact, Neeraj, with regard to Dr. Agarwal's, it's been in focus over the last month, couple of initiating coverage notes. And therefore, this kind of note stands out despite just about a 5% upside, which Kotak has given. 425 being the target price. Now, what's really standing out is they believe that ROIC, which is return on invested capital, the ratio will inch up and inch up significantly. Currently, ROIC is depressed, but they believe that EBITDA growth largely led by growth in branches. And what they are opining is that branches, or rather the centers that Dr. Agarwal's runs, will go up by nearly 2.5x by FY28. Existing branches will drive better returns and EBITDA growth as well, and the newer branches will drive expansion. So both of those twin engines will help the company clock an ROIC of 12% by FY28, and thereafter build on that is what they are underlining. They are highlighting a 23% EBITDA CAGR and a 27% EPS CAGR over FY24 to 28, and they believe that this one is fairly valued at around 27 times FY27 EBITDA, EV to EBITDA. And therefore, they're very positive on it, just about a 5% upside. But an interesting note, because we've had several similar notes coming out with regard to initiating coverage, especially in the healthcare space, and more so, a couple of them for Dr. Agarwal's.
It's not doing too much. Harsh, thanks so much for that. It's not doing too much in trade, and as I pointed out, was on my list as well. The upside potential just about 5% or so. 425 is a target that Kotak has. So bear that in mind as well. It's not done too much since listing as well. All told, it's just about flat. Any view on this one, Neerav? Do you have coverage on Dr. Agarwal's healthcare?
We don't have coverage, but we understand the business model quite well. Basically, it's a collection of the different medical practitioners, bringing them, acquiring their practices, individual practices, bringing them under one roof, and then trying to get the benefits of synergy in terms of procurement, in terms of manpower, in terms of purchases, etc. So it's an extremely attractive business model. It is going to be a slow burn, but when we see the results, then they're going to be phenomenal. So I think I wouldn't be surprised if at this point of time the stock remains sideways, but we will see results, very good results over a period of time.
About metals this morning, look at SAIL, look at Tata Steel, JSPL, JSW Steel. We had a very interesting conversation at 8:20 this morning. In case you didn't catch it, you can see it on our YouTube channel with Aditya Velekar, who said that you'll see a sentimental positive, but it may not go through. Neerav, dare I ask, yes or no on steel stocks?
Yes, but it's likely to fizzle out also. That's rightly pointed out. Because already the domestic steel players have been reporting very strong margins. If you see the operating performance of the steel majors, I think the domestic operations have been performing quite well. Realizations are quite strong. Backward integration is taking place. Modernization has taken place. And the margins are quite thick. We have operating profit margins of the domestic operations being more than 20% plus being reported by companies.
Okay. What about Kunal on the charts? Of course, they were expecting to be a bit of a pop for these steel names in trade, and that's panning out. But would you venture into any of them, or would you hold your horses?
So I'll not buy fresh at this elevated level, Alex. The only reason being, just look at JSW Steel. In last 7 to 8 trading sessions, it's up by around 20%. Just a couple of days, it was trading at around 900. Now it's at 1060, and that's near to the previous high itself. So technically, I think there might be some kind of profit booking at this level. If someone is already holding, I would advise to trail the stop loss and hold positions, but fresh entry at this elevated level is a big no.
Okay. We were talking, and Neeraj in fact was pointing out in his trade setup that he finds it difficult to argue for a sustained up move for IT, and indeed already, and of course I don't want to preempt anything because you could see a turn, but already in the pre-open session and post the pre-open session seemingly a bit of a cool off. But I'm just wondering, Kunal, whether if you got a pop yesterday in some of these names, would you book that profit? Would you book that gain? And would you stay off just a tad bit and be a little cautious because there's so many moving parts here?
So, Alex, with all due respect, I'm very bullish on IT stock and IT sector, specifically Infosys and TCS, because again, as I mentioned earlier, risk-reward ratio for me is extremely favorable. Infi, we initiated a buy near 1350. Right now, it's trading at 1440. If I'm a short-term trader, I would definitely trail my stop loss to around 1415, and I'll exit if that's triggered. But otherwise, I think these are the levels to watch out for, and someone can create a positional, long-term bet on these two counters at least, and expect, the upside of around 10 to 15% over the next 6 months.
Okay, Nirav, do you concur on the view on positive trade for TCS Infi? Which would you pick, particularly based on what you know, and what would you watch out for very quickly on HCL Tech?
Well, we continue to like TCS and Infosys, but at the same time, we feel that mid-cap companies have better growth prospects going forward. A case in point is Tata Elxsi, where we read the financials. If you see the financial performance, it's almost flat with a negative bias, but the commentary looks quite promising. So I think that's the way we look at the mid-cap IT companies at this point of time. And I think hopefully we should have a better commentary from HCL Technologies going forward.
Anything else that you're spotting, Kunal, even from the broader market, anything that stands attractive post the open session?
So I think JK Paper can do well. This counter was in sideways consolidation for quite a long period of time. Today it's gap up opening and giving a breakout. So if this counter sustains at this level, I think 365, 370 is something to watch out as the immediate target.
Okay. Watch out for JK Paper. Both our guests saying that they are not very enthused about the steel companies. So bear that in mind to enter at these levels effectively. They'll start off higher, but both our guests are saying that this is not a wise point of entry. And selectively on the Adani Group stocks, I think there is some constructive opinion from both, I believe. Kunal in particular likes Adani Green, so bear that in mind. And as we speak, at $3,480 or $3,500 to a troy ounce, gold is the real bull market. It's scoffing at the others, including the dollar, and saying that I'm charting my own course. But our markets are not doing too badly either. And let's see how we do today in light of the fact that the US markets didn't have a great day. We're likely to start off well. The question is, can we build on from there after the rally that we've already seen? Well, about 0.21% higher, not bad. Banks are still doing okay. I wonder if IT is picking up steam or giving it up a bit actually. Nifty IT. Mid caps and small caps, 0.33% for the mid cap index and the small cap index 0.4%. So not a bad start. Let's get the heat map up on the screen. What's sulking? IndusInd Bank down 4%. Then some of the IT names, I believe, because Infi, TCS, HCL Tech, Tech Mahindra, Wipro, they were in the top quadrant yesterday, giving up some of the gains. Bajaj Auto is in the red. There is also weakness in SBI Life and Power Grid. But effectively, it's IndusInd Bank and IT. And IndusInd Bank is slowly now down close to 5% in trade. So that's the set of losers. What about the gainers? There is Tata Steel, JSW Steel, Hindalco, Coal India. So the metal index, really, we can hear Metallica almost. Adani Enterprises in that list too. And then HDFC Bank yesterday led the gains on the points front and still up in the session today. So keep an eye out for that. Trent, Kotak Bank are amongst the others, which seem to be doing okay for themselves. Well, that's it from the large cap space, Tamanna. Metals ruling the roost.
Metals ruling the roost. IndusInd Bank in pain after a report this morning in the newspaper saying that EY has been hired for another audit, and this time a probe of a 600 crore gap in their microfinance portfolio. So that news report that and fear that there might be more can of worms or more skeletons in the closet, possibly looking at that outsized drop in IndusInd Bank. In fact, that's what's really dragging in part the Nifty. I don't know if we can pull up Nifty contributors very quickly just before we get to the broader markets and see what's happening there. You have Infosys, the drag there as number one. I mean, I don't know if clarity has emerged or what has happened, because the guidance was weak, the outlook was weak, the numbers were poor. I'm not sure what was happening with Infosys yesterday apart from short covering, but yes, Infosys down. IndusInd Bank is the second big dragger, not outsized weightage, but definitely because of this news report, seeing some pain there. ICICI Bank, so the bank's actually turning. It's HDFC's turn to shine in that sense. Let's pull up the broader indices if we can, small cap and mid cap stocks, and see what's happening there. Are you seeing some boost in the broader market? Just pretty much holding up. In terms of, 0.25% up, both on the small cap and the mid cap. We'll pull up the sectoral indices very quickly for you, and metals will be, in all possibility, actually, ruling the roost, which it continues to do so. The Nifty metal there, defense stocks doing okay. Everything else is kind of middling in the range of about 0.25 or 0.5% up. What's hitting the most is Nifty IT, and this is something we've been talking about this morning, that the longer term pressure on IT stocks and IT companies, the sector as a whole, is something that needs to be seen. Auto following suit as well. A bit of a shaky start for the market, if at all. But corporate results in focus, and let's look at some of those specific stocks. Anantraj, Himadri, Pitti Engineering. Pretty decent numbers on the face of it. Pitti, of course, a drop in profits because of a one-time impact, but otherwise decent numbers, and you're seeing all of them doing fairly well. Anantraj, they're about 4.5% up. Himadri and Pitti also in the green. Safeguard duties impact. We saw Tata Steel. Let's see what's happening with SAIL. SAIL also about 1% up. Tata Steel 1.5% up. HG Infra has a contract win for a 600 megawatt project. About 4% up on HG Infra this morning. And 361 WAM, they've inked that deal with UBS. We reported it yesterday on Heard on the Street. It has now been finalized, about 1% up on the stock. I just want to see what's happening with Muthoot and Manappuram. I was curious because gold at all-time highs. We saw Muthoot buzzing in the pre-open session as well. Remains about 2% up. Manappuram just middling there, not really too much action, but remember that run up with the Bain deal has already happened. So a somber start, I would say. If you look at it in relative terms, Alex, to what's happened rest of Asia and US, we're actually looking pretty decent, pretty good, but no fireworks this morning.
There are a few pockets of strength, and you pointed out a few, Tamanna, but I do want to point out from the broader markets, and I'm looking at the Nifty 500, the top two gainers are in the textile space. So take a look at Alok Industries as well as Raymond. They're doing quite the number today. Alok Industries up about 6%. And I was just trying to pull up data on the total production that is going to exports, and apparently I will have to check this, but about a quarter is what I can see, at least on the face of it. I will have to check this, bear that in mind. But I'm wondering what is at play here, because even Raymond doing particularly well, up about 5.4% or so. Anything with regard to the trade?
Pearl Global.
Pearl Global, we should talk about
maybe it is reacting to, because that's the other textile stock that we are going to get today.
Pull it up. Let's see where it is. Pearl Global, and whether or not the entire. So it's not the entire raft. A couple of them playing out. But Nirav, I think to a certain extent the expectation is that textile companies that also have some presence abroad, if at all there is some positive trade between the US and India that is discussed, of course, JD Vance here in India, it would benefit some of these companies. Do you buy into that, and would you buy into any of these companies also?
A few points. The first you pointed out about Alok Industries and Raymond. So Alok Industries has been beaten down very badly. It's been a rank underperformer. It's just trying to make a comeback in trade. And Raymond, I would look at it more as a real estate play at this point of time. So these are two factors, and for some really tangible rally to happen in the textile stocks, we need to see movement in stocks like KPR Mills or Vardhaman Textiles or the likes of Gokaldas Exports. That is where we really see signs of some turnaround in the textile space. And we have to look forward to the treaty, or what could be the broad contours of the deal. how they work out as far as the textiles are concerned. And textiles has never been so aggressive. So we've always seen a slow and a steady move in this particular space. There is a lot of focus on modernization. There's a focus on quality control measures, etc. So we've never been kind of very aggressive in that race as far as the textile space is concerned. So it'll be a slow and steady going forward as far as this sector is concerned.
Yeah, my mistake. Raymond, of course, is the real estate business, and Raymond Lifestyle is the textile business. It was split, of course. Alok Industries continuing to gain. Transformers and rectifiers is an interesting name. It has moved up quite considerably in the recent past. I'm just wondering, Kunal, on the charts, what does it indicate? Because we've spoken often about the power space. We've spoken about the prospects for this particular company. How does it look on the charts?
So, Alex, on the transformers and rectifiers chart, I think the trend is overall positive. In the recent correction also, it came down till 365 levels, I guess. But yeah, the breakout happened right on time, and now it's at 550, 560 kind of levels. So I think at this level also, if someone wants to initiate a trade, I think buy on dip can be a good strategy. Just keep one support level in mind, that's around 535. If the counter breaks below 535, then probably we'll have to turn cautious. Otherwise, this trend is likely to continue, and the targets can be 625, 630 as of.
Okay. All right, let's also take a look at what else is moving. And so what struck me about the banking space and the results that we've seen so far, HDFC Bank, let's see what it's doing in an otherwise flat market, at least for the Nifty 50, Nifty Bank not doing too much. It's gaining about 1% and lending quite a bit of support to the benchmark as well as to the Nifty Bank indeed. But the argument, Nirav, about the margins improving, and you pointed this out when we spoke about the earnings so far, right? I'm just wondering whether to a certain extent, out of all of the banks that could be in focus because of the lowering of deposit rates. Of course, HDFC Bank has also cut it by about 25 basis points on the savings bank accounts, right? So it accounts for about 23% of the deposit book. The question that I have is, if it's trying to replace high cost deposits in a lower interest rate scenario, would it be a bigger beneficiary than others because it might be able to change more of its book faster?
Well, definitely that is something which is expected going forward. And as far as, of course, HDFC Bank is concerned, there is a room to replace the higher cost deposits with the lower cost deposits. And consequently, that could have a very positive impact on the net interest margins going forward, because as it is, they are reporting margins close to around 3.6% as compared to ICICI Bank, which is reporting margins of around 4.4%.
By the way, certain information coming through. Apparently, IndusInd has roped in EY to conduct another audit to probe 600 crore discrepancy in its microfinance portfolio. The reason perhaps why the stock is under pressure at this juncture, 5% or thereabouts. Of course, it's made a comeback in the recent past, but it's losing ground again. Kunal, would you stay away from this if at all you've managed to catch the bottom on IndusInd Bank and you made some gains? Would you book right now?
So Alex, during that, that fiasco, we actually discussed on our channel also, and then eventually I posted the chart also saying that the extreme low levels of 650 were the perfect levels on the trend following basis. Now someone initiated a buy near those levels can comfortably stay invested with the trailing stop loss of 750 right now. And if someone wants to initiate a new trade, I think the good support is that 735, 750 itself. So keep the stop loss of 735 and buy the dip. I think the trend is likely to continue and good volumes are also happening. By any chance, if the counter breaks the day's high, then for short term also one can initiate a buy with the day's low as a stop. So yeah, overall trend is strong on the recent time frames and it's a thumbs up to buy.
Okay, well, amongst other things, since the Indian markets are doing so well, we thought it best to get in some macro note as well. And Morgan Stanley's Ridham Desai and team have put out that India strategy note in which they speak about why India continues to be our top emerging market pick. Now, yeah, this question mark is not needed, but there are a clutch of factors. They haven't bifurcated into it, but I have bifurcated into 3 buckets. So first, cross-asset factors. They say India's low beta is helping it to significantly outperform markets because the world markets or investors have realized that India is a low beta market per se. And weak global markets, the caution though, is that weak global markets can cap absolute returns, but relative returns, India will probably do well. The domestic factors which are at play for this, the strong macro stability with improving terms of trade. And this we can clearly see in a clutch of negotiations that are happening both from a G2G perspective as well as maybe G2B or B2G perspective. Then mid to high teens earnings growth annually over the next 3 to 5 years. We've seen that already. Hopefully we'll see that again because that's a big shot in the arm. The reliable source of domestic risk capital. And viewers, as much as we scoff at it, or if we scoff at it, is nothing to scoff at. That's a sizable pool of money that is coming in. And remember the HDFC investor, AMC investor con call yesterday, they mentioned that flows are still at 98% of peak, which is substantial in volatile markets like this. And of course, they point out that the dovish RBI, sluggish oil prices, and likely Indo-US trade deal are some of the key domestic factors. And technical factors include persistent retail buying, underpinning India's structural nature of the market. Foreign portfolios positioning is the weakest since we've had data in 2000. And there are early signs, according to Morgan Stanley, that the FI view is shifting and their proprietary sentiment indicator is in the buy zone. So multiple factors why Ridham Desai and team believe that India, as to justify how India is their top investment idea currently. Well, certainly things to watch out for, Alex.
Yeah, no doubt. And to a certain extent, I think this is also a reiteration and a building up of what Ridham himself had said just a couple of months back. In fact, he had called it at the NDTV Profit conclave that the worst is over. And in fact, the uptick is already underway in terms of economic growth and resilience. So this is something that he had called. Let's give him credit. Let's talk about some of the plays that you would need to focus on, of course, for it to improve. And we were talking about consumption and the fact that at least in the recent leg of the rally, it has not really participated to the extent that some might have thought. What happens from here, though? And Neeraj also pointed out an interesting set of companies based on a few notes that have come through as well. Neerav, if you were to look at the entire space, I think GCPL is something a lot of people are focusing on. In the FMCG basket, though, what would be your pick and what are the factors that you would watch? What are the key indicators that would tell you that now is the time to go out and buy?
I think the improvement in the rural economy, I think the rural economy has a lot of land holdings, it contributes to food security and it has a lot of gold. So I think this could be very big positives, improvement in the rural economy and the urban landscape also improving because of the tax related proposals, more disposable income in the hands of the people. So I think all these could augur well. And why just Godrej Consumer Products Limited? We've seen some positive commentary coming in from Tata Consumer Products also. Not that bad commentary from Marico. We are seeing stocks like Jyoti Laboratories continue to perform well. So the frontline companies definitely are facing some challenges as far as volume growth is concerned, but I think the mid caps are likely to perform better when we compare, especially with respect to the price and the value proposition.
Okay. Now, first 15 minutes of trade done. Kunal Rambia, anything that is standing out for you at the end of 15 minutes?
So I think Neeraj bhai, PSU banks are looking good to me right now. First is IOB, Indian Overseas Bank. I think at 38.90 one can initiate a buy with the stop of 37.5. The targets can be 41.5 to 42. The second is Canara Bank, which is again looking very good to me as at this point in time. With the stop of 96, one can initiate a buy. Targets can be 108 to 110. The third is Ramki Infra. Now this counter has come up in a big way from the recent lows of 400, trading at 515. I think this can also be initiated with the stop of 500 and the targets can be 550. So these are three stocks which are looking attractive to me as of now.
Okay, gentlemen, both of you, thank you so much for taking the time out and being with us. Really appreciate your time. Now, a lot is being spoken about the Indian textile industry, right? And the focus amidst the global tariff wars that are continuing. How will the changing global trade help in the Indian textile industry? What are the possible tailwinds? Before we get in the management of Pearl Global, let's get in my colleague Mihika to break it down for us. Mihika.
So the Indian textile and apparel industry is not only prominent domestically, but we did rank the third largest textile exporter in FY24, and with the US, the EU 27 and UK constituting around half of India's exports. Now there are certain global tailwinds in the context of trade. The first one is US's 245% tariffs on China. Now China is the top exporter to the US in the textile and apparel space, and any slowdown in Chinese textile sales to the US because of these tariffs could directly benefit India, and we stand to benefit from the shift in the sourcing preferences that the US could have. In terms of the market share, China, like I said, does have a dominant share, 20.8%, but our share has increased 5 to 5.8% in 2024 versus 5.7% in 2023. We also have the India-UK trade agreement that we discussed yesterday. It's in the final stages of negotiations, and the proposed free trade agreement eliminates the tariff and could make Indian textiles cheaper in the UK. We currently have a 7.9% share in 2024. This has dipped from 2023, but with better market access, the Indian textile industry in the export front could benefit, and that's why what we're talking to Pearl Global about, who is an exporter of garment.
Oh, most certainly. Mihika, thanks for putting that into perspective. And Pallab Banerjee, MD of Pearl Global Johnson right now, while they're in the silent period, to talk about this macro theme. Pallab, great having you. And thank you for accepting our request and talking to us today, because it's a very important aspect to focus on. And I know, Pallab, a lot of this is hypothesis, belief, and your experience, but that is what we need today. So let's try and break it down into two aspects. One is the trade war and the trade deals, and then we'll come to the FTA as well. Firstly, the media reports seem to suggest that a lot of inquiries from Western nations, particularly the US manufacturers and retailers, have started to come into Indian manufacturers because of the 245% tariffs on China as they stand, and therefore even during a usually not so busy first half of the current financial year for Indian companies, the inquiries are strong. Would that be the case, and why would that be the case?
First of all, thank you. Thank you for having me on this call. See, what is happening, China has got extra tariff at this point, up to 245%, but not for Apple. I think it's around 100 plus. Whatever the number is, it's quite prohibitive. So naturally, most of the players in US are looking for alternate source of China at this point of time, especially the business that they have placed and these goods that is getting stuck at this point of time because of this tariff. Now, once this dust settles, then we have to see how things really comes up. But for now, as I had mentioned earlier also, like most of the brands from US had moved out of China over the last few years from the direct sourcing. But there are some smaller brands as well as the importers who gets the goods into US and stock the goods and then give it to the retailers. So those players are very, very active in China, and a big number. China was still doing almost about, I think, some 25 to $28 billion of garment exports to US. So that particular segment, they are looking for alternates, and that's where some queries are coming to India as well. The challenge that the Indian manufacturers would face is the cost. This cost that originally these importers were buying from China was very competitive. So, and the ecosystem that China has, they could manage those prices due to various reasons. So that's where the challenge lies. But yes, at this point of time, a lot of queries are floating in India.
So Pallab, so therefore the question is that if costs are a challenge despite the Chinese duties and the ecosystem benefits stay in China, does this $28 billion of exports that China was doing to some of the smaller retailers, will Indian companies be able to step up in time to be able to take advantage of this short period? It may be a short period, right, as you said, because I heard you use the term before the dust settles.
Yeah. So two things. One, to manufacture the garment or the apparel, you need the raw materials. Now, where India has a shortcoming is that we don't manufacture all kind of textiles. We have been very strong in the cotton-based textiles, and that's where like it's a win. Definitely, the business that can come from China or from the other countries would get some kind of benefit because we have the raw material and we can do it quickly. The other products, like which is where we have to depend on the raw material from China, that's where the trouble starts. So at this point of time, most of the goods, if you are not sourcing from China, you would be sourcing it from countries like Indonesia or Vietnam or Cambodia, where the raw material can easily flow into those countries and then go to US. Whereas India, the uncompetitiveness because of this availability of raw material and availability of the other infrastructure that we have, especially like things like drawbacks, duty drawbacks and all. So which is compensated when we're doing the costing for these various products. So that's where like there is a challenge for India. But in the short run, let's see. What we are hearing is that some of these Chinese players are definitely offering heavy discounts to the US retailers from 10% to 40%, that range. But still, because of this, whatever has happened, this geopolitics or this tariff war, it seems that there are certain possibilities that India can encash upon in the short run. To build up the infrastructure for a longer run would take more actions, I would say.
Mr. Banerjee, hi, very good morning. Tamanna here. Important point you make about the opportunity that exists, but the challenges to actually encash that opportunity. Give us some perspective there. And, you know, for example, from your point of view, would you look at this stage as the chance to build up capacity and to be an alternative to some of those supply chains that China has been servicing? Or why just China? Let's look at Vietnam. Let's look at Bangladesh.
So we, specifically if you're asking about Pearl Global, we do have manufacturing, a substantial amount of manufacturing in Bangladesh and Vietnam and Indonesia, apart from India. We also manufacture in Guatemala. So naturally, like the shift that is happening from China, we are definitely, there's a huge benefit that we're getting in these other locations. Vietnam being in the close proximity, Indonesia, again, the kind of handwriting of the product and handling of those synthetic products is much more easier. So that's an immediate short-term benefit that we are experiencing as a company. But that's like specifically for Pearl. If we talk of India, India definitely we had foreseen some kind of challenges that would be coming up and some shift would be happening as the geopolitics has not been recent. It's been developing for quite some time. So we have been building up our capacity. We are ready to expand and can do more. We have to solve these challenges of raw material. Anything to do with Indian raw material, we are up and running. Anything to do with imported raw material, that's where I find still the Bangladesh or Vietnam or in Indonesia as much more attractive option where we can easily service our customers and take this benefit in the short run as well.
Change with the tariff impact baked in.
So tariff impact means you mean after 9th of July?
Yes. No, what I'm trying to say is after 9th of July, if India has relatively a better deal on tariffs, and for example, you have Vietnam who would see a more detrimental rate of tariffs because that was the state before the pause, right? Vietnam outpaced India in the tariff impact. Would then that skew the situation in favor of India?
On paper, yes. If you talk of only from price point of view or from only tariff point of view, it's definitely attractive. But as I said, like we have to keep in mind the readiness of the industry and the raw material flow. So that's where the shortcoming is, the biggest challenge is. And you see that other factor is the number. US has been always very deep in Vietnam, in countries like Vietnam. As a result, the infrastructure that is there, which exists, can service those kind of product, can use those raw material which is coming out of China, and as well as ship. So naturally, they gain in the last 3 or 4 years. If you look at the kind of substantial gain that has happened for the exodus that has happened from China is in countries like Vietnam and Bangladesh. These are the two countries which gained the maximum in the apparel sphere. And that's because of the reason that I'm talking about. Bangladesh more so because of cheap labor and the ease of doing business. You can bring in the raw material, produce the garment, and ship it out quickly. So that's the kind of infrastructure that Bangladesh did ramped up in this last 10 years. Vietnam was always has been focused on it. So that's why, we saw these two countries really gain that market share. Now is the time that India can do something similar. We need to definitely ease some of these maybe policies and some of the way that we work. The whole ecosystem, if it quickly readjusts itself, we can take a huge benefit.
Pallab, you're almost pouring cold water on this whole theory that people have around how Indian companies will benefit as a result of the Chinese duties, right? You're kind of saying that there might be some benefits, but nothing exemplary.
So yes, I told you again, like anything to do with cotton fabrics where we have the raw material, it's definitely a win.
But not otherwise. Okay. The other aspect is a belief that a lot of people have that the India-UK FTA, Free Trade Agreement, will actually be a fairly decent bonanza, if you will, again for Indian manufacturers. Is there merit to that argument?
Again, the reality is that India will come more equal to these other countries. Bangladesh already has a duty-free advantage because of LDC status that they have. And that is going to continue till 2029. Because even if it expires in 2026, 3 years of extra, guaranteed period that they have. Same is for Cambodia. Then Vietnam entered into two kind of pacts. One is the Comprehensive and Progressive Trans-Pacific Partnership, as well as a Vietnam-UK FTA. So these three countries, which are the major garment producers, if you see, already are there. India, we are expecting to be there by the next month. Almost 24 chapters out of 26 have been signed and dusted at this point of time. Small things are left. We are looking forward to it. Again, the immediate benefit, whatever we are losing out because of this cost competitiveness, which was not there compared to these countries, we will have that now. So suddenly, we get that extra 10% advantage. So yes, at this point of time, if you look at UK does import about $25 billion, I think, few years back. It had dropped because of the US slowdown, the UK economy slowdown over the last few years. I think it's still just below 20 at this point of time. So $20 billion, India does about, I think, 5 to 6% of that number. So that number, we are looking forward to a bump up, a significant rise, which is maybe it can become 30, 40, 50% more immediately. So that's an advantage that India will definitely get.
Okay. In which case, you are effectively saying, Pallab, that while there will be an immediate 10% benefit to maybe, let's say, EBITDA or bottom lines, but not necessarily on revenue, because it only brings India at par with the other countries. So yes, it's a benefit for companies to get extra 10%, but for incremental sales to come up, a lot of other factors need to change, even when it comes to the India-UK FTA, or for that matter, the benefits that come in from higher tariffs on China and other countries.
So just to clarify, this for a cotton garment, I think we get about 9.6% tariff that an importer has to pay in UK if they're taking it from India, which they don't have to pay if they're taking it from these other countries. So that makes it India more attractive. They would come with some more business to India as well. So it's not only the bottom line, but the attraction towards India, because certain products, let's say typical cotton product, a cotton shirt. Now, if this shirt is made in India and lands in UK, they have to pay a 9.6% duty. But if the same shirt is made out of Bangladesh or Vietnam, they don't pay that duty. So naturally, they would, at this point of time, they were sourcing it from only Cambodia or Bangladesh. Now, India opens up for that. Now, Indian manufacturers, if we compete on the prices of Bangladesh and Cambodia, we have a much more stronger hand to compete and gain more business. So both, there will be bottom line benefit for the product that we're already shipping, as well as this additional business that we can bring into India. But we will have the shortcoming in terms of those synthetics and other products.
Let's talk about what we need to do, Mr. Banerjee. I mean, apart from companies investing in capex, etc., what is the policy push that you need? We have a PM Mitra scheme, and we have a PLI, etc. All of that is happening. But what do we need to do to strike while the iron is hot as a nation?
So one thing, like I could talk about what we have been doing. We have opened up our factories in the eastern part of India, places like Bihar, Odisha, and all these places, so that our cost competitiveness to a country like Bangladesh is better compared to the industry, which have been more focused on the metropolitan cities of Bangalore or Karnataka in general, or let's say Gurgaon, this NCR region. Tirupur, some of the locations where the garment or urban industry has really developed. So that has to diversify. One of our biggest challenge have been the turnover of the workforce. It has been because the workers or the laborers have got much more options in India compared to a country like Bangladesh or Cambodia to work for. So as the industry moves to this region where the workers are from, rather than coming workers, a Bihari worker or a Odisha worker going to Karnataka or Tamil Nadu to work, if the industry can develop in those regions and government can support that, that's a huge advantage, I think, which is happening now in India. And PM Mitra is one such program that we are coming up with. At the same time, certain policies of import-exports, like so that the kind of benefits that can easily give us those quick wins, we can look at. Also, the final lines in this trade FTAs that will be done. That means what are the raw material sources, what kind of restrictions are there. So for example, like when you talk about this comprehensive Trans-Pacific Pact, so they have certain conditions that the goods have to be, like for Vietnam, the goods have to be from the Korea or the Asian region or some of these limitations. Similarly, what kind of FTA that we're signing with UK, where should these raw materials from? Is it open or is it closed to only India region? Those things also will play an important role. As I said, like industry, to have this variety of raw materials, India is lacking at this point of time. So that we need to also quickly come up. So there have been PLIs, but things have been slow. It has to really move fast now because I think in 2025, we are seeing the whole world order is changing in terms of the trade blocks or the groupism that is going to happen across the globe. So we need to encash upon those in India.
Exactly. We need to strike when the iron is hot, and I hope this is an opportunity we will not waste. Thank you so much, Pallab Banerjee, for speaking to us this morning. Now, just shifting focus to what is the worst performing sector for the last several days, but seeing, a mixed sort of bag today. It's been a tough quarter for the IT PAC, EBITs, PAT missing estimates, guidance lower than even brokerage estimates, and much more. HCL Tech is going to report Q4 today, so we need to see how that focuses and pans out. But meanwhile, let's go across to my colleague Puneet, giving us a recap of earnings so far, and also, Puneet, what we can expect from HCL Tech.
Well, definitely. Thanks for that. So it's been a somber start to the earnings season for all large cap IT companies, something that was baked into estimates. But, the commentary has been that there are some project delays that the companies are seeing. Essentially, the conversations are taking longer to close essentially in this particular time frame. Apart from that, from the Nifty IT is down 30% from its peak specifically, and we've seen, the expectation that mid-cap IT companies will be reporting better earnings than the large-cap ones, but Tata Elxsi numbers have been actually, much worse than the large-cap ones. So HCL Tech today, with that onset, is expected to have, flat revenue in this particular quarter, just about a percentage growth, but EBIT margins will be impacted for the company based on salary hikes in this particular quarter, and the basis of the guidance will be something to watch out for. There was expectation of a 2 to 5% growth in guidance for HCL Tech. Similar one was for Infosys as well. Infosys reported a 0 to 3% guidance for FY26, and I think the commentary from HCL Tech will be something that will be the key to watch out for. Generally, Q4 in terms of constant currency revenue growth is slowest for HCL Tech, and that's something that's across the IT pack. The second half is slower than the first one. But interestingly, we also had an MK note today come out on this. They mentioned that, that IT companies have not reported negative sequential growth, outside of the recessions of 2008 and 2020 pandemic effects. So, with the onset of first half is expected to be slow for FY26, it could actually be a washout year. So from this particular chart is essentially, where do you see value now in the Nifty IT pack? Is it the large caps that are expected to do better with the higher free cash flow yield now that the valuations have corrected, or is it that the mid caps with a niche focus is something to watch out for? And the last one will be that, essentially going into the next year, while cost cuts and will be something to watch out for with the Trump tariff impact, the key aspect will be, the GCC trend that we're seeing as well, because we're seeing some comments from Cognizant yesterday as well. So essentially a lot to unpack in this particular chart, with uncertainty being one of the key ones to go forward as well from here. And where do we go from here as well right now?
Where do we go from here is the question. Ravi Menon joining in. He's IT services analyst at Macquarie Capital. Ravi, great to have you on, and thank you for your time with us here on NDTV Profit. Let's start with your take on how the IT players have fared so far.
So I think that this has not been, I'd say, as gloomy as people have made it out to be. I think it's been moderately encouraging with North America for TCS actually, fairly flat. For Wipro, that's actually grown. So a slight decline, but it's been in-fees results, I think, that have been very disappointing, with North America down about 6%, and very broad-based decline across industries. But I think that's more probably company-specific and their portfolio-specific issues. It's not something that I would say applies to the whole industry. We expect that clients in the US will would have deferred some spending, but we are not looking at sharp cuts like we saw early on in the onset of COVID-19. People just want, I think, some certainty, and once they have that, they will start making decisions on spending. And I don't think that we will have a sharp quarter-on-quarter decline. Maybe revenue might be flat, marginally down in Q1, not a sharp decline. That's how I expect Q1 to be.
That's how you expect Q1 to be, but in terms of the guidance that has come from Infosys and from Wipro as well, do you think that IT companies are erring on the side of caution here, Ravi?
To some extent, I think, for Wipro, definitely that's the case. For Infosys, I think where the bookings are, it's actually very similar to what they've done in FY23. And, that year, in FY24, they reported 1.4% CC growth for the full year. And they actually had pass-through revenue as a tailwind that year. This year, as pass-through, they have suggested will be a headwind because they are expecting lower pass-through in FY26. So with that, I think, their guidance may actually, I would say, be realistic. But I think the others might err on the side of caution. And it really is a difficult environment. I would have actually said that, think we could have expected a tougher situation if it hadn't been already for 2 years of steadily trimming what they could cut. So we are in a situation where I think some of what could be thought of as discretionary 2 years back is now become an imperative. You really have to spend this year on some of these projects that have been deferred too long. So I would expect cost takeout projects to bundle with transformation. So larger deals, and I think that doesn't really rule out even some of the mid-cap companies, right? Because even they are now, many of them are over $1 billion in revenue. Someone like an LTIMindtree, I think, would be a promising challenger. Many of those Persistent, Coforge, or other firms that I think can also play good roles as challenger firms in this.
What are you hoping to hear from HCL Tech today, Ravi? What would you watch out for looking at what we've heard from TCS, Infosys, and Wipro so far?
HCL very marginally missed its guidance in FY23. So I think if they beat their guidance for this year of 3 to 5%, that's been narrowed down 4.5% now. That would be really good. The other thing, of course, is the guidance for next year. But I think the guidance for next year really, will be taken seriously if they actually manage to exceed expectations for FY25. So that's, I think, the key to watch out for.
Do they meet their guidance this year? And then, of course, you will look at their next year guidance seriously. One larger issue which seems to be emerging, and I'd like your view on this, is the conversion of this deal pipeline or large deals into actual revenues. That choke point is being seen for a while. How do you look at it?
I think some of this is actually because you had existing programs. That book of business has been under pressure over the last couple of years. As I think the US has had the steepest interest rate hikes starting, I would say, Jan 22. That's been the sharpest ever hikes. So IT is thought of as capex. When interest rates go up so sharply, people cut back on capex. That's essentially the whole idea of raising interest rates as well, that to clamp down on demand. So I think it achieved its intended result, and people have cut back. So that's why we, even though we've seen deal awards, and some of them may actually be, by the way, there could be a misleading number too, right? Because some of them could be renewals as well. So companies like TCS, they don't disclose a breakup separately. Infosys does give you the new deal and renewal deal separately, but the others, some of them don't disclose it that way. So I think that could be a misleading number when we look at that.
Ravi, good morning. Neeraj here. Been a while that we've spoken, and it's a very different looking Ravi Menon, I say, for the better. But Ravi, the question would be, somebody was making this point this morning that the last 2-3 times that Indian IT might have seen a 30% correction from peak, notably during GFC or during COVID, there was a monetary and a fiscal put from the US government for the US economy, and that resulted in a fairly furious pullback for the Indian IT services because there was visibility. This time around, that seems to be lacking, and a big lack at that. Could that be a key factor? I mean, how do you view that particular aspect, that US is not supporting the economy per se this time?
See, I think that if the base case is starting to be that US goes into a deep recession, I think no one will be really immune, right? The whole world will actually be impacted by that. So I wouldn't say that that's our base case expectation. Right?
Okay.
A shallow recession actually might even be good, and as long as that might even spur more embrace of offshore. So let's see how that works out. And I think we talked about the GCC trend as well, right? I think the GCCs, especially this new wave that got set up in 2015 onwards, they've never really had to deal with an extended pressure on spending. And I think this will be interesting. Maybe we might see some of them being monetized, just like after the GFC, we saw a lot of the GCCs back then getting sold to vendors. So it will be an interesting time, I think, next year.
Okay. Oh, that's something to watch out for sure, if such transactions were to happen. Okay. The other aspect, Ravi, is, and I don't know what extent of coverage do you have on ER&D, but I'm guessing it's large there, because EU auto or European auto seems to be hurting real bad, right? Maybe US auto too, but EU for sure, which is where I believe some of the ER&D players have a sizable presence. Does that spell issues for the Indian ER&D companies? Or do you think the price correction in the recent past kind of bakes some of those challenges in?
So actually, there is a good question on this. And, LTTS is one of the ER&D firms that I cover. So that's the one ER&D firm that I cover right now. So we think that we had a double upgrade on that. For a long time, the valuations were a worry. That had corrected. So just very recently, we did a double upgrade from underperform to outperform, because we thought they have very limited exposure to the German auto names. They have much more based set of verticals. Some of this might even benefit them, like the plant engineering segment, for example. If people are looking at brownfield expansions in the developed world, that actually leads to new contracts for these guys. So I think that's one name that I would look at, as potentially even benefiting from the current situation.
What would be your top call or your favorite in relative terms out of the big four, Ravi?
So our top pick is TCS. We're expecting that margin expansion should come through this year. I was actually honestly a bit surprised by how much employee costs went up this quarter. And I think a good explanation for that could be significant lateral hiring. And that means that could be deployed fairly quickly. So I think we might see a revenue surprise and a margin surprise for TCS over the first half.
All right. Thank you so much, Ravi. Ravi Menon there saying that perhaps things are not as bleak as they seem. TCS continues to be the top pick. LTTS and LTI Mindtree also on the radar. We'll take a very short break, but we'll be back in just a minute. We look at the markets, we look at all the top buzzing stocks today, and we also have this interesting conversation lined up with Vikas Prasad, Portfolio Manager at M&G Investment. Stay tuned.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
The second buy pick is in Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
The first stock on the list is it's IGL now. If you see the stock that has perked up around 4% in trade, and this is largely on the back of the buzz that is on the street, that the company might announce a price hike of anywhere between 3 to 4 rupees from the 1st of April. Now this might as well happen in phases, so keep an eye out for IGL. Now this stock had to, the company had in fact had to take a price hike post the Delhi election because the cost of gas had increased for them, and because of that the margins had come down, but they had not taken any price hike so far. So the street is expecting a price hike announcement to come in, which will be effective from the 1st of April, and it could be around 3 to 4 rupees, and it could well be implemented in phases. So keep an eye out for IGL.
Do you really know the company you invest in? What is the real picture?
Back with India Market Open right here on NDTV Profit. Pull up the Nifty once just to show you how we are behaving in the first 1 hour or 50 minutes of trade. Important to do that. I mean, individual stocks are doing well, and 0.22% for the Nifty. The surprise element, of course, is eternal. Everybody believed, and rightly so, that Zomato or Eternal will crack post this thing, and all that Zomato has done or Eternal has done is inch higher. Very, very interesting. But I'll tell you what's playing on expected lines, and that is IndusInd Bank. That stock is in focus, of course, after the board appointed EY to carry out a second forensic audit to investigate for fraud. Harsh joins in with some highlights on this. Harsh.
Well, yes, as per news reports, EY has been appointed as to conduct a second forensic audit on IndusInd Bank. Well, EY is going to, as per reports again, EY is going to investigate a 600 crore discrepancy related to accrual of interest in the microfinance portfolio. This is purely relating to FY25 discrepancy and likely a Q2 or Q3 discrepancy in FY25, and therefore this doesn't relate to past periods. But the amount nonetheless is decently large. It's 1% roughly of IndusInd Bank's net worth, Mind you, they've already taken a hit of around 2.27% on the net worth, given the 1580 crore post-tax hit that they have taken from their derivatives portfolio discrepancy. Now this is the other one. EY is also going to check for lapses and fix accountability as part of whatever reports are suggesting, and reports also suggest that it's not an issue which spans multiple years, and they're also going to investigate fraud if any. On the back of that, of course, stock reaction in front of you.
An issue which spans, it's not an issue which spans multiple years. What does that mean? I mean, how do you have a 600 crore hole in your microfinance book after a problem with your derivatives book in any case? So, which is why you're seeing that 3.5% downer on IndusInd Bank. But Harsh, financials are in focus. IndusInd Bank is one side of the story, but financials is in focus because of what the RBI has done, isn't it?
Well, yes, absolutely. And, you know, the key positive here is that RBI is doing all it can to improve the liquidity in the system. Now, in terms of what views from the analyst community is coming through with regard to the revised LCR norms, and this is obviously a very key positive. Morgan Stanley, first off, they believe that the norms itself should aid loan growth by 1 to 2% within the system. Now, this is significant because loan growth is slowing, and this will, of course, help loan growth going forward. There's also expected to be some amount of margin accretion as a result of the freed up liquidity. 2 to 4 basis points within the system. Margins will go up. Of course, will be different for different players. Likely beneficiaries will be some of the larger banks. That's what analysts seem to be suggesting, not Morgan Stanley. This is what analysts seem to be suggesting. Now, third, is that Morgan Stanley believes that some benefits will percolate in FY26, so will be upfronted, and then most of them from FY27, because this is effective only from 1st April 2027. Macquarie also very similar views. 140 to 160 basis points improvement with regard to loan growth is what they believe this will lead to. They're expecting around 2.5 to 3 lakh crore rupees freed up in terms of system liquidity, which is again significant because liquidity has been so crunched over the last at least year or so. And they also welcome these kind of moves within the current environment, especially given the likelihood of a weaker loan growth. So they believe that this will obviously aid the loan growth number, which is a positive. CLSA also, they've increased the system-wide liquidity by 2.5 lakh crore. As per their estimates, that's what this will impact. In terms of PAT, they don't believe there'll be a significant impact, but sentimentally will be extremely positive as per CLSA. So CLSA not really building a PAT impact as a result of this, but Morgan Stanley and Macquarie building both a profitability impact as well as a growth impact as a result of all of this. Clearly positive with regard to where banks is concerned.
Okay. Thanks for that. And you know, that's been the big talking point for India markets, right? That the RBI has done all that it can and more to rev up the animal spirits. Vikas Prasad, portfolio manager at MNG Investments, joined right now. And from where he's perched, Vikas, good to know whether you're in Singapore or New York, but from wherever you might be, I'm presuming it's Singapore. The FII mind in you, how has it looked at all the recent developments in India when the valuations were lower, but the Reserve Bank of India did all that it could to shore up confidence?
Well, what a difference a year makes when it comes to liquidity and the tightness around the financial system. What has not changed in the past year is our constructive view on India. When I was speaking with you last time, a few weeks ago, one thing I had mentioned is that we remain fully deployed in our India strategy, but as a firm, we were looking to increase our exposure to India and have that converge with the exposures that we've had in other parts of Asia, in North Asia in particular, and we have indeed done that. Late February was a great opportunity for us to increase our India allocations. We continued that in early March. We continue to do that even now, and it's across sectors. The financial sectors, especially the private banks and NBFCs, is one area where we've been very active this year. And increasing our holdings. But there's a lot to like in India. That has not changed. If anything, I'm surprised by the pace of the rebound just over the last couple of weeks, given the uncertainties that we have. But you always have to ask yourself, what is in the price? And at the end of February, a lot of bad news was in the price after the 5-month-long sell-off that we had. Long term, nothing has changed for our view, whether it's small caps, large caps, financials. If there are certain areas where we are still cautious, even though they have underperformed, it's the IT services names. But again, we're reevaluating that call given the underperformance that we've had, the earnings season that we've seen. And when you look at how IT services reacted post-earnings, and how the private banks reacted after very strong earnings, it gives you a signal of what is in the price, given how they've moved since then.
Vikas, hi, good morning. Tamanna here. The point you make about what is in the price, what do you think is in the price right now when we're seeing the rebound? And I'm asking this in the context of the concerns that we were talking about just a few weeks ago. One of them was the quality of corporate results. That's yet to play out, decent lot from a couple of banks, IT largely disappointing, and we have to see how that goes. What's in the price if we have an economic slowdown fears. I'm just wondering if anything has fundamentally changed from the concerns we were all talking about a few weeks ago as well.
Overall, in India, I don't think that's the case. If you look at our time horizon, which is 2, 3, 4 years out, if you look at it sector by sector, yes, certain things have changed. There is more uncertainty in the automotive space and in auto parts, auto ancillaries, where we've been active. Last time I was on, Amin was on from JP Morgan as well. We had a good three-way conversation about that. And for IT services also, the outlook has gotten a little bit cloudier. But when you look at the performance, they have fallen quite a bit. So we have taken advantage of some of these falls to add back some exposure at the margin to both of these sectors. If you look at other sectors like consumer staples, the picture is more mixed, and I don't think that anything really has changed. The other difference between the end of 2024 and the beginning of this year is the increased exposure that we have had to healthcare services. We've switched some pharma exposure to healthcare services, diagnostics, hospitals, large cap, small cap as well. And then also we've been on the lookout for entirely domestic stories that are not contingent on the new policies coming out of Washington or Beijing or Tokyo. And there's plenty of choices in a market like India. Music streaming is one area that we're excited about, so we have exposure there. When I look at the market today and the opportunities we have on offer, the only thing that is scant, where the pipelines are thinner or less full than they were a few months ago, is in the ECM area, in the IPO arena. We think that will probably pick up as the markets have started to come back, but we continue to be very selective in what we spend our time on when it comes to new companies, especially in this environment where we're seeing disconnects and dislocations among names that we know.
So rightly, put Vikas, the IPO streamline has dried up a fair bit. But did I hear you saying that you are adding on IT on the margins now?
Yes, we have, because of the magnitudes of the falls, and we remain underweight the sector, and the name count that we have in that sector is very low. It's the lowest it's been in years, actually, since just before COVID. But when we look prospectively and we look at the valuations and we look at the magnitudes of some of these falls, then yes, we've started to reduce that underweight, but not materially so. If IT had been the only sector that had been underperforming to this extent, then it would be different. We'd probably be adding more. But given the sell-offs that we've seen across a broad array of companies, small caps to large caps, we've added back a little bit less.
And you're favoring your smaller cap or mid cap IT players or the larger ones?
For now, the smaller companies, because we've seen even larger disconnects. We haven't seen all the earnings from all of them yet, but we have seen from the larger ones, and they've not been so exciting.
In terms of just following up on the point you made, the hunt for domestic-facing companies, and interesting to hear about a streaming app there on your list. But what would be the spaces that you see of safety when you're seeing global turbulence, where domestic companies or domestic-facing companies would come in? Would financials, for example, make that list?
Financials do make that list, and BFCs make that list. Pan-India, so not just the ones focused on North India or in Bombay, but we have exposure to NBFCs in Southern India as well as South-based companies. What we don't have exposure to directly, for sure, is microfinance. There might be some of the larger private financials that we own that have some exposure, but you were talking about that just before I came on. Microfinance is tricky, so we don't have exposure there. But overall, I would say if we take a step back first and then we get into the sectors, India overall is relatively safer than other countries, and which is why we have increased our allocation across the firm to India. If you look in March, now again, the starting point was lower for India because of the 5-month sell-off, and it had underperformed to start the year, but it was the best performing market in the region. And post-Liberation Day, it was the first market to erase those losses, and we continue to grind higher, 10% or so, just over the last 10 trading days in India. I'll share a stat. More than 70% of India's revenues for the NSE 200 come from within India, and that number is growing. If you look at the US, less than 60% of S&P 500 revenues are from within the US, and that number is falling. So when you look at India, it is a largely domestic story. There's a lot of companies to look at. It's a very broad and deep market. And so we're spoiled for choice on our time horizon. Now, if I were trying to outperform the market today, tomorrow, over the next month, it would be trickier. But we see a lot of businesses that we want to own that represent where India is going. And we want to be part of that on a 3-5 year horizon.
Because the piece on MFI is interesting, right? Because it's split right down the middle. There are people who are betting on this being the turn of the cycle. There are people who are saying that the pain is so large, and there will be some more washouts that will come in from states, etc., which are, now giving out dole-outs. That it will be persistent and not a cyclical upturn. Which way are you veering on? I'm guessing you are veering towards the cyclical uptick, maybe. If so, why?
Well, we by design have no direct MFI exposure in our portfolios.
Okay.
We have in the past, and we thought that this is not an area where we can have a sustainable edge, was my view. So we don't have that exposure anymore. We keep an eye on it. It's not just about the valuations. Optically, in this sector, valuations have been low for several years now, but the names continue to underperform. It is just the nature of the business. It serves a very good purpose, but there's a difference between the purpose and having a good business delivering that purpose. And what we see is there are plenty of other choices elsewhere. And so we direct our capital to other names within the financial services sector.
Got it. Because one macro question on the markets, at least. When the markets were correcting, everybody made this point about why is it that India can trade only at average multiples? Why can't it go below the multiples? So why 18 times? Why can't it be 17 times or 16 times when earnings growth is not there? Now, when the markets have shifted, the narrative has also become that it was fairly cheap for a market which is looking good in an otherwise slightly dull world, and therefore go out and buy it. So my question to you is it possible that even if earnings growth stays sluggish and not 15-16% but 12% for FY26, the multiples may still be higher because India might still be better off than a lot of other markets at a point of time when money is probably moving out of the US, and a small pile out of that deluge would be good enough to take Indian market multiples higher. So can India trade at higher multiples despite earnings growth being slow?
That's fair. I would say it can and it should, because if you look at the long-term earnings growth, that remains intact, whether it's a 6 to 12 month relative slowdown or a deceleration relative to expectations, that's a different question. And that's what was priced in the sell-off from the end of September until the end of February. And the growth expectations have returned a little bit. Also, what we've seen is India has become more appealing relative to other markets. The price of oil is behaving when it comes to India. The price of the rupee against the dollar also behaving. That is helpful. And you have largely intact growth stories. Even if the overall aggregate market growth, earnings growth, falls from 15 to 12%, within that you have 6,000 plus listed companies. You have over 1,500 that have a market cap over $100 million US dollars. It's not difficult to find sectors within the overall market that are growing faster than the market, and then within those sectors, if you do your homework, you can find the relative winners as well. India remains a very good market for long-term absolute equity return appreciation or equity appreciation, but it remains a great market for active managers as well for relative stock picking.
Vikas, I'm just wondering how you're feeling about gold right now, because even as we're speaking about equity, it's all about gold across the board. How are you, organizing this into your investment plan or looking at the gold factor? Do you think that we're going to see a further upside continuing?
I would assume that in this environment of uncertainty, and we don't really have any macro views on gold other than that it's understandable that the price keeps going higher. We don't really express that in the portfolio directly. There are companies that make gold loans. Some of the larger financial institutions are now increasing the attention that they pay to this. The short answer from my view is I'm not surprised that the price of gold is going higher. I would also not be surprised if it continues to go higher. But it's difficult to implement that view in the way we invest in our portfolio.
Truly, truly it is. Thank you so much.
I will say,
yes.
personally, I'm a gold bug. So we own gold, and I am a fan. There's an article recently that I read about all the new gold bugs in Asia. So I get it. It's a fair question.
No, I think the gold bugs, at least in India, are very old ones. They're all the.
Well, I'm getting to be one of the old ones too now.
Yeah, and they're all the Indian women who have turned out to be the most astute investors. Thank you so much, Vikas, for speaking with us. Always a pleasure. Always a pleasure having you on. That was Vikas Prashad. Then, yeah, a gold bug. That's an interesting term. I think we're all turning into those.
Yep.
Yep. Everyone's got it. Markets are holding on though. 24,190 now, middling away, 0.25% up. I think holding on right now is fair enough in this market. The Nifty IT though, the one with a bit of pain ahead of the HCL Tech numbers, you're seeing a bit of a reality check perhaps dawning that all is not going to be well with the IT pack, at least for a while. Nifty Bank is what is moving the markets up once again. It's come off that very heady and giddy up moves, but doing okay. I want to pull up the mid cap and small cap just for a second before we get to some of the counters that are buzzing this morning in trade as well. Mid cap is improved actually, about nearly 1% up in trade right now, and you're seeing the small cap also mirroring that kind of a chart pattern since they've opened up in the morning. So some strength coming in the broader indices. Should we just quickly pull up the advanced decline ratio before we get to our next story and get a sense of where the broader markets are? And yes, it's definitely a positive advanced decline ratio that we're seeing right now. Okay, let's take a stock of buzzing counters, and Varsha's joining us to talk about Raj Ratan Global. Varsha, what does this company do? Why is it at a 20% circuit?
So thank you for that. So they've come out with their Q4 FY25 numbers. So basically company makes bead wire which are used in your tires. So their Q4 FY25 numbers, if you see, inline set of numbers, I would say good numbers when it comes to quarter on quarter, but yes, still there's still margin pressure when it comes to year on year. There was a volume growth of 6%, which is a good thing, but this was offset by price decline of almost 1% year on year. For India business, they had a volume growth of 17%, but for Thailand business, they have a negative volume growth of 8%. Their EBITDA per ton for India, if you see, was up almost 37%, but overall on the consolidated operations, the EBITDA per ton was down 34% quarter on quarter. If you see, they have also approved conversion of existing black wire capacity of 12,000 tons per annum at Pithampur into wire one rope capacity of 10,000 tons per annum. Now this move will actually improve their unit economics and aid overall profitability as per the management, and this capex that they are doing will be funded by a mix of internal accrual and debt. So overall, good set of numbers quarter on quarter, but yes, margin pressure when it comes to year on year.
Okay, so well, one reason or a slew of reasons why the stock would be 20% higher in trade. I tell you though, not everybody has that luck, and the auto sector certainly doesn't have that luck, but it is in focus after Jefferies has given a bearish note on the auto sector. They've cut targets for major auto players as well. Puneet Johnson with more on that report. So from the bull to the bear, Puneet, tell us, what does Jefferies have to say?
I'll try and find some bull cases here as well, because we're seeing this note specifically on the two-wheeler space, downgrades on Bajaj Auto as well as Hero MotoCorp, and it's a trend that was largely based on the sales from December onwards visible in those numbers as well. So Jefferies downgrades Bajaj Auto to a hold from a buy rating earlier. Target price is now 7,500 versus 10,550 earlier. For Hero MotoCorp, the target price has been, it's been downgraded to an underperform rating from a buy earlier. Target price has been cut to 3,200 from over 5,000 rupees earlier. So two big downgrades here, maintaining buy on Eicher Motors as well as TVS in this particular note. Now, three key points that this note says specifically. They are saying that they are cutting two-wheeler industry growth volumes by 6 percentage points in FY26 and 2 percentage points in FY27, while largely seeing a healthy 10% CAGR over FY25 and 28, and that's seen in the premium category as well as for someone like Eicher as well as TVS. The second point that they're making is that the competitive landscape has effectively changed very meaningfully and significantly, with TVS and its domestic market share now at a 18-year high, while for someone like a Hero, their market share in the domestic two-wheeler space is the 20-year low. And hence they are downgrading Hero in this particular note. They've also mentioned that while they're cutting EPS targets by 5 to 11% for something like a Bajaj as well as Hero MotoCorp, they are seeing just some slight pressure for TVS as well, just by 2 to 3 percentage points, but very bullish on Eicher as well. And the target price is high to 6,700 for Eicher Motors. So TVS as well as Eicher gets the big thumbs up from Jefferies, while Bajaj and Hero are downgraded going forward as well.
Okay, thank you for that, Puneet. Auto middling over there, IT is sulking. It's the banks that are holding up the markets. That's pretty much all the time we have on this edition of India Market Open. But watch out for the afternoon sessions, which from the last few trading sessions, it's where all the action starts up.
And thus far positive.
Thus far positive. That's the important one. But that's all the time from Neeraj, me and the team that put the show together. Stay tuned. Ask Profit up next.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
The second buy pick is a Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
To India specifically, I really think India has a fascinating opportunity, because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
The first stock on the list is it's IGL now. If you see the stock that has perked up around 4% in trade, and this is largely on the back of the buzz that is on the street, that the company might announce a price hike of anywhere between 3 to 4 rupees from the 1st of April. Now this might as well happen in phases, so keep an eye out for IGL. Now this stock had to, the company had, in fact had to take a price hike post the Delhi election, because the cost of gas had increased for them, and because of that the margins had come down, but they had not taken any price hike so far. So the street is expecting a price hike announcement to come in, which will be effective from the 1st of April, and it could be around 3 to 4 rupees, and it could well be implemented in phases. So keep an eye out for IGL.
Do you really know the company you invest in? What is the real picture?
Hi, thanks so much for joining in. You're watching Ask Profit on NDTV Profit. My name is Alex Matthew, and this show gets you answers to all of your stock-related questions. Let me tell you how to get in touch with us. Of course, the numbers on your screen are what you should consider using. On the top of the screen, you'll see a number, and that is the WhatsApp number. You can send us your messages, or you can call us on the landline number that you see at the bottom, and we'd love to speak to you. So get your phones out and get to dialing. In the meanwhile, let me take you through how the markets are faring right now, and it's looking like a decent day in the context of what you've seen globally. Overnight, of course, you saw that the US equity markets declined yet again, 2% drop for the S&P 500, but you have gains of about 1/3% for the Nifty 50. The broader markets are looking even better. You have gains of about 1% or so for the mid-cap index, or 0.9% for the mid-cap index, about 1% for the small-cap index, and all told, it's looking like a pretty picture. Let's take a little bit of a deeper look, because you have had banks that have contributed to a large extent in the recent run-up for the Nifty 50 and indeed for the markets, and that continues to be the case today. In fact, building on that strength, apart from one or two names that are languishing, let's in fact pull up the list of stocks. You have something like a Canara Bank that is moving quite substantially today, gaining about 2.5% or so. HDFC Bank, what a run it has had in the recent past. I'm sure that a few of you will have questions about this bank as well. It's up about 2% or so. You have State Bank of India that is participating, gaining about 1% or so. ICICI Bank not doing too much. Of course, it was in the red, but it is gaining ground, about 1/3% or so as things stand right now. We are at record highs, or very close to that mark once again today. Yesterday we hit record highs for the first time in a long time, and today we are at fresh records for the Nifty Bank. IndusInd Bank, of course, losing ground, but it's recovering a tad bit. In fact, let's pull up the intraday chart for IndusInd Bank, because it was down over 4% at some point, but it is making a bit of a comeback as things stand right now. And of course, the update is that it is apparently, and this is according to reports, employing another audit firm, EY, this time to investigate certain discrepancies to the extent of 600 crore or thereabouts. And so that uncertainty that is swirling around this bank is proving to be a negative, at least in the near term, but a smart recovery for this counter as well in trade. A few other counters that you should watch out for, in fact, from the broader markets, these are all stocks that were doing reasonably well. I would like to pull up something like an HG Infra. It was up over 4% at one point, but it is cooled off a little bit, up about 2.3% or thereabouts. It has emerged as the lead bidder in a project in Gujarat, this Urja, for battery storage system, in fact, and so it's doing reasonably well. Himadri Specialty was another counter that is doing well, and this is on the back of earnings. I pulled this out as one of the stocks to watch. It has cooled off just a tad bit, and so watch out for that as well. Of course, margins have improved for this company in the fourth quarter, and it is also bolstering its capacity for carbon black. We'll talk about a lot more stocks, and I'm sure a lot of you have questions as well. Let me introduce our experts. We've got Swati Hodkar, who is AVP Technical Research at Nirmal Bang, and we'll soon be joined by Astha Jain, Senior Research Analyst at HEM Securities as well. Let me start with technical questions, though, some that have come through. And the first one that I'm taking, Swati. And Swati, first of all, thanks so much for joining me this morning. Rajesh from Bengaluru is asking about Central Bank, which Rajesh has acquired 5,500 shares of at an average price of 47 rupees. In this move up for banks as a whole, would you hold on, and what are the key levels to watch out for? Is there a possibility of recovery of buy price in the near term? What would you do with this, Swati? Would you hold or exit?
I think I will suggest to hold this particular counter, because already the stock is on the verge of showing some sort of a pullback rally, or say the reversal from the downside levels. Now, though the client has bought at a very elevated levels, but those are the likely targets which are we are likely to witness in the near-term futures. Up to 45, 46 rally can be witnessed. At the current levels, the support is placed at 35 levels. So I will not suggest to book the losses on a very deep at such levels, but try to keep the stop loss of 35 rupees and hold your long positions. If the stock manages to give the breakout of 45 to 45 levels, then upside rally can be seen on the higher towards 250 to 54 levels. But you should hold the long position on every rise. You should sell this particular counter nearby 45, 46 level so that your loss will not be faced as much. But you should hold this particular counter with the mentioned stop loss.
Okay. All right. And we've also been joined by Asta. Asta, thanks so much for joining in. We've got a caller, Dheeraj from Hyderabad, asking about Waaree Energy. And this is a counter that is in focus on the back of earnings as well. Let's see what it's doing today. It's up about 6% today as well. And it has gained quite considerably in the recent past. He's bought at levels of 2,480. Dheeraj, very good morning to you. How can we help you today?
Good morning, sir. I'm holding Waaree Energy
Yes.
at 2480.
Okay.
So today are the company's earnings actually.
Yes.
They declare their quarterly earnings.
Yes.
So can I hold it for some more time or should I exit in the rallies is my query regarding the technical.
Yeah. It's a good question. Okay, so regarding technicals, okay. So Swati, I'm coming back to you. Of course, Waaree Renewables was in focus earlier last week on account of results, and Waaree Energy also gaining ahead of its earnings. Would you book at this stage or would you hold on?
Since today we have a result, so the volatile trading session is likely to be continued. But looking towards momentum, the counter is already 6.5% to 7% on the upside. I believe at least partial profit should be booked at the current market price, though the upside is very open for this particular counter. Nearby 2650, 2670 levels can be seen on the intraday basis as well. But at the current level, you should book your partial profits so that your half a profit will get in pocketed. And for the second half, you can hold on this particular counter with a trailing stop loss of 2500 rupees on the downside. For immediate target will be 2670 and 2700 levels on the high side.
Okay, all right. So that's a view on Waaree Energies. Let's talk about the next question, and it is for you, Asta. On the long-term basis, Bharat Dynamics is the name of the counter, and we've got Major Suresh Kumar Nair, who's got this question. Evidently, from his description, he knows what he's talking about when he's invested in the defense space, and indeed, he's making money on this as well. He's got a long-term view that he's seeking on Bharat Dynamics. He's bought at levels of 1,233, and he's holding 600 shares. He purchased in March, and this is, I guess, when the stocks were under a little bit of pressure. What's the view on the long-term basis? Because especially in the context of a reiteration by the defense minister of a 50,000 crore target in the next few years for exports. So we're talking about firing on both cylinders, domestic demand, of course, for defense, but on the export front as well.
Right. So regarding export, I would like to throw one point here is that they are having the estimated order book of around 200 billion, out of which export order book is at around 20 billion, right? So strong order book they are having. And what we are believing that in the results coming, we can see the surge in the EBITDA margin because of the niche technology on which they are working. So looking after all these factors, in fact, their Q3 performance was also on average mark. So looking together after all these points, I think, yes, it is a story to believe on for a long term. And I would like to recommend stay on for this counter. Initial price target can be set at somewhere around 1600 to 1700 odd levels.
1700. Hold on, Major, is the question. Is the view on Bharat Dynamics, and congratulations on having acquired it when you did. The next question is on Anant Raj, and Harsh Bhutra from Chennai is asking. He's bought at levels of 500. By the way, the earnings came through, and quite a bit of those gains, in fact, taking place today itself. So he's gone above his buy price today. I will remind you of the earnings. The margins have improved in the quarter gone by. They've come in at 26.3 versus 23.6, and there's an improvement to the extent of 51% in the net profit as well, and that is coming at 119 crore. The revenues increased by as much as 22.2%. So all told, a decent set of numbers. Would you hold on is the question. Asta, on the fundamentals, what's the view?
Yes, we have seen a very, very strong performance on this counter, especially in the time when we were quite skeptical about the data centers, etc., when the news broke few months back regarding the data centers. So I think that has a bad implication on the stock prices, and we have seen the stock prices nose diving towards southward directions. But now, what I believe is that with the kind of results which we have witnessed, they have seen a surge in their pre-sales as well. I think this stock is well poised to show more upside from here. Only the point is that it has already risen 12% in the last 1 week. But what we have seen is that the 40% fall from its peak prices. So definitely there's a scope for more upside from here. Our idea here is to stay invested in this counter with the initial price target of around 600.
Okay, all right. We've got a next caller. Okay, so that's the view on Anantraj. Hold is a view from Asta. Ram is calling us from Hyderabad on a stock that is in focus today, but has given up some of its ground. It's up only about 0.5%. In focus, of course, because of the safeguard duties that were announced, 12% for steel companies. Ram, good morning. Thanks so much for calling. How can we help you today?
Morning, Alex. I bought this Tata Steel based on the news today.
Yeah.
So I was expecting at least 5% increase in the stock price, but it's not moving. That's why.
Yeah. So you bought it for a short-term trade, is it?
Yes.
Okay, got it. Ram, I will also draw your attention to the fact that some of these steel companies and metal companies have moved up very substantially in the recent past. And so maybe to a certain extent, one would say that that was already priced in. Remember, this is an announcement that came a little while back. This is the official notification. So let me get your question answered by Swati in any case. Swati, is it a case of a very sharp run up in these metal counters and now some of that steam is being let out? The potential upside from this stage is not very high. And would you suggest getting out before you see further drawdowns?
Yes, you have rightly pointed out that this news has already got discounted in the price because we have seen a very strong rally from almost 126 to 142 levels. Now the stock is just facing a very strong resistance of the short-term moving average, which comes to nearby 20-day DMA 140 to 145 levels. Today also on intraday basis, we have seen a 142 high, and thereafter we are witnessing some sort of a selling pressure or say the profit bookings at the resistance level. Since the view holding period is only for the short-term period of time, I will suggest to maintain the strict stop loss of a 137 levels on the downside. If it's break that level, then we are likely to witness some sort of a more selling pressure into this particular counter. Any move above 145 levels only will witness some sort of a fresh buying into this particular counter, and the target will be reach up to 155 levels. But since the overall short-term period he is looking for, I will suggest to keep a strict stop loss for 137 rupees.
Okay, all right. So that's the view on Tata Steel, and in fact the steel counters by and large are giving up. I'm just curious about SAIL. Let's pull up SAIL and see whether it's moving at all, because when the announcement was made, it was viewed as one of the big beneficiaries. And we spoke with a steel analyst earlier today, or metal analyst, and what he was pointing out is that the companies that focus primarily on flat rolled steel are likely to benefit more, something like a Tata Steel, something like a JSW Steel, but as we've pointed out, it is likely priced in already. But let's talk about the next question. We've got Prashant tuning in from Bengaluru asking about Mangalore Chemical and Fertilizer. Is this a good time to enter, and what are the targets? Since he's not specified a time frame, let me go across to you, Asta. And once again, I think we're drawing attention to the chemicals and fertilizer stocks. Some of them have started moving. The question is, while we're not likely to see tremendous increase in volume, we are seeing some improvements trickling in on the operational metrics, right? So they're changing their mixes. They're trying to improve on margins and operational efficiencies. Would you hold on? Would you buy into Mangalore Chemical? What's the view?
So first of all, I would like to say that Mangalore Chemical results were on the decent side when we have seen them in the Q3 FY25. I mean, Q3 FY25 numbers were on the decent side. They have shown 21% rise in the profit. Now, the results date has not been announced as of now. So we are not aware when the results will gonna come. But yes, we are positive on the space as a whole. And yes, we can see some more upside in the margins in the space as a whole, because I think whatever going on at the macro level or at the global level definitely will help these chemical companies to show an outperformance. So definitely we are positive on this counter. The only thing is that we really need to closely watch when the results will come. Otherwise, our idea here is to stay invested in this counter with an issue price target of around 225.
25. But let me just prompt you and maybe give me a quick answer on this one, Asta. Based on the information that you have available right now, what would your top pick in the broader chemical space be?
Navin Fluorine is our top pick. Undoubtedly, we find that counter to be very, very strong. So yes, Navin Fluorine is something which is looking very promising to us, followed by SRF. So I mean, these are two counters in the chemical space we are positive on. But yes, we are positive on the fertilizer space also, although it is not related to chemical, but yes, we can say.
Yeah.
So their Chambal fertilizer is looking good to us. And one more point I would like to make, Alex, in the previous question, the viewer was asking that why the Tata Steel is not rising so much.
Yeah.
Because I think the expectation of these duty hikes were more. So it was around 20 to 25%, which these companies are demanding. Against them, they have got only 10 to 12%. So I think that expectation of hike was more. And in that case, the result or the outcome is not that very high. So that can be one of the reasons that why we are not seeing these stocks to be so much excited by this news.
Got it. Okay. All right. So, and thanks for that clarification, by the way. Do bear in mind that Asta just given you her view on both chemicals as well as on steel companies, speaking about why they have not reacted maybe as much as some had anticipated. Hari is calling us from Chennai to ask about Tata Consultancy Services. Hari, very good morning to you. You're holding at a price of 3,920. Can you help me understand what the thesis was when you bought and what was the time frame that you had in mind?
Hi Alex, good morning. It's nice talking to you. Alex, in the IT pack, I saw TCS and the Infi are the bigger ones. I have holdings in both Infi and TCS, and I'm looking at a long-term perspective, maybe 3 to 4 years or something. Now my question here is, I bought it around 52 weeks high, and I bought on all dips kind of. So my average is around 3,900.
Yeah.
So I'm not going to sell the stock. I just want to hold it. Maybe at current phase, I'm looking for 4 to 5 years of holding. But my question is whether I can accumulate at this level. The reason I'm asking is overall the IT pack is not doing good, and there are a lot of news coming from US.
Yes.
Can we take advantage of this, or maybe it's whether I need to wait for some more time to see how things are settling down?
Yeah, that's a fair point. And you've got both TCS and Infi. Let me go across to Asta. Asta, of course, at this juncture when the entire pack is going through this elevated level of uncertainty, of course, existential questions also start getting asked. In fact, I will draw your attention, everybody, to a show that my colleague Tamanna did yesterday, and the question she was asking was whether or not a pivot is necessary for IT companies to really move out of this logjam that they're facing. And I think she was speaking to Mr. C.P. Gurnani, who said that this is a cold that the industry is going through and not typhoid, and so they're going to be able to get past it relatively quickly. I will encourage you to watch that. It's the big question. It's available on YouTube. But what's the view, Asta? Would you hold on to TCS and Infi?
Yes, I would like to say that one can remain invested in this counter. Now, talking about TCS in particular, there were 2-3 points. First of all, international business grew of around 0.6%. Secondly, strong deal bookings they have witnessed of around 12.2 billion, which is again up as compared to last year. Thirdly, no major project cancellations. Fourthly, they are moving towards Gen AI projects, etc. So, I mean, these things, I have taken these things all from the management commentary, but I'm finding them optimistic. But right now, the kind of scenario is such that some uncertainty lies. So, idea here is just to hold on, but to accumulate at this point of time, I say no. I think we can see some more downfall from here, especially in the case of TCS. So the chances of accumulation one will definitely get, but at the lower prices. not at the present moment of time. Even Swati can just confirm that thing if I'm wrong, because I think this stock can fall down more. So accumulation definitely can be done in this counter. After all, it is a leader. So no worries on that part in the longer term, but in the shorter term, it can witness more downfall. So yes, you can accumulate this counter, but not at the current level, maybe at the lower levels, which Swati can tell better.
Yeah. Let me go across, and it's a good point to make, Asta and Swati. Yesterday, everybody was a little flummoxed, if you can call it that. We were certainly scratching our heads, wondering why the IT pack on the back of Infi results, Tata Elxsi gaining as much as 9% after what was a pretty weak set of numbers, and we saw the delivery stats. Right, it's not like there was tremendous delivery buying. If I remember correctly, it was only double digits, and that too maybe even teens, 11%, 12% or so for Tata Elxsi. So short covering evident. What are the near-term triggers and what are the levels to watch out for TCS Infi?
Yes, for the TCS, definitely, this is also the right point to take long positions for a long-term horizon purpose, because daily charts suggest a positive divergence, and we have seen that the stock has managed to maintain the 3,000 levels, which has been tested in the 2024 level. So that level has been tested, and from there onwards, we have seen a very good bounce back rally, minimum towards 220 DMA. So I believe, yes, if you're looking for a longer-term horizon, at least for 3 to 4 years time period, then one should take a long positions at the current market price, not more than 20-30%. If you're getting any dips to back towards to the 3,000 and levels, so then you can add on. So the overall setup has been, just as of now, we are witnessing a time correction into these particular counters. Over a period of time, I'm looking for a target of 3,700 to 3,800 levels in the TCS. So this will also be the right levels to take a long positions, not more than 20-30%. On the Infosys as such, I can say that you should wait for this particular counter, because as of now, the bottom is not finding out in this particular charts or weekly or the monthly as such. If you're getting any dips towards to 1,300 and so levels, so that at that point of time, the risk reward ratio will be literally favorable. So I will not suggest to take a long position into the Infosys at the current market price, but any dip towards to 1,200 levels, that can really act as a very strong buying point levels. And for an upside, we are looking for a bounce back rally towards to 1,600 to 1,650 levels. So those are the targets we are looking for, a medium to short-term PTR answer into both the counters.
Okay, so comprehensive view on the large cap IT space. And remember, this is a pack that is going to remain in focus because you have mid cap IT that's going to be reporting its numbers. Quite a few of those stocks going to be in focus together. I think 5 companies on one day, if I'm not mistaken. All right, we'll keep a watch on that. Rajesh Maheshwari has got the next question. He's writing in from Indore. Rajesh, you're back from Singapore, seemingly, and asking about Globus Spirit. He's got 125 shares at an average price of 1,197, and it's a long-term holding. What is the short to medium-term outlook on the stock, and what is the most prudent course of action? And he's wondering from a strategy point of view, Asta, on the fundamentals, would you hold on to Globus Spirit?
See, short to medium term outlook is not so positive unless I don't see the results, because what happened in the previous results, there was a loss. If I take all the other income and extraordinary items, then it seems to be a loss in the bottom line. So that markets never like. So my outlook really depends on now the results which this company will be giving, because I'm not aware. I think they have not given their Q4 earnings as of now. So just wait for those numbers to come in and then make any sort of strategy in this counter. Meanwhile, one can remain holding this counter. This is what we are suggesting right now.
Okay. All right. So that's the view on Globus Spirit. We've got our next caller, Deep, who's calling us from Kolkata. Deep, thanks so much for calling. I believe your question is on Dixon Tech. What do you want to know?
Yeah, actually, good morning. And
good morning.
I bought five stocks a week back, and I'm planning for a short-term hold. So is this the right time to sell it off, or should I wait for some time more?
Wow, what an acquisition price. I must congratulate you. You've made quite the acquisition. And did you have something in mind in terms of target or what?
Yeah, actually, since it went up higher in the previous years, previous time also, so I thought maybe 18,000 would be a good level to sell off. But right now, since the markets are so high, I'm kind of in a panic mode if I should sell it right now or wait for a bit longer.
Yeah, I mean, it's better to it's a good problem to have. You're in the green, you're making a profit, and you're wondering whether to take some money off the table. Okay, so Swati, it's better than wondering how to curtail your losses. Would you take money off the table right now?
First of all, congratulations, Dips. You have bought at the exact support levels. So that's why you are enjoying a very good handsome money. Definitely, you should at least book your partial profits, because within a span of a 7 to 8 trading session, you have seen a very good amount of profits. So partial profits are recommended at the current market price. Second partial, you can hold on. 16,000 will be the first psychological support level. So by keeping that as a second stop loss, profit stop loss, you can carry the long positions. I believe the stock has a potential to reach up to 17,400. That is the likely target we're likely to see in the next week. So at the current market price, book the partial profit. Second partial, you can hold on with a stop loss of 1,600 for a upside target of 17,400.
Okay, all right. So there you go. It's not an 18,000 target on Dixon Tech, but well, it's upside potential nonetheless. It's up and about in trade today, 5%, quite the pop. Hopefully that answers your question. By the way, on the other side of this very quick break, we've got a very interesting question from Santosh. He's got BLS International shares at an average price of 0 rupees. We'll talk about how that is on the other side of the break. Do stay tuned.
That's huge. That is a biggie. It's on.
गोल्ड ग्लास क्लियर ग्लास, कार हो या नियर, सब कुछ दिखे क्लियर।
The second buyback is a Naukri info edge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
To India specifically, I really think India has a fascinating opportunity, because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know.
Hi, welcome back. You're watching Ask Profit, and this is a show that gets you answers to all of your stock-related questions. I told you there was an interesting question that came through from Santosh, and he's writing in from Chennai. His acquisition cost for BLS International is 0, and it's actually not very complicated. Ultimately, he's gotten 20 shares. He got a couple of bonus share issues, and ultimately, as a result of those bonus share issues, it went up to from 20 to 80. He sold 60 shares, so the original 20 remained, and he has basically recovered his acquisition cost. So acquisition cost has dropped to 0. Profits are 8,000 rupees. He's asking about the future prospects. Should he hold or sell for the long term? Asta, what's the view on BLS International?
So yes, hold, definitely hold, because first of all, results they have posted exceptionally well. Their visa and consular segment is really performing well, and in fact, with the kind of acquisitions they have done, balance sheet is also is in a very strong shape right now, nice shape I should say. So there is no reason to get out from this counter. And what we have seen that this company is performing exceptionally well, especially when the transition happened from the partner-run model to self-run or self-managed model. So that transition really helped the company in posting good set of numbers along with the kind of acquisitions they are continuously doing. And yes, this company has announced bonus twice, I think one in 2017 and another in 2022. So in that way, definitely the cost price comes to almost nil. But idea here is to stay invested in this kind of a stock with a price target of around 500 at the initial levels.
Okay, all right. So 500 should be your target on the initial levels. BLS International is a hold, according to Asta, based on the fundamentals. Let's take the next caller. We've got Shankar calling us from Bengaluru. Hi, Shankar. Good morning. How can we help you today?
Hi, sir. Good morning, sir.
Yes. Good morning. Please go ahead.
Stock name Unominda. Stock 150 stock. Average price 890. Profit 2000. Hold or sell, sir?
I got your question very clear. Thanks, Shankar, for getting us that or for asking that question. Unominda from the auto ancillary space, and Asta, really the question is whether your view on the automotive suppliers is positive or not. Unominda, one of them, bought at levels of 890. Would you hold for the long term?
Yes, I would like to recommend a hold on this counter, although I know the kind of uncertainties which are prevailing in the market regarding automobile industry as well. But this counter is something which is, I believe, can show and can come out of all these and can show very strong performance going ahead. Now, talking about the fundamentals of this counter now, they are definitely into the automotive system. They are supplying to some major key OEMs. And we believe, in fact, some management change has also happened in the past, I believe. And I think all these changes which has happened to this company are poised to show some more good returns from here. So stay invested in this counter. Maybe time horizon can extend from 6 months to 1 year because of the kind of uncertainties which we are into right now.
Okay, all right. We've got an interesting question up next as well. So that's a view on Unominda. But we've got BEL from the defense pack, and we've got Venkat from Andhra Pradesh, who has said that he's acquired a sizable quantity of BEL, 10,000 shares at an average price of 279 per share. And the stock is currently at 300, and so for an acquisition cost of 27.9 lakh, he's making a gain of 2.5 lakh. He's asking whether to hold from the perspective of 6 months or thereabouts or not, or exit at the current level, take money off the table. Swati, this is not a very sizable portion of his portfolio, in that it's about 5% is what he's clarified and told us. So he can, I guess, hold based on risk reward. Would you say that he should, and what are the key levels to watch out for?
My view on this particular stock BEL is big positive. The stock is on the verge of giving the breakout of 305, 306, which was acting as a previous cluster resistance zones. Any move above that level will see the extension of this positive rally towards to 320 levels. Up to that level, I'm looking for a target on the higher side. Since the his buying price at the lower levels, I will suggest to hold on by keeping a strict stop by profit stop loss of 295. Hold your long positions for a target of 320.
Hold is a view on BEL, and Swati's got a positive view on the stock. 300 is the current market price. It has moved up quite substantially along with the rest of the defense pack. We spoke about that with regard to BDL, Bharat Dynamics as well. Okay, we've got our next caller, Rohit from Bengaluru, and Rohit wants to know about Sagility. Rohit, relatively new listing, what drew you to it?
So I work in the same sector, Alex, but for a different company. So I understand, and my company also have the same client base as US.
Right.
So and they have very strong fundamentals, and the results that followed up were very good. So that's why I got into this stock.
Okay, and so what do you want to know? You want to know about the long-term prospects?
Right. So currently, considering the US tariff wars that are going on, this stock has fell from its high. So I just want to know whether I can hold or should sell, or I can re-enter later, or basically a long-term view on this.
Yeah, and you said it. It's got primarily US-based clients in the segments that it operates in, and so therefore, Asta, the question really is, can it withstand the current uncertainty? How does it emerge on the other side? Because a lot that is happening right now, particularly with regard to the bilateral agreements that are in the works, perhaps everybody's watching this meeting between J.D. Vance and the Indian administration. Apparently, he met the Prime Minister yesterday as well, Prime Minister Modi. What would you say about Sagility? Recent listing, hold on?
Yes, I would like to recommend hold on this counter. Yes, the recent listing listed in November only at a issue price of around 28 to 30. They have come at the price band off, and we have seen a good jump from there. So they provide technology enabled solutions, especially to the US healthcare industries. Yes, we know that some sort of uncertainties are there, but if we see their previous commentary, management commentary, they are quite optimistic. In fact, they have onboarded various new logos, etc., and they have done certain acquisitions also. So I believe the kind of work which is going on in the company, so they are all set up with their plans. The only thing is about the macro environment, and this is not related to this particular company. It is related to the every other company which are working in the US right now. So I think just give some time, and things or this dust will definitely get settled down. Idea here is to stay listed in this counter. Initial price target we can give to this counter is 48 rupees.
48, so not too far, a cautious approach. And ultimately, you said it, you've got to wait for the dust to settle. Hopefully that answers your question as well. Interesting question on the banking space, and this one's from Satish. Between a Bank of Maharashtra, which a lot of watchers of public sector banks have identified as a stock to watch, and Axis Bank from the private sector play, which one would you pick at this juncture for the long term? And you know, because banking is in focus, let me get a quick view from both of you. Swati, on the charts, Bank of Maharashtra and Axis Bank, which stands out to you as a better pick?
I will go for with the Axis Bank, because the way this particular counter gives a rally, we can't compare it with the Maha Bank. It's a small bank, very slowly and steadily it will give a returns. No wonder the view is not much negative, but if you want to earn the fast money, I will go with the Axis Bank, because this is the counter, index-based counter. Whenever the bank nifty will show a spectacular rally, this will participate in those rally. Don't buy at the current level. If you're getting any dips towards to 1100 and so levels, definitely you can go for a long position. So if you want to do comparative analysis on the chart also, Axis Bank charts looks really good, and we are looking for a target of 1500 and so levels over a period of time. So I will go with the Axis Bank.
Okay, Asta, is that the view on the fundamentals as well, or would you pick a third bank?
No, both banks are looking good right now. So that is in the public sector bank, my Bank of Maharashtra, and it is in the private sector bank. But yes, if anyone has to compulsorily pick up only one, then I would like to go with Swati. Bank of Maharashtra is my second choice. First, I would like to go with Axis Bank. Although Bank of Maharashtra, we are expecting their CAGR growth of more than 10% in the AUM. But the kind of portfolio which we are seeing in the Axis Bank, I find it more, comfortable. I'm more comfortable with that kind of portfolio, which is now moving towards more retail deposit, etc. So idea here is, if anyone has to go with a single bank, then Axis Bank is the choice. Otherwise, both of these counters are looking good. Bank of Maharashtra can ultimately go till the level of 55 to 60 in the longer term. However, Axis Bank being the preferred choice, we have a target price of around 1400 to 1450. And with one disclaimer, this counter we might hold in our PMS services as well.
Which one? The Axis Bank, right?
Axis Bank, right.
Okay, got it. All right. Our next caller is also asking about the financial space, and Raju Reddy is calling us from Bengaluru. Hi Raju, good morning to you, and you want to know about Bajaj Housing. You've bought a very significant quantity. Can you help me understand what the thinking was? And because you bought so much, despite the fact that it's at just a 2 rupee difference in the price, you're losing quite a bit of ground. Did you acquire this at once or over a period of time?
Period of time for long term, sir.
Okay, I got it. But did you buy 90,000 shares at one go, or did you acquire it over?
At one go, sir.
Okay. And what was the thinking, Raju?
Sir, this parental company is a good company. So I am planning for 10 years, sir.
You're planning for 10 years?
Long term.
Okay. Do you own any other shares, Raju, or this is the single share that you own?
No, I have Trent 60 shares, sir.
Okay. And what price do you remember?
Trent, I bought 3,000, sir. 3,200 or something.
Wow. Very good. When did you acquire this?
This and all before 2 years back I bought it, sir.
Okay, okay.
Then Dixon Technology, I bought nearly 6,000 rupees, 25 shares I have, sir.
Wow.
This is around 3 years back I bought it, sir.
Okay, okay. Congratulations. So you know how to pick them, Raju. Okay, so let me go across to Asta on Bajaj Housing Finance, and he's taking an oversized bet on Bajaj Housing. I don't need to stipulate what his thinking is. He's trying to get in early and he's holding for 10 years. As he's displayed with his buy of Dixon Tech, as he's displayed with his buy of Trent, he's making a sizable amount of money in both. But he's got 90,000 shares of Bajaj Housing. What's the view?
So view is positive. First of all, good AUM growth, which this company has posted. So I believe they have posted the AUM growth of more than 20%, maybe 25, 26%. And in fact, their ROA and ROEs, because these ratios which I'm talking about, they hold key importance to any NBFC. So ROA of around 2.4%, ROE of around 11%. Good growth figures. The only problem is with the valuation, and I think that was the major reason we have seen beating down also in this counter. But going ahead also, since 56% of the portfolio is coming from the home loans and the kind of environment which we are into, where the interest rates are now we are seeing on the downside, definitely these NBFCs are well poised to show more upside from here. No need to worry. I think remain invested in this counter, and initial price target which one can set is at around 150 to 160 odd levels.
So don't go by that loss number. Of course, Raju, you don't need me to tell you that. You clearly know what you're doing. For the viewer though, just take a look at the number of units Raju has acquired. 90,000, right? So ultimately his buy price is 1.2 crore. And on that, he's losing about 1.6 lakh. Not too much if you think about it. And he's made okay, while sensibly, a lot of people talk about having lower concentration risk, but this is not a bad company. It's got a proven track record, and he's taken an outsized allocation towards one company. It depends on what your strategy is. So bear in mind, he's taken an outside position. Maybe that does not fit for you. We've got the next question. Smriti from Bengaluru is asking this question. She's got a question on Newland Laboratories, which she's bought 16 shares of, and at a price of 5,362. She's asking whether to book profits or to hold for the long term. She's making a sizable gain here as well. 1.25 lakh is the profit. Swati, would you book right now?
Yes, I will suggest to hold on, because this particular counter on the weekly chart is on the verge of giving the symmetrical triangle formations. So whenever such kind of a formation breakouts we get, definitely we are likely to witness a very strong upside, nearly at least 5 to 10% from here onwards. For a short-term period of time, I am looking for a target of 14,300 levels. Beyond that level, 15,200 levels can be seen. Since the buying price is at the low price, we can take a risk of standing out at the current market price. So hold your long position if you want to keep a profit. Stop loss with 12,500 is the crucial short-term support level. So by keeping that as a profit stop loss, you can definitely hold on your long position.
Okay, all right. We've got a next caller, and Murli is calling us from Bengaluru. Murli, very good morning to you. You want to know about Just Style, right?
Yeah.
Please go ahead.
Good morning. Yeah.
Good morning.
Yeah, I bought 1100 shares of Just Join at 1234.56.
Okay.
Last October I bought.
Okay.
And being a Reliance change of management, and they are yet to come to the dividend list, and they declared a very good result in the fourth quarter now.
Yes.
What are the future projects can I hold, because I'm incurring a loss of 2.5 lakhs?
Yes, I can see
and
that.
And being a Reliance stable, I thought some point of time
it'll turn around.
Strong management and they'll do something.
Yeah. Okay. So decent thinking, and in fact, you must have seen a sizable pop in yesterday's trade as well, because this is one of the stocks of the day yesterday, Murli. Let me get Asta in on this one. Asta, Just Dial, decent set of numbers, as Murli pointed out in the fourth quarter. Would you hold on? His buy price is 1234.
Yes, definitely, because the numbers were really good. And the most important feature of these numbers is they're the unique visitors, which have risen by around 11%, I suppose around 198 million. In fact, the active listings has also shown a growth. Pardon me. So I think this counter is well placed to show more upside from here. Definitely the cost price is high, but I think in the longer term, we can see his cost price also remain invested in this.
In Just Dial is a view from Asta. We've got Dr. Vijaya, who's asking the next question, and she's bought Cera Sanitary Ware, 5 shares at 7,000 rupees. The stock is currently at 5789. This is for a long term. She's wondering whether to add at the current dip or to avoid, and maybe also to exit if that's the view on the charts. Swati, on the charts, what's the view?
The view as of now, we already have seen a very sharp correction from the mid of 2024 onwards to now mid of almost 25 levels. Now at the current levels, I believe that we already seen the price correction. Now the time correction is likely to be going on. Stock will be under the consolidation phase for a few weeks and so, and then onwards we can witness some sort of a reversal into this particular counter. Since the buying price is very at the elevated levels, I will suggest to average it out at the current levels. Average not the exact 50% quantity, but 20-30% can be added at the current market price, because we are likely to witness some uptick rally towards at least 6100 to 6200 levels. Up to that level, we are looking for an upside rally. So definitely you can add on few more stocks at the current market price. For a short-term period of target will be 6200 levels. Beyond that, 6500 levels can be seen. If you want to keep any kind of a stop loss, 5500 is acting as a very crucial support level provided by its 20 days moving average. So by keeping that stop loss, you can hold on the long positions.
Okay. All right. So that's the view on Cera Sanitary Ware, up about 2% in trade today. Rakesh is calling us from Hyderabad. Good morning, Rakesh. How can we help you today?
Good morning, Alex. I'm holding 5-star business at the rate of 706 rupees.
Right.
I'm tracking this stock from long time, and it is going up to 848, and it is lowering down again to 700 rupees. Whether I want to hold or book some profits there.
I got it. Okay. And what is the time frame that you had in mind?
Initially, I bought for a longer time, but I'm looking to book profits now.
You're looking to book. Okay, fine. All right. By the way, it's engaged in the micro lending space, or the micro entrepreneurs and self-employed individuals, and we're just about seeing a bounce in that segment. So you might want to watch that as well. But since you're asking for a short-term view, let me go across to Swati. Swati, on the charts, he is making a small profit at this juncture. Should he book?
Alex, if we look towards the weekly chart or the daily charts, the stock has already given a very strong rally from almost 650 to 850 levels now. Current 200 points has been witnessed. Probably we might witness some sort of a profit bookings at the higher level, but the overall view is definitely positive. I'm looking for a target of 870 to 900 levels on the higher side, but the client is looking for a very short-term period of time, and we might witness some sort of a profit booking at the higher levels. I will try to convince him to book the partial profits at the current level, so that your at least buying price will cover up. So by keeping profit stop loss of 820 rupees on a downside, you can hold on your second partial quantity for a target of 900 rupees on the high side.
All right, so that's a view on 5-star. A lot of questions on the financial space, understandably, because the space as a whole has done particularly well over the course of the last few sessions. I think over 12%, 13% for the Bank Nifty in just a few sessions, 5 or 6 sessions. Okay, Abhirami is calling us from Chennai. Hi Abhirami, how can we help you today? I think you want to know about Bandhan Bank, right?
Good morning, sir.
Good morning.
Sir, I buy Bandhan Bank 175 my LTP, 350 shares. I can hold for short term, sir. What is the target for Bandhan Bank?
When you say short term, have you defined that as 1 month, 2 months, 3 months?
Sir, 3 months, sir.
3 months, all right. All right. Swati, on the charts, Bandhan bought at 175. What is the potential upside for 3 months?
The potential target I'm looking for 185 to 190 levels. Up to that levels, you can definitely witness the long positions, but not at this speed. At this speed, whatever we have seen in the last few trading sessions, because the Bank Nifty is trading at all-time high levels, we might witness some sort of a profit bookings at the current market price as well, nearby 175 levels. Then retracement levels can be seen up to 155. Then onwards, we can in the pattern of the high tops, high bottom formations, we are likely to witness the uptick rally, but definitely for a short period of time, my view is definitely positive. 185 to 190 levels I'm looking for a target. The immediate support lies at 155. So as long as the stocks maintains the 155 levels on the closing basis, the view will remain a positive.
Okay, all right. So Abhirami, hopefully that answers your question. It is time now to take a few more questions on WhatsApp. Anthony Waste is the name of the counter that we're taking next, and this is a question from Mahendra Raj. He's bought at levels of 624 and the stock is currently at 520. He's looking at the long-term prospects. Actually no, he's looking to hold for the next 6 months and whether or not to do so or book losses. Swati, on the charts, what's the view?
My view is not that much positive in this particular counters. As of now, the stock is currently trading at around 520 levels, and so downside is a very good support of 500 rupees. So as long as it's hold that level, we are likely to witness some sort of a pullbacks, but those will be a very short-lived. So sell-on buy strategy should be applied. On the higher side, 540, 550 levels can be seen in over a period of time. So once the stock manages to reach that level, try to exit your long positions.
Okay, Richie Lalu from Kerala is asking about Premier Explosives and whether to buy at the current price. He wants to deploy as much as 2 lakh rupees. Stock is currently at just under 400. Swati, what's the view?
My view is not that much positive in this particular counter. If you want to invest the same principal amount, try to find out the another counters such as the Balrampur Chini really looks very good at the current market price, United Spirits. But premium exposure, I believe that the upside is very limited. It will go up to 420, 430 levels, and the risk reward is not favorable. If you're getting any dips towards to 375 to 380, that will be the attractive level to take a long position into the this particular counters. But apart from that, if you're looking to invest at the CMP, United Spirits and Balrampur Chini looks attractive on the technical fronts.
All right, it's time now, ladies, to hit the rapid fire segment, and you know what this means. I'll toss as many questions at you over the course of the next 2 minutes. Do keep your answers as short and as cogent as possible. The first one is from Vijeta from Kolkata, asking about Dr. Reddy's Laboratories. 3 to 6 month view is being sought. She's bought already at a price of 1,162. Should she hold on? Swati, what's the view?
Definitely should hold. I'm looking for a target of 1250 to 1300 on the higher side. Downside, it has a good support of 1120. So by keeping that stop loss, you can hold the long position.
Okay, CA Yogananda Naidu is asking about IndusInd Bank, which he's bought at a price of 750 and is currently in profit. Should he add more or should he exit? Asta, on the fundamentals?
Don't add more at this point of a time, and if risk appetite is not high, so book partial profit also.
Okay, Satyan wants to know about Vedanta. He's been holding for 8 months at a price of 460. He's looking for the next 4 to 6 months, and his target was 550 on the charts. Is that possible going forward? Swati, on the charts.
The 500 target will be possible, but before that 470, 460 levels can be seen, which are the previous resistance levels. So up to that level, I'm looking for a uptick rally. Downside, it has a very good support of 400 rupees.
Okay, Jay from Bengaluru wants to know about Bharti Airtel. Is it a good time to enter at the current market price? How does it look for the long term? Asa, on the fundamentals, would you buy?
Yes, definitely. One can make an entry at this point of time also. Long term is looking good with the price target of 2,000.
Okay, Venkat Ramana, unfortunately, we couldn't take your call, but we did address Bank of Maharashtra. I'm saying this right now. I want to reiterate, he's on the call for 20 minutes. I'm so sorry you had to hold, but I'm going to ask Asa to reiterate. You said buy on Bank of Maharashtra, right?
Yes, Bank of Maharashtra was also looking good.
Yes.
And here the price target can be 55 to 58 levels.
Okay. Hopefully that answers your question, sir. Apologies to keep you on the call for so long. CAMS is the stock that we're talking about next. Should it be bought at the current market price is the question Sanjeevi wants to know. Ask Swati on the charts.
It's definitely 20-30% can get accumulated at the current market price. If you're getting any deeps towards 230, 637, you can add on. We are looking for a target. Initial target will be a 4,500 and beyond that 4,800 levels can be seen.
Okay, all right. Asa and Swati, thanks so much for answering all the questions that you did answer today, and we've covered quite a bit of ground, so appreciate that. All right, it's practically impossible to answer all of the questions that we get over the course of a one hour time frame, but we do our best. If you've not got your question answered, then there's the program in the evening, or we'll be back tomorrow to take more of your questions. In the meanwhile, I hope that the stocks that we discussed today and that we will discuss over the course of the day will help you out. Do stay tuned. This is NDTV Profit.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
The second buyback is a Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company? Hello and welcome. You're watching Know Your Company. Today we're going to be covering Ashiana Housing, real estate play, of course, and an interesting one. It's a sub 3,000 crore in terms of market cap. And what I want to know and why we're featuring Ashiana Housing today is I want to try and understand. They've come out with their provisional numbers for FY25. There's been a slight bit of a miss in terms of that number. So whether there are any regulatory and approval challenges which are cropping up with regard to this company in particular, with regard to existing projects. That's the first piece I'm going to try and zoom in on. Second one I want to really understand is with regard to pricing and outlook for FY26 and the near term thereafter, whether there has been a significant shift in terms of either of those metrics, demand and pricing. The third piece I want to understand is they have around 2,100 crore of GDV which needs to get executed, which is roughly 49% of what has already been received by them with regard to this execution of GDV. GDV being gross development value, and therefore all the development that they are doing should lead to some amount which is 2,100 crore to be recognized in the near term. How quickly are they going to recognize that? The approval status of existing projects, whether there are absolutely any approval delays that we are seeing at this point. I want to also understand the cumulative gross development value currently, because that as of now is not available in public domain, something I want to understand. New projects which are being considered going forward, what are the growth levers and how is that looking? Mind you, roughly 11,000 to 12,000 crore of execution is what they've guided for. That will come as part of our analysis, but that's something that you should know, given the fact that we are looking at the gross development value in cumulative that they are currently sitting on is what I want to understand. Now, the last piece is with regard to capital allocation. They're sitting on some amount of cash. They're also sitting on some amount of debt. The debt number, frankly, is very low. How are they incrementally allocating capital, and therefore what are the return ratios at which they are deploying capital is something I want to understand. So those are some reasons behind why we're going to be zooming in on Ashiana Housing today. Interesting play in the real estate space. Let me start off by explaining what the company does. In terms of Ashiana Housing, it's a mid-sized real estate developer, and it was incorporated in 1986, listed on the BSE in 1993, and thereafter listed on the NSE in 2011. It's specializing in residential projects in Tier 2 cities. It's a prominent player in developing housing for senior citizens. Now, in terms of segments, they are into the kid-centric home segment. They are into senior living home segment. So this is one real estate player which is developing a niche of sorts within these pockets. Premium homes is the other place where they are playing, and elite homes is where they are playing. So those are the 3-4 clusters that they are currently focusing on. A really wide geographical presence. Now, again, this is unique from a small developer perspective. Not too many small developers have such a wide range in terms of geography that they cover. But just look at some of those names, all Tier 2 plus cities. So again, it's Tier 2 plus, it's wide ranging, and it's in these specific pockets that they operate in. Something that you should keep in mind as we speak about the company even as a whole. That's the future projects, that's projects in the pipeline in terms of saleable area, but the gross development value of those projects will be crucial, and we'll understand that when we speak with the management. Now, in terms of what are the KYC metrics that we'll look at when we're speaking about Ashiana Housing. And I'm going to start off with the first metric, which is operational metrics which we generally look at in real estate companies. Thereafter, we look at income statement and cash flow. We'll combine those two metrics. Balance sheet is the third metric and return ratios is the fourth. Thereafter, we look at shareholding pattern. We look at street cred. We look at the outlook going forward, what the guidance seems to suggest. And last off, we'll compare the valuation at which this currently sits at versus some of the other players that are there in a similar market cap kind of space. So that's how we've kind of split up the metrics, and we'll hopefully dissect all of that for you by the end of this this show. Now, in terms of who's joining me, we have Anushi Vakharia joining me on this show to try and break these metrics down. Anushi, firstly, welcome. Good morning. Wanted to first start off with those operational metrics that we always look at when it comes to real estate companies.
Of course. So before we go with the income statement for real estate companies, it's important to focus on how the booking values have fared in terms of how the area booked has looked at. So if you see the growth in the last 2 years or so, we've seen at a muted growth of around 2% in terms of how much area has been booked. We saw in FY25 this number standing at about 26.97 lakh square feet. While in terms of value of area booked that we are looking at, here we have seen improvement in terms of where the land value is concerned. We're looking at a growth of around 8% in FY25, of course, aided by higher price realizations as well. In FY24 and FY23, there had been a substantial pickup in terms of these growth numbers that were there, around 37% of a growth last year. So overall, this is the picture that we are seeing over the last 4 years or so. But let's also talk about the fourth quarter, what has panned out for the company. In terms of area booked, we're seeing about a 20% of a dip in this number. While if you look at the value of area sold, that stands at 574.7 crores, seeing about a minus 33% of a dip as well. Do note that the company had guided for a 2,000 crore of overall pre-sales for FY25, of which it was shy of by around 63 crore. It reached a pre-sales number of 1,937 crore. So in terms of where the key operational numbers are looking at, that's what we are seeing. But Harsh, let's also talk about the income statement, right?
Yeah, let's do that. And it's not a very impressive looking income statement, also from a perspective that you will likely see that for real estate players, the execution is chunky. So something to keep in mind. FY25, when I'm looking at the numbers, not impressive at all. In fact, trailing 12 months, FY25 ended 9 months, which is not reflecting in the graphics in front of you, is just about 600 crore in terms of top line. But outside of that, it's grown at a fairly healthy clip of a low base. Mind you, for a 3,000 crore market cap company, it's doing about 1,000 crore in profit after tax. The EBITDA margins have gone up from 7 to 10 odd %. And the net profit also has gone up in similar kind of stead, as you can see. And for FY25, as I did mention, not a very impressive set overall, at least up to 9 months. So some bit to be done, some room to be left with regard to execution. And that's something, of course, we will ask management as well. So that's on the income statement. Let's look at the CAGR. And again, it's a 3-year sales CAGR of 57% off a very, very low base, and a 3-year profit CAGR of 147%, again off a very, very low base. And loss making as well, in fact, a couple of years back. So something to be kept in mind. When you're looking at the standalone numbers for 9-month FY25, you can see revenue is in fact down 52%. EBITDA is loss at around 50 lakhs odd. And you have a net loss which is at around 2.1 crore, which has been clocked by the company. Now, so of course, that's the income statement. Let's also look at the cash flow while we are at it, because this kind of unimpressive number largely not translating to cash flow. Cash flow is reasonably better in that sense. As I did mention, when income statement is concerned, you will largely see it chunky. Cash flows may be the better way to look at it, but you would want a faster growth on a lower base where the cash flows are concerned. In fact, H1 FY25, the cash flow is negative 2.6 crore, and the net cash flow is of course looking positive at around 86 crore, which is in front of you. So that's how it's stacking up. We'll give this metric a neutral for the moment, both the income statement as well as the cash flow. You want to see more execution, and you want to see on this base whether Ashiana Housing can continue to execute That's really the question. Anushi, balance sheet.
Right. So if you're talking about the balance sheet, let's just segregate it in two parts. If we take the equity shareholders fund in consideration, the equity share capital roughly to the tune of 20 crores. So considering reserves and other factors also, we are seeing at an overall unchanged value of 754 crore. This is the end of 9-month figure that we are looking at. But considering debt and cash flow position, it's a healthy picture that we are seeing. Cash, of course, eclipsing what the debt picture is. We are company currently sitting on a cash of around 343 crore, higher than that of the debt of 256 crore. In fact, when also asked about what their future plans are on the what the future plans is as per the earlier conversations, the company does not want to do fundraisers as well. So we are looking at a healthy picture in terms of the net debt picture that is there for the business, right?
Right, absolutely. And they're doing roughly 100 crore, at least in a normalized year in terms of cash flow as well, Anushi. So believe that should not be a concern. Let's look at return ratios though. That's because that's the other metric you want to look at. The ROCE FY23, look at the numbers, quite unimpressive in that sense. ROCE and ROE numbers, sub 4%. It's obviously jumped in FY24, would have likely again tapered down in FY25. Again, you want to see more stability on this number. It's likely a thumbs down, but we're giving this a neutral only because we see it on an improving trajectory, and therefore, can this sustain and can the ROCE number or the IRRs within each project make good returns for investors on the invested capital that shareholders or the companies plowing back into itself is really the question that we'll try to answer again with management, but we'll give this a return, give this return ratio number a neutral for now. Let's look at shareholding pattern, Anushi.
Yeah, so in terms of where the shareholding pattern is concerned, there's nothing much to talk about here in terms of where the promoter holding is concerned. It's a flat number that we are looking at, no changes there. 61% is the shareholding that they had in March 25. Again, comparing this to the September picture also, there are not major changes that we are seeing. FII is also 7.74% is the ratio that we are looking at. So that has remained majorly in line. DI is again a similar kind of a ratio that we are seeing. Public holds about 23.4% of the stake in the company. So overall, this metric we have given a thumbs up, considering there are no major rejects or changes that we are seeing in terms of how the shareholding has panned out.
Yeah, just one quick point that I'd like to make here is that SBI Contra Fund holds around 7.5% stake in the company as at the end of FY25, 7.67%, and continues to buy. So they, at the start of the last financial year, they had around 6.7% stake, which they've hiked to 7.7% now. So something to be kept in mind. SBI Contra is one of the funds that looks at this particular company in positive light. Now let's look at street cred, because that's again the other metric that we try to track. And the last 1 month returns have been tough to come, negative 12%. The year-to-date period returns also are negative 25%. So we've seen a bit of a correction on the counter. The last 1 year, the stock is down 29%. And in the last 5 years odd, the stock has been a 6-bagger. So it's done clearly very well over the last 5 years odd. And you can see the kind of trajectory that even the numbers have taken, especially after the FY22 kind of period. It's really gone up substantially, but a lot of those returns have been front-ended. So in the first 3 to 4 years, we've seen very solid returns. Over the last 1 year, stock is actually down 30%. So a lot of the pain currently sits in the short to medium term with regard to this counter. So something to be kept in mind. We'll give this a neutral. Anushi, what's the outlook looking like? What is the guidance that the company is giving? And thereafter, we'll try and, on the basis of that guidance, try and extrapolate how do you derive a valuation with regard to this one.
Right. So let's talk about how the fourth quarter had panned out and subsequently the impact on the FY25 and the outlook forward that we are seeing. So in Q4, what we had seen is company had launched Ashiana Nitara. That's the phase 2 and 3 project that we are seeing, along with launched Ashiana Amara phase 5. That was conditional on the overall booking trends that we have seen for overall FY25. Now do note that the company had guided for around 2,000 crore of pre-sales by the end of this year. Company fell short of that target by around around 63 crore mark. That is what we are looking at. Another concern has been some of the regulatory challenges affecting construction timelines of some of these projects that we are looking at. But on to the outlook forward, now company has given out a 5-year plan in which they have given higher weightage to the kind of return ratios they want to build in. They're expecting high teen margins over the next 5 years as well. So that would be in focus. This is in terms of PAT numbers that we are looking at. Along with that, they also plan to launch around 3 to 4 projects more. They plan to acquire land parcels, including a 20-acre site that we are seeing in Jaipur. So this is the overall picture that we are seeing for how the Q4 shaped up, leading to the kind of miss that we are seeing in terms of the FY25 number and how FY26 is expected to be going forward, right?
Absolutely. So therefore, given all of this, let's try and break down how the valuation looks like. And this is of course a very, very difficult job to do. But what we've tried to do is, and I'll explain this a little better, we've tried to pick companies within the 2,500 to 6,000 crore kind of market cap band. So you'll see the market cap here of each of those players: Ashiana, Arcade, Sunteck, Kolte Patil. And thereafter, what we've tried to do is basis whatever they have shared with us in terms of either their analyst investor presentations or in terms of the way in terms of the commentary that's coming through. This is the execution broadly. Broad number again, the approximate number in terms of execution over the next 5 years that's anticipated from each of these players, right? And thereafter, any guidance that they've given in terms of EBITDA or profit after tax. And I'll give you examples here. So for example, Sunteck has guided for an EBITDA of 21 to 23%. We've taken the profit after tax number at around 15% of the execution which Sunteck is expected to do on existing projects only and not on new projects. Again, a Kolte Patil, they've guided for around a 12 to 13% margin. We've deducted a decent amount in terms of interest cost, which is around 200 crore. On 25,000 crore, that's an EBITDA of around 3,250 crore. So we've deducted around 200 odd crore in terms of interest payouts, and thereafter we factored in a tax of around 25% to arrive at this broad profit number on an execution size of 25,000 crore. So this may well change if any of these assumptions change, but broadly, as of today, as things stand, this is the broad profit after tax on this execution that the companies are going to do over the next 5 years. And thereafter, what we've done is we've just listed down the market cap. And when we are comparing the profitability with the market cap, what you're seeing is Ashiana trades at quite a large premium versus some of the other players. Some of the other players are just about a 10% premium at most. But Ashiana is at almost a 30 to 35% premium to the 5-year profit that we're extrapolating. Again, this may well change if there are projects which are added, and some of these numbers may well change if the companies go into new segments or new geographies. So some of these metrics might change, but as things stand, this is how we're looking at the valuation picture, and which is why we're giving Ashiana Housing a thumbs down. Also, mind you, and as Anushi has been arguing with me in the newsroom regarding this, Ashiana is in a very different segment compared to the others. But profits is really what we want to compare with the market cap, and this is 5-year profit, so it takes out any execution risk, at least from a near-term standpoint. So maybe for a year or two, there may be slower execution, delayed approvals, but despite that, you might still achieve that kind of profitability. So there are multiple things to be kept in mind, but this is broadly how we are looking at it. It's a tough one, but we've tried to piece this together and we've given it a thumbs down, given the kind of delta that is there between this one and some of the others.
Right.
Yeah.
Well, yeah, that was quite a detailed piece. So this is what we are looking in terms of valuation picture. But let's in fact speak to the management to understand how the picture forward is going for FY26 and beyond. That is what we are looking. We had the management with us, Varun Gupta, the director of Ashiana Housing. My first question is regarding real estate as a segment. As we are seeing, they have been marked by the regulatory challenges. This year, you clocked in FY25 pre-sales at a number of 1,937 crore. This was against the guidance of 2,000 crores. So talk to us about the year gone by in terms of how the booking challenges are and some of these regulatory concerns which were there?
This number is in the context of 2,000 crores, our targets. We actually had good sales across locations, except we missed our targets in Gurgaon. The launch of the last phase didn't go as we had targeted at the beginning of the year, though we still had a good launch. We had no regulatory issues. We were able to launch our projects that we had planned to this year. And overall things, regulatory challenges were not part of last year in terms of launches and pre-sales. We have had some regulatory challenges in getting OC, so our deliveries have gotten delayed. So Ashiana and Mall in Gurgaon, the OC came in now in April instead of March. So our delivery targets have been a little bit delayed because of regulatory issues.
Right. So considering that FY25 we saw about a 2,000 crore of a target, what's the outlook looking for FY26 in terms of where the pricing growth is concerned and also for the booking trends that we'll see? What's the booking value expected for FY26?
For FY26 also we are building a target of 2,000 crores itself, Anushi. We are looking at secular price increases across the board. Unfortunately, we have less stock to sell in one of our key markets in Jaipur, where we have to launch a couple of projects this year, and there are some regulatory challenges in getting those on board, and we have had limited stock because we found the land prices in Jaipur to be very expensive and we've been holding off. So with having a little bit more limited inventory to sell, our annual targets are a little bit more constrained because of that, but we see secular price increases going forward.
Okay, so secular price increases in FY26 number remains at 2,000 crore. But out of the total area that you've booked so far, amount of around 2,100 crore is to be received in future. Can you break down the execution timeline for this number?
Most of this should get executed within the next 2 years. Some of it will go to 27, 28 as well. We actually give a delivery schedule in our investor updates. I'm guessing you're talking about this number from the December updates because the March updates have not gone in. The numbers of receivables will actually go up. And most of it should come within a 24-month time frame and some of it going to a 36-month time frame from.
And Mr. Gupta, also give us a number for the gross development value on all the current projects that you have currently. If you can talk to us about this number.
So current gross development value of all our projects put together, including what's under construction, is about 11,000 crores. And we are targeting to realize the profits by FY30 of these values. And I've, as said, the expected after-tax profits from these projects is about 2,000 crores, and which we expect to realize over FY25 to FY30.
Just a follow-up on this, considering that current projects 11,000 crore is the number that we are looking at, of course, the current land parcels that you're going to have, what is the kind of number that we look for that?
11,000 is inclusive of all the land parcels that we have, but excludes one parcel called Milakpur, which is stuck under litigation. So 11,000 is across the board put together.
Okay, and Mr. Gupta, how many new projects are being considered in terms of launches? If you can give us perspective, also the key regions where you're seeing most of these launches panning out. Give us a detail on that also.
So we have 4 launches planned for this fiscal year. Out of that, 1 is in Gurgaon, 2 is in Jaipur, and 1 is in Jamshedpur.
Okay, and of these new launches that are there, what's the gross development value for these projects?
So overall, the GDV of these projects combined put together is around 3,000 odd crores. Of that, we will not launch everything. So probably a quarter of it to a third of it will be launched. We like to phase our projects. So depending on the market conditions at that point of time, probably a quarter of it will be launched in this year.
And now one key risk that we are seeing for some of these real estate companies is the receipt of necessary approvals on some of these projects which are there. Any projects where you are seeing that approvals are pending?
So all the project launches that we're talking about have some approval risks attached to them. The comfort levels in Jamshedpur and Gurgaon are very high because we are at late stage of approvals. In Jaipur, one project has got even RERA approval, which is a very, very small project. But the larger project that we want to launch, the risk on approvals there is higher and low.
Okay, so thank you, Anushi, as well as the management of Ashiana for giving us that perspective and that conversation with regard to Ashiana Housing. We of course also spoke with arcade developers earlier this month, or rather late last month, and therefore a couple of those real estate plays coming into focus and a lot of perspective that gives us. But that's how the KYC ratings stack up with regard to where Ashiana is concerned. And Ashiana, out of all the rating parameters, if you look at shareholding as well, street cred, the outlook as well as the valuations, the KYC rating that Ashiana gets on the back of all of this is a 5 on 8. But it's been an interesting conversation. And Anushi, just with regard to perspective, they have around 11,000 crore of existing GDV, another 3,000 crore likely to be added over the next year or so, all of which will likely get executed by FY30.
Right.
That's the aspiration. And at roughly a mid-teens kind of PAT margin, that's broadly how one should look at a company like this. But thanks so much for breaking this down with us today, and thanks for staying with us. Completely out of time on this edition of KYC. From Anushi, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
The second buyback is in Naukri InfoEdge. It's a bit of a conditional buy that we've seen. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
To India specifically, I really think India has a fascinating opportunity, because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims?
Markets trade in a range as tech stocks fall, but banks hit fresh record highs as sentiment remains positive. Steel stocks are doing well in the markets. This is on the back of the announcement by the ministry about 12% safeguard duty being imposed on steel. Think again before you head to the jewelry store. Gold prices have crossed 1 lakh rupees per 10 grams. Textile exporters are likely to be beneficiaries of the US tariff regime. This is because of the differential in tariffs between Asian countries. IndusInd Bank appoints EY to carry out a second forensic audit, say reports. EY will probe the 600 crore rupee discrepancy related to the bank's microfinance portfolio. And welcome. Good afternoon. This is Markets at 12 and I am your host Malika Mishra. Let's take a look at how the markets are doing at the moment. If you see the benchmark indices such as the Nifty 50 and the Sensex are both above 0.3% high, with the Nifty 50 standing strong about 24,000 levels, and the 30-pack Sensex is hovering around 79,600 levels at the moment. The broader markets are outperforming the benchmark, with the Nifty Mid Cap 150 and the Nifty Small Cap 250 both above 1% higher. The top contributors, if we pull up that chart, to the gains that we're currently seeing in the Nifty 50 basket are some of the top banking names like HDFC Bank, Kotak Mahindra Bank, State Bank of India, along with SBI and Mahindra & Mahindra as well. And HDFC Bank is actually leading the contributing pack with, on the back of strong Q4 earnings as well. While on the downside, you see Infosys, the IT lag, and Bharti Airtel, L&T, IndusInd, and also some other stocks that are sort of adding pressure to the Nifty 50 basket. Let's take a look at how the sectoral picture is at the moment looking as well, and you'll see that a lot of green. And in fact, IT currently is the only laggard, which is down about 0.25%, and currently the sectoral heat map is being led by PSU Bank, Realty, FMCG Bank, Defense, Finance, amongst others. Let's take a look at the Nifty 50 heat map as well to check how some of the other stocks are doing in the basket. And you'd see, as I mentioned, a lot of IT names in the red, like you have IndusInd Bank, also Hero Moto, Power Grid, Infosys, Bajaj Auto, Wipro, Asian Paints, Bharti Airtel. So all of these stocks in the red. In fact, at the moment, as we speak, there are 31 stocks advancing and about 19 declining. So definitely a sadder picture than what was yesterday, how it was yesterday on the stock exchanges. Let's take a look at some of our market breadth as well, and you'd see that the advanced decline ratio looks healthy at the moment, with about 1,656 stocks gaining and just about 560 declining. So that is exactly how the markets are currently positioned. And moving on with the first story, we spoke to Vikas Parshad, portfolio manager and M&G Investments, about his market outlook, and he says that outlook on IT companies has gotten cloudier. Let's listen in.
What a difference a year makes when it comes to liquidity and the tightness around the financial system. What has not changed in the past year is our constructive view on India. When I was speaking with you last time, a few weeks ago, one thing I had mentioned is that we remain fully deployed in our India strategy, but as a firm, we were looking to increase our exposure to India and have that converge with the exposures that we've had in other parts of Asia, in North Asia in particular, and we have indeed done that. late February was a great opportunity for us to increase our India allocations. We continued that in early March. We continue to do that even now. And it's across sectors. The financial sectors, especially the private banks and NBFCs, is one area where we've been very active this year in increasing our holdings. But there's a lot to like in India. That has not changed. If anything, I'm surprised by the pace of the rebound just over the last couple of weeks, given the uncertainties that we have. But you always have to ask yourself, what is in the price? And at the end of February, a lot of bad news was in the price after the 5-month-long sell-off that we had. Long term, nothing has changed for our view, whether it's small caps, large caps, financials. If there are certain areas where we are still cautious, even though they have underperformed, it's the IT services names. But again, we're reevaluating that call given the underperformance that we've had, the earnings season that we've seen. And when you look at how IT services reacted post-earnings, and how the private banks reacted after very strong earnings, it gives you a signal of what is in the price, given how they've moved since then.
Vikas, hi, Gamanna here. The point you make about what is in the price, what do you think is in the price right now when we're seeing the rebound? And I'm asking this in the context of the concerns that we were talking about just a few weeks ago. One of them was the quality of corporate results. That's yet to play out, decent lot from a couple of banks, IT largely disappointing, and we have to see how that goes. What's in the price if we have an economic slowdown fears? I'm just wondering if anything has fundamentally changed from the concerns we were all talking about a few weeks ago as well.
Overall, in India, I don't think that's the case. If you look at our time horizon, which is 2, 3, 4 years out. Now, if you look at it sector by sector, yes, certain things have changed. There is more uncertainty in the automotive space and in auto parts, auto ancillaries, where we've been active. Last time I was on, Amin was on from JP Morgan as well. We had a good 3-way conversation about that. And for IT services also, the outlook has gotten a little bit cloudier. But when you look at the performance, they have fallen quite a bit. So we have taken advantage of some of these falls to add back some exposure at the margin to both of these sectors. If you look at other sectors like consumer staples, the picture is more mixed, and I don't think that anything really has changed. The other difference between the end of 2024 and the beginning of this year is the increased exposure that we have had to healthcare services. We've switched some pharma exposure to healthcare services, diagnostics, hospitals, large cap, small cap as well. And then also we've been on the lookout for entirely domestic stories that are not contingent on the new policies coming out of Washington or Beijing or Tokyo. And there's plenty of choices in a market like India. Music streaming is one area that we're excited about, so we have exposure there. When I look at the market today and the opportunities we have on offer, the only thing that is scant, where the pipelines are thinner or less full than they were a few months ago, is in the ECM area, in the IPO arena. We think that will probably pick up as the markets have started to come back, but we continue to be very selective in what we spend our time on when it comes to new companies, especially in this environment where we're seeing disconnects and dislocations among names that we know.
So rightly, put, Vikas, the IPO streamline has dried up a fair bit. But did I hear you saying that you are adding on IT on the margins now?
Yes, we have, because of the magnitudes of the falls, and we remain underweight the sector, and the name count that we have in that sector is very low. It's the lowest it's been in years, actually, since just before COVID. But when we look prospectively and we look at the valuations and we look at the magnitudes of some of these falls, then yes, we've started to reduce that underweight, but not materially so. If IT had been the only sector that had been underperforming to this extent, then it would be different. We'd probably be adding more. But given the sell-offs that we've seen across a broad array of companies, small caps to large caps, we've added back a little bit less.
And you're favoring your smaller cap or mid-cap IT players or the larger ones?
For now, the smaller companies, because we've seen even larger disconnects. We haven't seen all the earnings from all of them yet, but we have seen from the larger ones, and they've not been so exciting.
Now, viewers, IndusInd Bank is back in focus after the board appointed EY to carry out a second forensic audit to investigate for fraud. My colleague Harsh is joining us with the latest updates on this development.
Well, yes, as per news reports, EY has been appointed as to conduct a second forensic audit on IndusInd Bank. Well, EY is going to as per reports again, EY is going to investigate a 600 crore discrepancy related to accrual of interest in the microfinance portfolio. This is purely relating to FY25 discrepancy and likely a Q2 or Q3 discrepancy in FY25, and therefore this doesn't relate to past periods. But the amount nonetheless is decently large. It's 1% roughly of IndusInd Bank's net worth. Mind you, they've already taken a hit of around 2.27% on the net worth, given the 1580 crore post-tax hit that they have taken from their derivatives portfolio discrepancy. Now this is the other one. EY is also going to check for lapses and fix accountability as part of whatever reports are suggesting, and reports also suggest that it's not an issue which spans multiple years, and they're also going to investigate fraud if any. On the back of that, of course, stock reaction in front of you.
Thanks for that update, Harsh. And now let's take a stock of few counters buzzing in trade today. Rajratan Global is soaring in trade after posting their Q4 results. The numbers are in line with estimates, and my colleague Varsha is joining us to break these numbers down for us.
So they've come out with their Q4 FY25 numbers. So basically, company makes bead wire, which are used in your tires. So their Q4 FY25 numbers, if you see, inline set of numbers, I would say good numbers when it comes to quarter on quarter. But yes, still there is still margin pressure when it comes to year on year. There was a volume growth of 6%, which is a good thing. But this was offset by price decline of almost 1% year on year. For India business, they had a volume growth of 17%, but for Thailand business, they have a negative volume growth of 8%. Their EBITDA per ton for India, if you see, was up almost 37%, but overall on the consolidated operations, the EBITDA per ton was down 34% quarter on quarter. If you see, they have also approved conversion of existing black wire capacity of 12,000 tons per annum at Pithampur into wire one rope capacity of 10,000 tons per annum. Now this move will actually improve their unit economics and aid overall profitability as per the management, and this capex that they are doing will be funded by a mix of internal accrual and debt. So overall, good set of numbers quarter on quarter, but yes, margin pressure when it comes to year on year.
Thanks for that, Varsha. And now 360 ONE WAM is in the news. The wealth management firm has approved an exclusive collaboration with UBS. And my colleague Harsh is joining us again. Harsh, we hear that this is an exclusive strategic collaboration between the two entities. Give us some more details about this.
Yeah, so I'll break this deal into three parts for ease. First is there's going to be a strategic collaboration between both entities where clients of UBS AG, which is the German which is the Swiss giant, will also enjoy the advisory which 360 ONE provides, and 360 ONE's clients will enjoy services which UBS AG provides. So that's the one big synergy which will play out. The second piece is with regard to how will UBS AG benefit from 360 ONE and its growth in India, and that is going to happen through a 2,100 crore infusion of convertible securities which UBS is going to purchase from 360 ONE. So 360 ONE is going to issue these securities to UBS at a deal value of roughly 40,000 crore post pre-money and around 42,000 crore post-money. So they will own around 4.95% at the end of this. They will own around 4.95%. UBS AG will own of 360 ONE WAM, which is a listed entity. That's the second piece. The third piece of it is the takeover of the India business of UBS AG, which includes also other businesses which UBS AG has been incubating in India, including stockbroking, distribution, discretionary and non-discretionary, portfolio management. All of that, including the Credit Suisse business of India, which UBS AG owns, will now be hived off to 360 ONE for a consideration of 307 crore. The AUM of this business is around 26,000 crore. So largely a decentish kind of valuation that they've got on this business as well. So it's a three-part consolidated arrangement of sorts which has happened.
Thank you for giving us that triangular perspective on this deal, Harsh. And viewers, Ashiana Housing was in focus on KYC, which is our show today. And our research team broke down the company's income statement and explained how investors must consider the company's low base when gauging its growth. Take a look.
It's not a very impressive looking income statement, also from a perspective that you will likely see that for real estate players, the execution is chunky, so something to keep in mind. FY25, when I'm looking at the numbers, not impressive at all. In fact, trailing 12 months, FY25 ended 9 months, which is not reflecting in the graphics in front of you, is just about 600 crore in terms of top line. But outside of that, it's grown at a fairly healthy clip of a low base. Mind you, for a 3,000 crore market cap company, it's doing about 1,000 crore in profit after tax. The EBITDA margins have gone up from 7 to 10 odd %, and the net profit also has gone up in similar kind of stead, as you can see. And for FY25, as I did mention, not a very impressive set overall, at least up to 9 months. So some bit to be done, some room to be left with regard to execution. And that's something, of course, we will ask management as well. So that's on the income statement. Let's look at the CAGR, and again, it's a 3-year sales CAGR of 57% off a very, very low base, and a 3-year profit CAGR of 147%, again off a very, very low base, and loss making as well, in fact, a couple of years back. So something to be kept in mind. When you're looking at the standalone numbers for 9-month FY25, you can see revenue is in fact down 52%. EBITDA is loss at around 50 lakhs odd, and you have a net loss which is at around 2.1 crore, which has been clocked by the company.
Right, and now two other stocks that are buzzing in trade today are Anant Raj and Pitti Engineering. And basically, Anant Raj clocked a strong growth all round, while Pitti Engineering in its Q4 results posted a sales volume jump of around 50%. And to give us more details on their quarterly results, my colleague Anushi is joining me in the studio.
Well, first off, I'll start off with Pitti Engineering. Now, the highlight over here is the revenue growth that we've seen, about a 40% of a growth in terms of the revenue numbers that we are looking at, of course aided by sales volume, which increased 50% on a year-on-year basis. If you talk about the margins, they've also expanded to 17.7% as compared to 15.5% last year. However, net profit, we are looking at a downtick of around 21.5%, but do note that there is an impact led by a lower other income last year. So like interest cost also going up by 36%, another factor as to why we are looking at a downtick in terms of net profit, but margins and revenue growth numbers continue to remain pretty strong. Anant Raj, on the other hand, no complaints here. Revenue, if we are seeing a 22% of a growth number is what we are looking at. Margins were particularly impressive at 26% as compared to 23.6% last year, aided by about a revenue growth of 22%, and EBITDA also seeing about a 36% growth. Net profit saw 52% growth at 119 crore as compared to 78 crore. Of course, a lot of focus now remains on the data center business that the company has, or even the cloud servicing business that the company has, will aid the higher margin business that the company aims to maintain. So focus would remain on that front as well. So two results, overall strong set of numbers that we are looking at.
Thanks for that update, Anushi, on both those results. And now Morgan Stanley continues to keep India at its top pick among emerging markets, and my colleague Neeraj Shah has the details of their India strategy.
Since the Indian markets are doing so well, we thought it best to get in some macro note as well, and Morgan Stanley's Ridham Desai and team have put out that India strategy note in which they speak about why India continues to be our top emerging market pick. Now, yeah, this question mark is not needed, but there are a clutch of factors. They haven't bifurcated into it, but I have bifurcated into 3 buckets. So first, cross-asset factors. They say India's low beta is helping it to significantly outperform markets, because the world markets or investors have realized that India is a low beta market per se. And weak global markets, the caution though, is that weak global markets can cap absolute returns, but relative returns, India will probably do well. the domestic factors which are at play for this, the strong macro stability with improving terms of trade. And this we can clearly see in a clutch of negotiations that are happening both from a G2G perspective as well as maybe G2B or B2G perspective. Then mid to high teens earnings growth annually over the next 3 to 5 years. We've seen that already. Hopefully we'll see that again, because that's a big shot in the arm. The reliable source of domestic risk capital. And viewers, as much as we scoff at it, or if we scoff at it, is nothing to scoff at. That's a sizable pool of money that is coming in. And remember the HDFC investor, AMC investor con call yesterday, they mentioned that flows are still at 98% of peak, which is substantial in volatile markets like this. And of course, they point out that the dovish RBI, sluggish oil prices, and likely Indo-US trade deal are some of the key domestic factors. And technical factors include persistent retail buying, underpinning India's structural nature of the market. Foreign portfolios positioning is the weakest since we've had data in 2000. And there are early signs, according to Morgan Stanley, that the FI view is shifting, and their proprietary sentiment indicator is in the buy zone. So multiple factors why Ridham Desai and team believe that India, as to justify how India is their top investment idea currently.
Thanks for that, Neeraj. And moving on, another day and yet another outperformance by Nifty Bank over Nifty. And Q4 earnings by major banks have only given a boost to this momentum. ICICI Bank is one such counter that posted a strong Q4. And analysts are crediting the CEO Sandeep Bakshi for it. My colleague Harsh has gathered some data to tell us how consistent Bakshi has been in harmonizing these numbers.
Well, it's been fantastic to try and understand this better. So let's quickly dive straight into it. In terms of just stock price performance, and this is where it really starts to stand out. One is quarter after quarter, ICICI Bank, at least over the last couple of years, has delivered a beat versus analyst consensus. And therefore, I've tried to do this exercise. In 9.5 years prior to Mr. Bakshi's appointment, the stock was up just about 260%. That's the kind of return it gave. So it gave a return of around 14.5% for those 9.5 odd years. Thereafter, just look at the contrast in terms of absolute returns. It's twice that of the 9.5-year period in a 6.5-year period. And therefore, the stock has compounded at nearly 25% from 2018, since the time Mr. Bakshi took over, till now. Now, what are the factors that have led to this consistent kind of performance? Look at the FY18 number in terms of loan growth. It was sub 11%. Thereafter, in not a single year has ICICI Bank not done a teens kind of growth, except in one, which is FY20. And no concern there, because it was it was just the start of COVID. So maybe some bit of tempering there, but outside of that, just look at the kind of growth that ICICI Bank has clocked. Just been a consistent compounder of sorts in terms of loan growth, steadily increasing their loan growth. Now, in terms of profitability as well, and you'll see the bar chart as it goes, and it's a beautiful one. So from 0.9 times in terms of ROA dipped and thereafter has picked up on a consistent trajectory. And even on a higher base, which is of 2.2% nearly in FY23, they've been able to expand ROA in FY24 as well as nearly expand it in FY25 as well. So the kind of ROA expansion even on a higher base is really the other piece that's standing out. So growth, better ROAs, and now we look at NPA ratios. Look at that NPA ratio in FY18. It was at 8.8%. Thereafter, Mr. Bakshi takes over, it falls to 6.7% immediately. And thereafter, look at the trajectory of the fall. There's been no steep variance in terms of GNPA. It's been consistently falling across each of those years and currently sits at 1.7% nearly. And the net NPA ratio is even more fascinating to see, because now it's gone from 4.77% to something that's best in class. Just look at the kind of NPA ratio at the end of FY25 that ICICI Bank has clocked. Just goes on to show the leadership within banks is so very, very important. He's showed up on all of that, and he's improved the metrics dramatically for ICICI Bank. And ICICI Bank is the best bank at this point in terms of its performance as well as in terms of the way it's operating. So a phenomenal franchise is how he's built this, at least over the last 6.5 years. Something to admire, at least for the banking industry.
Very well said, Harsh, and thank you so much for bringing us that unique analysis. Moving on, viewers, US Vice President J.D. Vance has embarked on a pivotal 4-day visit to India, aiming to strengthen bilateral ties by unlocking economic opportunities and negotiating a potential trade deal. Yesterday, he met Prime Minister Narendra Modi and spoke on critical themes such as economy, trade policies, and geopolitical alliances amidst the backdrop of an escalating trade war between Washington and Beijing, India's main rival in the region. According to a statement put forth by PIB, PM Modi and J.D. Vance have already made significant progress in bilateral trade negotiations. Their focus remains on enhancing cooperation in energy, defense, technologies, and various other fields, thereby setting the stage for Donald Trump's potential visit to India later this year. Also, as of this morning, J.D. Vance, along with Second Lady Usha Vance and their children, visited Jaipur's Amber Fort and is expected to address a gathering at the Rajasthan International Centre later in the day as well. Now, speaking of bilateral talks, our Prime Minister as well left for Saudi Arabia this morning on this 2-day visit. India and Saudi Arabia are set to sign at least 6 memoranda of understanding. Let's speak to my colleague Mohammad Ghazali from NDTV to understand what else is on the Prime Minister's agenda.
Yeah, so the Prime Minister is going to visit in Jeddah today, and where he is expected to meet the Indian community members here in Hotel Carlton, where I'm reporting from in Jeddah. And this visit assumes a lot of significance. One, because the Prime Minister is visiting Saudi Arabia after 6 years. The last time he visited was in 2019, and before that, the first step was in 2016 as Prime Minister of India. But this visit is also will be very much different from the previous visits, because in the previous 2 visits, he had visited the capital city of Riyadh. Now, this is the first time he's visiting Jeddah. Jeddah is a port city, which also brings our attention or focus back to the issue of connectivity. IMEC corridor is one project or a vision which India had conceptualized when it was hosting G20. Saudi Arabia, UAE, and other European countries are signatories to that project. So when it comes to the progress of that project, in the first leg, India has to build on or progress on the connectivity between India and UAE and Saudi Arabia. So with UAE, the logistical issues are getting processed. Perhaps the Prime Minister will also talk about the IMEC corridor and its progress with Saudi Arabia in the bilateral talks which he will be holding with Mohammed bin Salman today evening. Besides that, there will be new areas or avenues where India and Saudi Arabia will explore for joint collaboration, be it area of defense, space technology, AI, hydrocarbon. So these are certain issues, or space technologies are certain domain where India and Saudi Arabia will look forward for deeper collaboration. We know that India is the second largest trade partner for Saudi Arabia. Saudi Arabia is our 5th largest trade partner. We also kind of import all the crude oil, petrochemicals, and other such items from Saudi Arabia, and fertilizers, DAP. Actually, Saudi Arabia is our 2nd largest supplier for DAP, which is used in agriculture. So in all, these are the bilateral issues which will be discussed. But besides that, this visit also assumes significance because Prime Minister is visiting Saudi Arabia at a time when 2 global issues or 2 global developments are very concerning. One, we have the Russia-Ukraine war, for which the mediation and talks were happening in Saudi Arabia in the past few weeks. Then the issue of West Asia between Israel and Palestine, that war has also has stretched for more than a year. Then India's stand for in both the issues, in both the conflict, is as much as similar to what Saudi Arabia stands for. When it comes to Israel-Palestine conflict, as Saudi Arabia says, India also stands for two-state solution. It stands for removing all the illegal annexation of Israel on the Palestinian land. And when it comes to Ukraine-Russia conflict, Prime Minister Modi has said it on multiple occasions on global forum that how dialogue and diplomacy is the only way forward and solutions can't be found on the battlefield. So Prime Minister will not only focus on deepening collaboration between India and Saudi Arabia, but he will also be apprised about the global developments of significance.
Gazali, thank you so much for that update. And well, viewers, that's all the time we have on the show. But do stay tuned to NDTV Profit, as there's a lot more lined up for you right on the other side.
That's huge. That is a biggie. It's out of it.
गोल्ड ग्लास क्लियर ग्लास, कार हो या नियर, सब कुछ दिखे क्लियर।
The second buy pick is a Naukri Info Edge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
To India specifically, I really think India has a fascinating opportunity, because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Hello and welcome to NDTV Profit. You're watching Profit Buzzers. A very good afternoon to all the viewers. I'm Hiral Dadia and with me is Varsha. Varsha, good afternoon. Interesting day of trade in terms of today's session, because if you see the markets, clearly a 50 to 60 point gain is what you're seeing on Nifty 50. Let's quickly pull up Nifty 50 on the screen and then we'll follow it with Bank Nifty as well as what the other sectors are doing in trade. If you see overall, 0.3% higher, though we've cooled off from the day's highest levels of 24,242. We've come down to 24,072 and again reclaimed some higher grounds. Let's pull up, even the other sectoral indices and see what's happening on that front, because Bank Nifty is the one which has been garnering a lot of attention, a lot of buying that's happening as well from the FI perspective. But you have the PSU Bank Index, real estate, FMCG, as well as consumer durables. These are the top gaining sectors in today's session. What's lagging is the IT space now. Initially, the 2 to 3 days of euphoria that you saw in terms of the IT counters, the call on the street was that, yes, there was some bit of short covering that is happening. In terms of this week, you have the expiry on Thursday. So that is a factor we need to wait and watch and see as well. But apart from IT of infra, which has been losing its sheen, energy is also down to the tune of almost around 0.1%. Let's quickly pull up the Nifty 50 heat map, as well as after that we will look at the contributors in terms of today's session. In terms of the heat map, sectors and stocks which are losing out. So you have an Indicin which is probably under pressure. Infosys trading under pressure as well. Wipro, Bharti, NTPC and L&T which are losing out in today's session. Tata Consumers, SBI, RIL are a few of the other gainers as we speak. Let's look at a few of the contributors as well in terms of today's session. What's actually providing that support? And I mean, there you go. HDFC, second or third consecutive session where it's providing support in terms of where Nifty 50 goes. SBI, Kotak Mahindra Bank. So all the three banking heavyweights are the ones, which are on the front foot. Infosys again seeing profit booking. Why Infosys is interesting as well, because yesterday post the earnings, you did see an up move. And the key question was, though NDTV Profit clearly categorically mentioned that the earnings are below what the street was estimating. Brokerages have been negative. There was some verdict on the street as well that probably there are a few of the aspects which could be positive. But there you go. Now, after that rally yesterday, you are seeing profit booking that's coming in today's session as well. Bharti Airtel trading under pressure, and this is after the TRAI data yesterday. ICICI Bank also, after posting a strong set of numbers, is seeing some bit of profit booking in terms of today's session. So that's with regards to where the large cap space goes, Varsha. Interesting is going to be how the broader markets fare from here on.
Yes, absolutely, Hiral. And if I were to talk about Nifty Mid Cap 150, it's almost up 1%, 0.98%. But okay, but let's see who are the contributors when it comes to Mid Cap 150. On the gainers list, you have Dixon Tech, Nippon Life, SJVN, Colgate, and Max Health. Max Health has actually seen a good uptick. The interesting part when it comes to Max Healthcare is company moving towards brownfield capex versus greenfield capex. On the loser side, when it comes to midcap 150, you have Nykaa, KPR Mills, Tata Investment, and CG Power. But interestingly, if you see Nifty small cap 250, it's up almost 1%. And if I were to talk about gainers, you have Alok Industries. Let's see what that counter is doing. This is gaining on the back of Q4 numbers. There you go. The stock is up almost 17% in trade today. You have Asahi India, Apar Industries, and Trident as well when it comes to gainers list in small cap 250. On the losers side though, you have RK Forgings, Just Dial. Yesterday we saw Just Dial giving a fantastic set of numbers. Maybe profit booking over here. You have Signed and you have RBL also when it comes to losers list, as there was a block deal when it comes to Hiral RBL Bank. So these are the stocks which are actually losing when it comes to small cap 250.
I mean, it's an interesting day of trade as well from here on. In fact, let's also welcome in our guest Raghvendra Kedia, founder at Prosperity Advisors. Raghvendra, good afternoon and welcome to the show. Your quick view in terms of what's happening in the markets and taking the way the last 2 to 3 trading sessions have been. Do you think this is a market for the bears or the bulls?
Good afternoon, Hiral. Broadly, we continue to maintain our stand that it will be a seesaw market for the rest of the year, and we would actually see a range-bound play in the overall Nifty. So we had a great rally from 2014 till 2024, and we believe that 2025 and extended till 2026 maybe a time correction in the market. So on the upper side, Nifty 50 could trade at a range of around 24,500, 24,300. So we are on the higher side of the range. So we expect some profit booking, some negative pressure to come in at current levels. And on the lower side, we believe that a broader range of 2,000 points, which could take Nifty down to levels of 22,500, 22,700. So broadly, a range-bound movement in market could continue. And considering we are on the higher side of the range, we believe some profit booking can happen at current levels.
So, I mean, a range-bound market is what is on the cards as per what Raghavendra is mentioning. In fact, Morgan Stanley continues to keep India as its top pick amongst emerging markets. Neeraj has the details of their India strategy report, which he's decoding for all our viewers. Neeraj, over to you.
Since the Indian markets are doing so well, we thought it best to get in some macro note as well. And Morgan Stanley's Ridham Desai and team have put out that India strategy note in which they speak about why India continues to be our top emerging market pick. Now, yeah, this question mark is not needed, but there are a clutch of factors. They haven't bifurcated into it, but I have bifurcated into 3 buckets. So first, cross-asset factors. They say India's low beta is helping it to significantly outperform markets because the world markets or investors have realized that India is a low beta market per se. And weak global markets, the caution though, is that weak global markets can cap absolute returns, but relative returns, India will probably do well. The domestic factors which are at play for this, the strong macro stability with improving terms of trade. And this we can clearly see in a clutch of negotiations that are happening both from a G2G perspective as well as maybe G2B or B2G perspective. Then mid to high teens earnings growth annually over the next 3 to 5 years. We've seen that already. Hopefully we'll see that again because that's a big shot in the arm. The reliable source of domestic risk capital. And viewers, as much as we scoff at it, or if we scoff at it, it's nothing to scoff at. That's a sizable pool of money that is coming in. And remember the HDFC investor, AMC investor con call yesterday, they mentioned that flows are still at 98% of peak, which is substantial in volatile markets like this. And of course, they point out that the dovish RBI, sluggish oil prices, and likely Indo-US trade deal are some of the key domestic factors. And technical factors include persistent retail buying, underpinning India's structural nature of the market. Foreign portfolios positioning is the weakest since we've had data in 2000. And there are early signs, according to Morgan Stanley, that the FI view is shifting and their proprietary sentiment indicator is in the buy zone. So multiple factors why Ridham Desai and team believe that India, as to justify how India is their top investment idea currently.
Well, thank you, Neeraj, for all the details. Well, moving on, let's shift our focus to Himadri Specialty Chemical. Let's see what that counter is doing, because the stock was buzzing. There you go. It has slightly come off. The stock was buzzing in trade today on the back of Q4 numbers that the company has announced. Let's see what those numbers are. Revenue is down almost 3.6%, but EBITDA was up 30% and margins were at 20% versus 15% last year. Now, so the growth that you're seeing, except revenue growth in EBITDA and margin, it's all because the value-added products that they've been selling. So this is a growth which has been led by value-added products. Sales volumes though decreased almost 3% year on year, and the EBITDA margin increase that you're seeing is led by high value specialty products, and net profit growth was led by uptick in EBITDA. And a company is also focusing on capex, though this is not a new news. They are actually expanding when it comes to specialty carbon black expansion. So there's been brownfield expansion of new specialty carbon black line of 70,000 metric tons per annum, and with this they'll increase the total specialty carbon black to 130,000 metric ton per annum. That is doubling of capex, that we are speaking about. And this capacity will be operational by Q3 FY26, and company will also set up a unit to extract, high value added products. So overall, if you see, Himadri has given a good set of numbers, except the volume degrowth that you're seeing, but good uptick in, EBITDA margin. But let me go to Raghavendra. Raghavendra, Himadri Specialty, do you track this? How are you seeing these numbers? Because good uptick, when it comes to EBITDA margin, and everyone in chemical space want company to go into higher value added products.
Good afternoon, Varsha. Broadly, we do like the numbers overall in what Himadri Specialty Chemicals have posted. We would rather prefer to see the glass as half full, where even the revenue degrowth, that is very marginal, of around 3.5% less revenues versus last quarter. But on the silver lining side, we do take what there has been a significant expansion in margins. There has been a significant improvement in EBITDA. And in the coming quarters, what if they continue to maintain margins of 20% with a higher revenue growth? So that will be icing on the cake. So we do believe that at levels of 480, 483, Himadri Specialty Chemical continues to look attractive. We believe a moderate upside of around 15% from current levels for a target of around 560, where how we have reached is again a very moderate earning per share of around 12.5 on a full year basis, giving a P multiple of 45, leads us to a target of 560. So that's a 15% upside in a 1 year investment horizon. So the numbers look attractive. We are happy to see the growth in EBITDA, the growth in margin, and we believe that the revenues, which have been slightly dented this quarter, would pick up significantly in the coming quarters for the stock to reach targets of 550, 560 in the quarters ahead.
550, 560 is what you should be watching out for as well with regards to where Himadri goes. But moving on, Mahindra Logistics, that's an interesting stock to watch out for, because clearly if you see a 52-week high of 554.7 is what that stock has hit in the last 1 year. From there, it's gone down to around 238, so almost halved in terms of in the last 1 year. But now the journey seems to be on an upward trajectory, at least in the last 1 month, where the stock has seen gains of almost around 19 to 20% coming in there. Now, what's happened with the earnings? Because that's what is a trigger for the stock to see gains of 3.5%. If you see in terms of the consolidated numbers, around 8% is the kind of top line growth that we've seen. Margins have also seen an improvement and the losses have reduced. From a quality perspective, the express business is something which continues to be impacted. However, there are some green shoots that are visible in the express segment, and this is mainly on the volume front. The key is going to be sustainability of the express business from here on once the volumes start to improve. Apart from that, there has been a positive surprise in terms of the contracts logistics segment. If you talk about the operational performance, the losses have been there, but the management has said that they're expecting an operational turnaround to come in the second half of FY26. And the focus is going to be on growing the integrated logistics business, and their expansion plan is expected to continue from here on. Overall, if you talk about their expansion as well, in fact, they're developing almost a 1 million square feet across clusters of Kolkata, Pune and Agartala, and that is going to be operational from the first quarter of FY26. I think one of the brokerage firms, that's Nuvama, also has a hold rating on the counter, and if you see in terms of where their target price is concerned, that is at around 325, so pretty much at its target price so far. So that's with regards to where Mahindra Logistics go. Now, the logistics space is going to be interesting, taking into consideration the tariffs as well, because there was a rush in the last couple of weeks. Let me actually check with Raghavendra his view. Raghavendra, your view in terms of Mahindra Logistics and taking into consideration the tariff war, how are you seeing the sector being impacted?
Hiral, we actually studied the quarterly numbers, and we do believe that the stock at current levels of around 315, 320, Mahindra Logistics is fairly priced. The stock is seen to be slightly expensive if you look at the valuation metrics where a full year EPS of around 8, earning per share of 8, and a P multiple of around 40. So that gives us a target of around 320, which is where the stock is currently trading at. There has been the sales growth of the company has been at around 12%, which is not impressive. And if you look at the peer group comparison, it is slightly expensive in terms of the other logistic companies which are available on the listed space. So the current price of 315 or 320 on Mahindra Logistics do not attract us as a buy candidate. We would continue to watch. There has been an appointment of a new managing director. So we will wait how the performance in terms of the massive capex they are doing in the next 2 quarters. But until then, it's an avoid or wait and watch on Mahindra Logistics at current levels of 318.
So wait and watch when it comes to Mahindra Logistics. Well, sticking to earnings impact, Anant Raj and PT Engineering are in focus as well. The stocks are buzzing in trade after posting their Q4 results. Anushi joins us to help us break down the numbers.
Well, first off, I'll start off with PT Engineering. Now, the highlight over here is the revenue growth that we've seen, about a 40% of a growth in terms of the revenue numbers that we are looking at, of course aided by sales volume, which increased 50% on a year-on-year basis. If you talk about the margins, they've also expanded to 17.7% as compared to 15.5% last year. However, net profit, we are looking at a downtick of around 21.5%, but do note that there is an impact led by a lower other income last year. So like interest cost also going up by 36%, another factor as to why we are looking at a downtick in terms of net profit, but margins and revenue growth numbers continue to remain pretty strong. Anant Raj, on the other hand, no complaints here. Revenue, if we are seeing a 22% of a growth number is what we are looking at. Margins were particularly impressive at 26% as compared to 23.6% last year, aided by about a revenue growth of 22%, and EBITDA also seeing about a 36% growth. Net profit saw 52% growth at 119 crore as compared to 78 crore. Of course, a lot of focus now remains on the data center business that the company has, or even the cloud servicing business that the company has, will aid the higher margin business that the company aims to maintain. So focus would remain on that front as well. So 2 results, overall strong set of numbers that we are looking at.
Well, thank you, Anushi. Yes, absolutely good set of numbers by Anant Raj and PT Engineering. Raghavendra, your view on both the stocks, but especially when it comes to Anant Raj, because they are going into data centers and a lot of hype has been created, and that's the reason we have seen a uptick in the stock as well. So, are you tracking Anant Raj?
So, Varsha, Anant Raj, we have been tracking the space of data center, and it's very fancy, if you say. And we don't want to be on the have a FOMO feeling where we have missed out some great opportunities, where though the valuations are slightly discomforting or slightly expensive. But if you see Anant Raj on a standalone basis, the company has a revenue or an earning rate of around 8 rupees on a full year EPS basis. So that still makes it very expensive at P multiples of 60. So if the stock corrects to levels of 430, 440, then it might look attractive. But on the valuation metrics, though the company has come out with a very fantastic, impressive earnings, we do believe that there is some kind of froth in valuation, and a slight price correction of 8 to 10% would make it more attractive. Moving to PT Engineering, the stock currently trades at around 1,000. We do believe that the company has come out with very impressive numbers in terms of revenue, EBITDA, margin expansion. The commentary also is encouraging. So a 20% upside at current levels for a price target of around 1240, 1250 for a 12-month investment horizon is possible in PT Engineering. The stock has corrected in the last 1 year, and this dip plus this fantastic numbers could be taken as an entry level buying opportunity at current levels for PT Engineering at levels of 1020.
Right, so that's with regards to a few of the stocks which have come up with their earnings. But one sector that has been seeing some bit of profit booking in today's session is IT. Now, Macquarie Capital's Ravi Menon spoke to NDTV Profit about the fourth quarter earnings of large cap IT companies, and he told us his stock pick was TCS and explained why. Let's first listen in to a chunk of his conversation.
I think that this has not been, I'd say, as gloomy as people have made it out to be. I think it's been moderately encouraging with North America for TCS actually fairly flat. For Wipro, that's actually grown. So a slight decline, but it's been Infy's results, I think, that have been very disappointing, with North America down about 6%, and very broad-based decline across industries. But I think that's more probably company-specific and their portfolio-specific issues. It's not something that I would say applies to the whole industry. We expect that clients in the US would have deferred some spending, but we are not looking at sharp cuts like we saw early on in the onset of COVID-19. People just want, I think, some certainty, and once they have that, they will start making decisions on spending. And I don't think that we will have a sharp quarter-on-quarter decline. Maybe revenue might be flat, marginally down in Q1, not a sharp decline. That's how I expect Q1 to be.
That's how you expect Q1 to be, but in terms of the guidance that has come from Infosys and from Wipro as well, do you think that IT companies are erring on the side of caution here, Ravi?
To some extent, I think, for Wipro, definitely that's the case. For Infosys, I think where the bookings are, it's actually very similar to what they've done in FY23. And, that year, in FY24, they reported 1.4% CC growth for the full year. And they actually had pass-through revenue as a tailwind that year. This year, as pass-through, they have suggested will be a headwind because they are expecting lower pass-through in FY26. So with that, I think, their guidance may actually, I would say, be realistic. But I think the others might err on the side of caution. And it really is a difficult environment. I would have actually said that, think we could have expected a tougher situation if it hadn't been already for 2 years of steadily trimming what they could cut. So we are in a situation where I think some of what could be thought of as discretionary 2 years back is now become an imperative. You really have to spend this year on some of these projects that have been deferred too long. So I would expect cost takeout projects to bundle with transformation. So larger deals, and I think that doesn't really rule out even some of the mid-cap companies, right? Because even they are now, many of them are over $1 billion in revenue. Someone like an LTM Mindtree, I think, would be a promising challenger. Many of those Persistent, Coforge, or other firms that I think can also play good roles as challenger firms in this.
So that's the view coming in from Ravi Menon of Macquarie on IT as a sector. But one company that will be reporting earnings today is the HCL Tech post-market. As my colleague Puneet is standing by to tell us more. Puneet, what's your expectation from an HCL Tech, taking into consideration how TCS, Infosys and Wipro have fared so far?
Well, thanks for that. It's expected to be a somber quarter again for HCL Tech, similar to the other large cap IT players as well. We're expecting just about a percentage growth in terms of revenue to come in at 30,261 crores, while EBIT margins are expected to fall by roughly 116 basis points to come in at 18.63%. Now, the EBIT margins will be impacted because of a wage hike in this particular quarter, and the profits will subsequently fall by 4% to come in roughly at 4,376 crores. Now, apart from the wage hike in this particular quarter, the product business is also expected to have a very weak quarter and a seasonal weak quarter essentially. Nomura is also expecting in terms of deal wins of about $2 to $2.5 billion in terms of deal wins for HCL Tech in this quarter. When you look at the constant currency growth over the last few quarters, actually Q3 is generally the strongest for the company in the financial year, and that was in the last quarter at 3.8% in terms of constant currency revenue growth on a quarter-on-quarter basis. So we are expecting a quarter-on-quarter fall in terms of revenue, at least on this metric for HCL Tech. Well, on the other hand, in the same time last year for Q4, it was at 0.3%. So we might see some growth there, but the number generally in Q4 for constant currency revenue growth is generally weaker. And finally, in terms of headcount addition as well, and here's the interesting trend. Over the last 8 quarters, the company has actually had negligible to actually negative headcount addition cumulatively over the last 8 quarters. And while the attrition has gotten better from roughly about 19.5% roughly 2 years ago to 16.3% now. Essentially, there's been no headcount addition because of slower revenue growth. And in terms of guidance, the company does report full year guidance expectation. Our brokerages are penciling in 2 to 5% growth in terms of constant currency for HCL Tech for FY26 specifically. It's similar to what was expected out of Infosys as well, but Infosys did report just 0.0 to 3% growth. So I think guidance, commentary as well as the deal wins, these will be the key things that I'll be watching out for in this particular quarter.
Right. Thank you, Puneet, for getting us the details. Raghvendra, your expectation, number one, from HCL Tech that will be reporting numbers today, and from the three IT majors which have reported their quarterly results, which have been slightly on the weaker side in terms of expectations, and the outlook is remaining absolutely weak. How would you look at the space? Do you think you see an opportunity to buy from a long-term perspective?
Hiral, I think you read my mind where I would actually see this as an opportunity to buy for a long-term perspective. Broadly, what has happened to the overall IT space after the reportings of large cap stocks in terms of their earnings for Q4, we can actually say, greater expectations, greater disappointments. So the street was expecting in terms of order wins, in terms of revenue, some great numbers where the companies have posted good numbers, but they might have fallen short of the very high expectations the street was expecting them to deliver. So still, what we would take away is the earnings have been good, the order wins have been moderately fine, and the attrition rate has nothing been on a yellow flag side. So any opportunity on the price correction side could be taken as buying IT space, and we have a preference in terms of large cap IT names in the likes of Infosys, HCL Tech, TCS, and Wipro. And we believe that the global macro, where a US corporate tax reduction would actually make huge orders coming from US corporates to the Indian IT, the strength of US dollar versus the Indian rupee would also augur well for the margins of the IT companies. So it's a buy at current levels for large cap IT names.
Right. With that, viewers, it's time for a break. Don't go anywhere. Stay tuned to NDTV Profit.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
The second buy pick is in Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Markets gain momentum. Nifty hovers around the 24,200 mark. HDFC Bank ITC contributes the most. Sensex nears the 79,600 mark, up 200 points.
All sectors barring Nifty IT and energy trading green. Nifty Metal rises to highest level since April 4. Nifty Realty continues to build gains, top sectorial gainer.
And think again before you head to the jewelry store. Gold prices have crossed 1 lakh rupees per 10 grams.
RBI releases final guidelines on liquidity coverage ratio. Banks are now required to set aside less funds against retail deposits than anticipated.
Also on the show, the biggest banking turnaround story in India. How ICICI Bank's Sandeep Bakshi steered the ship to growth. Welcome back. You're watching Profit Buzzers. Let's quickly take a look at what markets are doing at 1 p.m. as we speak. Right now, the uptrend does continue. Let's pull up Nifty 50 as well as Bank Nifty, post that on the screens. You did see a strong move on that front. There you go, 0.2%, but some cooling off has continued as we were talking at 12:30 as well. 24,179 is what you're tracking. Let's pull up Bank Nifty. That's the Bank Nifty. It's private banking space as well as the PSU Bank Index. There you go. Again, that index is cooling off, but you're seeing gains of around 0.8% coming in there. So clear outperformance coming in from the BFSI space as compared to what Nifty 50 is doing. Broader markets, if we can have the mid cap and the small cap index on the screens as well to understand the kind of performance, that outperformance has continued. It has remained absolutely stable in terms of today's session. If you talk about the mid cap index, as well as let's look at the small cap 250 as well. There you go. 1%, a marginal dip, but absolute steady moves on that front. Overall, in terms of stock specific action as well, let's just pull up the top gainers on Nifty 50 as well as what's losing at this hour, because interesting names, if we can get that heat map. There you go, HDFC, ITC, SBI, Kotak. So ITC is again trying to climb the ladder. And on the downtake, if you talk about stocks like Infosys, Bharti Airtel, ICICI Bank and Power Grid. So these are the names that we have been watching out for in terms of today's session. We have Raghavendra, who is with us on the show, who continues. And you have Vinay Rajani from HDFC Securities, who joins in. Vinay, very quickly, in terms of few of the names that are making headlines today, it's the HDFCs of the world which are supporting the markets. And Infosys is the one which is actually pulling us lower. What are charts indicating for both of these names, and what would your call be?
Yeah, so both are in a different territory. IT sector is actually trying to form a bottom and has been struggling a lot, and Bank Nifty is at all-time high. So from the recent low of whatever low which we saw in the Bank Nifty in the month of March, from that level, Bank Nifty has risen by more than 17% and have taken a lead in this market, and financials entirely looking very strong now. The positive news are also coming. So most of the positives are already discounted. The sectors and stocks have already given a very good return. It might happen that for the time being, it may go into the consolidation. But yes, the opportunity can emerge in the sector like IT, which has been struggling. IT index is down by more than 33% from its 52-week and all-time high. So once we see results coming out from most of the large cap segment in the IT space, there could be a bounce back in that particular sector also, because the way market is going, the sector rotation could happen, and the stocks and sectors which have seen a healthy correction can see a strong bounce back. So yes, IT can reverse the trend in results season. We saw in the history that the trend changes due to the results, and already negatives have been discounted. So it might happen that for the time being, IT takes a lead from here. So pullback is expected in the IT sector, while small profit booking we can expect in the banking and finance sector.
Right. But moving on, 361 is now in the news. The wealth management firm has approved an exclusive collaboration with UBS. Harsh joins us with more on that.
Yeah, so I'll break this deal into three parts for ease. First is there's going to be a strategic collaboration between both entities where clients of UBS AG, which is the which is the Swiss giant, will also enjoy the advisory which 361 provides, and 361's client clients will enjoy services which UBS AG provides. So that's the one big synergy which will play out. The second piece is with regard to how will UBS AG benefit from 360 ONE and its growth in India. And that is going to happen through a 2100 crore infusion of convertible securities which UBS is going to purchase from 360 ONE. So 360 ONE is going to issue these securities to UBS at a deal value of roughly 40,000 crore post pre-money and around 42,000 crore post-money. So they will own around 4.95% at the end of this. They will own around 4.95%. UBS AG will own of 360 ONE WAM, which is a listed entity. That's the second piece. The third piece of it is the takeover of the India business of UBS AG, which includes also other businesses which UBS AG has been incubating in India, including stockbroking, distribution, discretionary and non-discretionary, portfolio management. All of that, including the Credit Suisse business of India, which UBS AG owns, will now be hived off to 360 ONE for a consideration of 307 crore. The AUM of this business is around 26,000 crore. So largely a decentish kind of valuation that they've got on this business as well. So it's a three-part consolidated arrangement of sorts which has happened.
Well, thank you, Harsh, for all the details. Raghavendra, let me come to you first. How are you looking this collaboration and considering the valuation into picture?
We believe that as the overall penetration of stock market across the rural India happens, more and more money flows into it. So the overall space of the financial inclusion and the wealth management sector actually could have great quarters and great years ahead for the next 3 to 5 year horizon at least. So 360 ONE WAM is a great play to bet on in terms of the wealth management sector. Specific to this collaboration, we believe that this could actually augur very well for 360 ONE WAM in the quarters ahead, where the global clientele and the global reach of UBS, and which also has Credit Suisse in its offering in terms of the India business is concerned. So 360 ONE can look at it from a collaboration with UBS and as well as Credit Suisse as far as the business is concerned. So we believe that in the next 1 to 2 years, when these collaboration synergies will fructify, this could be a great stock to own, and it could be the best play in the wealth management space to bet on India's growing financial inclusion, wealth management, and rising income levels. So 360 ONE at price levels of 960, 970 is a great stock to own in your core portfolio. And this collaboration just adds to our confidence for a longer term investment horizon.
Right. Well, Vinay, how are the charts looking when it comes to this counter?
So the stock has been trading around its 50 and 200 days moving average. So I'm talking about exponential moving averages. So that level is around 1000. So for last 6 weeks, we can observe that this stock is not able to cross the 1000 mark. So once that is taken out, then we can expect momentum coming back to the counter. The good thing is that the entire sector has been performing very well in recently. In last 3 days, we have seen the capital market theme did very well. So 360 ONE is also has risen from the lower level, but somehow it is facing resistance around 1000 odd level. Once that is taken out, then we can expect it to come back into the momentum zone, bullish momentum zone. So that is a strong resistance. As far as existing positions are concerned, that can be held with a stop loss of 900. So overall, there is an opportunity, but I think if you are a trader, then you should wait for this resistance of 1000 to be taken out, and then you can take a trade on it.
Right, so that's with regards to where 360 ONE goes. So that's going to be an interesting stock to watch out for as well from the acquisition perspective. But moving on, everything that glitters is not gold. It's only gold that is glittering right now because you've hit the 1 lakh per 10 gram mark. What's interesting from here on is whether this is a time to still buy. Are you going to see further upside, or is this the time to stay put? Is the question. Joining us on the show is Kishore Narne, Director, Head Commodity and Currency at Motilal Oswal Financial Services. Kishore, good afternoon and welcome to the show. My first question coming to you is, 1 lakh per 10 grams. What is this telling you with regards to the story with gold? Because, you know, the average anticipation is that gold and markets always have an inverse relationship. Multiple times where this has gone wrong.
Yeah, good morning. I think this relationship between markets and gold has disconnected almost a decade ago, actually. Post Lehman crisis and post European crisis, I think when liquidity was the primary driver for most of the asset classes, so all the asset classes tend to lose these correlations between each other, and the historical correlations are no more applicable. So coming to the current situation, uh, uh, I think the world is looking for safety across the board, and the primary safe haven for the world at any crisis has been the dollar for quite some time. And when the confidence in dollar itself is shaken, the only alternative at this point of time available as a safe haven asset is gold. So there is no other safe haven at this point of time. Probably some of the Asian countries have Japanese yen still commanding that position, but as investors and funds stumble for safe havens, the only available instrument today is gold. So that's what is getting reflected in prices. Uh, the surprising factor is the speed, but not the direction. Direction has been predicted for quite some time. We've been bullish on gold for quite some time. We still remain bullish even at these levels, not ruling out any corrections, but at the same time, the direction towards 4,000 is on in dollar terms, which will take Indian prices close to around 1 lakh 20, 1 lakh 25,000, depending on where the rupee stands. So the direction remains the same. The surprising factor is the speed at which the gold is moving right now, which is showing the panic in the global market. Panic if the global leader in the asset classes, which is the dollar, has been questioned. So that's what is getting reflected in the price.
Right. Kishore, hi, welcome to the show. Varsha this side. So now you said that you being bullish on gold. Now, can new money be invested? Because every time we hear that, buy gold on dips, but that dip never comes.
Varsha, I think dips keep coming, so people miss the dips quite a bit, because when the dip comes, people actually turn bearish. That's applicable for most of the asset classes, including equities. Also, when actual dips comes, people run away from those dips. The problem is always at an all-time high. People tend to see that should I be investing my new money into this? Of course, it has to be done with a word of caution. There is absolutely a high possibility that you can see corrections ranging from 5 to 10% at any point of time. The kind of volatility we are seeing in the markets, across the markets, not only gold, but across the markets, the volatility is significantly higher. So 5-10% move here and there should not shake you up. So if you are that kind of an investor who are looking for 18 to 24 months in time frame, I don't think it is too risky. But of course, you should be putting a part of your new money and waiting for a dip. Probably tactically it should come at some point of time. So that's where you should grab more. But but gold is not a new investment. Every time all the asset managers, all the wealth managers suggest you should have gold in your portfolio. The range of that allocation can range from 15 to 15%, so 5 to 15%, 20%, depending on your age and risk profile, etc., etc. So the money which already you have in gold, just sit tight on that. That's what we are saying. Hold on to your investments, hold on to gold. New money, absolutely you have to start with caution.
You know, interesting point. Hold on, everyone understands. New money is what is actually wanting to find its way in terms of investments. So if you say that there is a possibility of a near-term dip that could be coming in, and if you're saying tread with caution, what are those levels one should be watching out for in terms of making their investments?
Rather than levels, I will be seeing that what triggers which should trigger this correction. So if there is any turnaround in Trump's policy, either even in the softness of the policy, or if there are negotiations with China, So if China and US comes on the table and start talking, I think that will trigger this correction. So the corrections could range from 5 to 7%, 8%. So 5% is something around 4,000, 5,000 rupees at current levels. So the worst come possibility is around 80 to 83,000 levels, which is right around 10, 15,000. Which is 10% from here. 10% will bring you to 82,000. But anticipation of this dip, before that, if it goes to 110,000 and then from there it falls by 10,000, you'll be at the same levels. So I don't really have any clue whether Trump will call for trade talks or what kind of this news flow happens tomorrow or day after or maybe in the short term. So that's what the ambiguity of this market is today. But the direction remains bullish. So you may get or you may not get the corrections. But the trigger for the correction is any softness or turnaround in the policy, which I am not predicting at this point of time. I'm not anticipating any softness in the policy. And whatever happened between Powell and Trump is also triggering more and more agitated markets. So I think the turnaround is not visible. If it happens, there will be a correction.
Got it. Well, Kishore, so one more question on when it comes to gold ETFs. What's your view on that?
It's absolutely same. It's just an instrument. So view on gold is and ETF is absolutely same.
And also, silver is also at, near 12-year high. So now gold versus silver, where the opportunity lies?
See, for the last couple of years, most of the analysts have been predicting silver has been underperforming. It has to do a catch up. Silver is more bullish than gold. But unfortunately, these two are paired together. Traditionally, they are two precious metals. But off late, especially last decade or so, silver has leaned slightly more towards an industrial metal than a precious metal. And the concentration of value in gold, as the gold increases its value more and more, the ability and ease of holding large amount of wealth in the form of gold and the protection it offers to your purchasing power cannot be done by silver at the same time. And silver's lineage into the non-ferrous and industrial metal side actually also triggers some kind of weakness, because as we anticipate, there could be US triggered recession, slowdown. China also could suffer from that. And so global growth is going to slow down. In that case, if the industrial growth is going to slow down, the industrial metals will be suffering from that. And silver can actually take a hit from that. So that's why silver continue to be an underperformer at this point of time. I don't see a big turnaround at this point of time in that equation. So gold will be a front runner in both of these metals, but silver is not far behind, but will be an underperformer. If the economy turns around, silver will outperform gold. So the thing is, if the industrial growth and global economy does well, silver will beat gold. But if the global economy growth is at the question, so then the gold will be a preferred metal.
Right, so gold could be a preferred metal as well from here on. So that's an interesting take with regards to what could be in store for gold and silver. Thank you, Kishore, so much for joining us on the show and sharing your views. So that's a quick conversation that we've had on gold. Vinay, just a quick question. If you're tracking the charts in terms of gold and silver, what are your levels indicating?
So basically, going by the international US gold in 2022, international gold, US gold was placed at 1600. Now it is around 3500. So gone double in 2.5 years. So significant returns have been generated by this asset class. And I think this is into the breakout was there when it crossed the 2050 odd level. $2050. So that was a breakout level, multi-month high, multi-top breakout was there in the gold when it crossed $2050 in the year 2023. And after that, we have seen that it has reached to $3,500. So after breakout, it has gone up like anything. And now it is into an overbought scenario. I don't think this is the right time to invest into gold. Whatever negatives were to come, it has already come out. The tariff wars, which was announced on in the beginning of the April, it has already been discounted. So in the smart investors has been actually accumulating gold since mid 2022 in anticipation that this can happen, this uncertainty in the economy may emerge in the future time, and that has already been it has already been discounted now. So I don't think this is right time to invest in gold. One should wait for the major corrections, then only one should look into it. And as far as silver is concerned, yes, silver as an industrial metal, I see some opportunity. The ratio charts are suggesting that the silver should outperform the gold from here, being a part of industrial metal also. So I am of the opinion that silver ETFs and silver as a asset class can be a right place to start investing, and accumulating ETFs is the right strategy for the investment in the commodities.
Right, so that's with regards to where a technical view coming in on silver as well as gold. But moving on, we did have a conversation with regards to how the global tariff tussle could impact the textile sector. We spoke to Pearl Global. Now, Mika standing by to give us the key takeaways from this conversation. Mika, over to you.
We spoke to Pearl Global Industries on mainly two things. The first one was whether the Indian textile industry sets to gain from the US-China trade war. The management did say that the US is looking at other sources after extra tariffs on China, and India is seeing inquiries from US importers for textiles. However, Indian industry may not gain a lot from the US-China tariff war because China's better alternatives are Indonesia, Cambodia and Vietnam versus India for something like a US. And India will face problems in matching the costs with China. The shortcomings are mainly because we as a country do not manufacture all kinds of textile because we do not have sufficient raw material flow for all the textiles. However, he didn't wash away any kind of hope. Cotton garments is a space that we could see a leg up in amid this China-US tariff war. And lastly, we also spoke about the India-UK proposed free trade agreement and how it could benefit India. Pearl Global Industries management said that it would help make India competitive with the other countries. It would lead to us gaining more business. The FTA would do away with the 9.6% tariffs that UK currently charges on Indian cotton, making us more competitive, and it could also bring an immediate 10% EBITDA bump for companies exporting in the UK.
Right. Thank you, Mihika, for all the details. I would like to thank Raghavendra and Vinay for joining us on this show. Thank you. And viewers, it's time to wrap this show. Stay tuned to NDTV Profit.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
The second buy pick is in Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture?
Hello and welcome. You're watching Top Trades on NDTV Profit with me, Somit Sarkar. Well, sixth consecutive day of gains on Nifty we are seeing. Today we are up just 66 points, but it has been the sixth consecutive session. And the FNO stocks is Dixon Tech, which has been gaining the most. It's up 6%, followed by IFL Finance, Max Healthcare, both up more than 5% in trade. Phoenix Mill, Colgate on the back of the UBS upgrade. The stock is also up 4% in trade. Mahanagar Gas is perking up in trade. It's up around 4%, trading around the 1,350 level. On the cash side, if you look at it, it's Raj Ratan Global Wire, which has hit an upper circuit of 20% on the back of strong set of numbers. Electronic Marts India is also buzzing in trade. It's up around 12%. On the losing side in FNO stocks, it's Cholamandalam Investment, which is down around 4% after the CLA said downgrade to hold rating from outperform, but they have hiked the target price to around 1,600 rupees or 1,700 rupees from 1,600. IndusInd Bank is down 4%, Nykaa down 2%, Cyient, Infosys, Power Grid down anywhere between 2 to 2.5% in trade that we are looking at currently. When you look at the sectoral indices that have been buzzing, in fact, it's the Nifty IT index, the only sectoral index which is in red, down around 0.4%. Apart from that, all other sectoral indices are trading in green. The highest gains is something that we are seeing on the Nifty Realty Index, that is up around 2.5%, followed by the Nifty PSU Bank Index, which is up around 1.7% in trade. Nifty FMCG again up around 1.5% on the back of the UBS note, which has come in. Let's also welcome in Mahesh Ojha, AVP Research and Business Development, Hensec Securities. So firstly, coming to you, the Nifty IT Index, after 4 straight days of gain, we are seeing some kind of breather when it comes to the IT Index. How are you looking at the overall IT sector currently?
I think the IT sector is currently fundamentally valuation is good, but some upside potential is kept. So we will see some moderate profit booking on a higher level. So I think it's a good buy, but the IT sector needs some positive trigger for upward side momentum. But still, it's a lower consolidation type. So on higher level, we will see some profit booking also. After some in lower level, we can see some buying opportunity. But on 5 to 7% or for 5 to 8%, if any high, then we will see some profit booking. So that kind of scenario in IT sector. So I think that's a part. Currently, we will see some more consolidation in IT sector as well.
Right, and when it comes to the FMCG space, we are seeing a lot of big moves. In fact, Colgate is up around 4.5%. At one point, it was up around 5% in trade. Anything that looks interesting when it comes to the FMCG sector?
Particularly Colgate, we have earlier suggested our client for 2-3 days back that buying opportunity in Colgate. We are seeing some more upside up to 2,800 level in Colgate. So Colgate was preferred in our peak also. So Colgate is still we are bullish on Colgate. We can see some more upside 2,700 to 2,800 level in Colgate. So Colgate is preferred.
Right. The Reserve Bank of India unveils
eased liquidity framework. Let's get in Shubhana with more details on the same.
So banks are actually required to set aside less funds as against their retail deposits, what they had anticipated earlier in the draft guidelines by the Reserve Bank of India. So in the final guidelines, what RBI is saying is that banks must set aside additional runoff factor of 2.5% of for their internet and mobile banking enabled retail deposits. In the previous guidelines, what the RBI has said that the runoff factor would be 5%. So back then, a lot of banks had come out and said that this would impact their NIMs. So this would be a breather for banks now. And the draft guidelines had also proposed differentiating between stable and less stable deposits. But the newer, the final guidelines propose a more flat structure. And what we're also expecting from the new guidelines is that it will improve banks' resilience. And what RBI is saying that they have come out with these guidelines based on the data what banks have submitted to the RBI as on December end 2024. And based on that, the RBI is saying that the LCR, which is the liquidity coverage ratio of banks, could improve by 6 percentage points. And what the RBI is also saying that the new LCR norms will align with global standards, and it will be in a non-disruptive manner, given that they have given the banks enough time to comply with these norms. Additionally, what the RBI is also saying that funding from non-financial institutions like trusts and other partnerships, that runoff factor would come down to 40% as compared to 100%.
Mahesh, on this easing of LCR that we are seeing, which bank as per you stands to benefit the most?
Definitely, if these guidelines come from the RBI in line with their earlier steps, so I think it's a good step. And from this step, we can see some more liquidity improvement in the sector. From our specific larger bank like HDFC, SBI will get much more benefit. And if you see which bank have a more trust deposit, they will get more benefit. So from my perspective, SBI and HDFC, ICICI will get more benefit from these steps. And if you see some more other banks, that can be more benefit from their perspective, like RBL and also.
Right, now we are now joined by Nitin Agarwal, the Senior Group VP and Head of BFSI, to talk more about this LCR issue. Apart from that, we'll also discuss more about his report, the recent report that he has come in with. The recent, so firstly to start off with the recent LCR guidelines that have come in, how do you see that benefiting the banks? The RBI and government are already addressing the liquidity issues in the market, plus this ensures liquidity beyond FY26 as well, right?
So the new guidelines that will be effective from 1st April 26, RBI has announced a runoff factor which is lower than what was there in the proposed draft guidelines. And to that extent, alongside RBI has also reduced the runoff factor on certain wholesale deposits. So the RBI has indicated that it will result in a 6% increase in LCR for the system. And many banks, especially the ones who are having a relatively lower share of retail deposits, and a higher reliance on wholesale, will go on to benefit actually from this. So the liquidity situation, which is nevertheless already improved, supported by the multiple regulatory actions, I think as now the system transitions to the revised LCR framework, it will improve further, and that will ease out the funding pressures and the liquidity pressures that the banking system has faced, and will eventually reflect in a better growth and in the margin environment for the banks as such. So it's another measure as such, I will say. And over the last few quarters, we have seen multiple relaxing measures being announced. So it's just a continuation of that.
And so, which banks are best placed here? Any estimates on that front?
I think the banks with a relatively higher share of wholesale deposits, wherein the runoff factor has been reduced to 40%, will go on to benefit more. And so to that extent, I think banks like RBL, AU, IndusInd, IDFC First should see an increase in LCR as the new framework comes into effect from next fiscal.
Right. So now if you look at the BFSI sector overall, we have seen a paradigm transformation. Now going forward, you believe that the next phase will witness a hyper-personalized banking experience driven by AI and decentralized finances. Which BFSI sector company, as per you, is best placed to lead this next phase of transformation?
See, we have already seen a lot of changes happening in the BFSI, and last 5 years in particular, the sector has undergone a complete transformation. And given how the technology is now becoming a key driver of how the sector and the underlying companies are growing their businesses, I think this change is only going to accelerate. Already, we have seen so many fintechs which are touching upon across different realms of BFSI and going on to acquire a sizable customer base. They will be able to better monetize and cross-sell a variety of products and grow their businesses going further. And within the banks, traditional banks, I think the technology has been a big investment area for most banks. And over there, some of the key private names like HDFC Bank and ICICI Bank are right at the front in terms of utilizing the technology to further grow the businesses. So to that extent, I think we believe that the amalgamation of between technology and the business underlying business, which is at the face of it looks very sort of traditional as such, will continue, and it will go to in fact the usage of technology will only increase from here, and banks need to be pretty much positioned to ride this change, which is only going to accelerate from here.
Right. So keeping this in mind, what would be the pecking order here in the BFSI space? Would you prefer PSU banks, private banks, life insurers, general insurers, NBFCs, or the capital market play?
So we have been very stock specific firstly, and over the last few years we have been following that approach, and that's also because the earnings trend for the sector, if you see, is very divergent. You will look at the private banks which are now looking to grow at around 10% for FY26, PSU somewhere in the 5 to 7% earning growth range. But at the same time, there are banks who are doing a lot better. And their ROAs are holding up much better than others, and they are not as much impacted with the asset quality pressures, especially coming in from the unsecured segments. So we believe that over the next few quarters, this performance and the divergence will continue as the trends in earnings and the asset quality will differentiate one bank from the other. And to that extent, we like ICICI, HDFC Bank amongst the top private names. And amongst PSUs, we like SBI. And from the mid-sized names, we like AU Bank. But our overall bias has been more towards NBFCs and non-lending financials, as that's a space which will benefit from the moderation in the rate cuts, which is already on, and we believe that the cycle will continue to ease as RBI does more rate cuts in the coming months and quarters.
All right, sir. And when it comes to the overall BFSI sector, which are those companies where are you expecting, or which companies will lead the earnings growth, say, over the next 2 or 3 years?
I think earnings growth for the banks as such will bottom out in FY26. Last 4 years, we are seeing a one-way deceleration in earnings growth, and FY26 will mark the inflection point. And beyond that, from FY27, you will see a more broad-based recovery in earnings, and wherein we expect the sector earnings to recover back to 14-15% run rate. In FY26, we are still looking at a 10-odd% kind of earnings growth for the banks. And there may be, I think, capital market companies and select NBFCs who will be a beneficiary of this moderation in the rate cycle, which can report better progression in terms of earnings growth.
So for banks, offered if you see, credit growth has slowed down and NIMs were compressed so far. But going forward, what are the key triggers that would lead to solid earnings growth for them?
See, when you started with FY25, there was a complete sort of uncertainty as to what level the asset quality is going to normalize, because right after COVID, between FY21 to 24, the environment was very, very benign. And we did see almost negligible credit costs for many leading banks. And so then when the trend changed in FY25, when one of the private banks reported a very high credit cost right in the first quarter, it was very uncertain as to how and to what level the asset quality pressure will show up. But having seen the 4 quarters of FY25 with the leading banks like ICICI and HDFC Bank reporting very stable trends. I think that concern is now diminishing. Already you have some banks and lenders like SBI Cards who have called out a peak on their credit cost. So to that extent, I think we are now looking at a very calibrated uptick in credit cost versus what we were factoring in earlier, and that will be supportive of the earnings growth. And secondly, as now the funding cost reprices, because some of the banks have already taken a cut on their SAR rates. Now, this is something that was unthinkable until a month or 2 months back. But now banks are able to take that step because the liquidity situation in the system has eased. I think the entire fixation or the scrutiny around the CD ratio has also eased down. And to that extent, banks are able to reliably deliver better growth. And also that is allowing them to reduce deposit rates. So as this now passes through and the deposit portfolio reprices, so maybe from FY27 is some at the time when we think that banks will go to start recovering on the margin line. FY26 is still a year wherein we are expecting NIM pressures to continue, and that is partly one reason why I talked about a 10% earning growth in FY26.
Right, sir. And so when it comes to the MFI space or the small banking finance space, issue related to MFIs have impacted quite a few banking names. Do you see that the worst is now around the corner and things could start improving from here on?
Yes, MFI space, you are right, has impacted a lot of banks, and we have seen even double-digit credit cost in this space for the lenders, many lenders, and I think now under the new guardrails, at least the formation of stress, the forward flows will peak out in the first quarter, and the recognition of that stress will happen possibly over the second quarter also. But I think what is more important is the trend in collection efficiencies on a X-bucket basis. Wherein our view is that right from the second quarter, you will start to see an improvement in collection efficiencies, and therefore the credit cost should start to moderate from the second quarter or latest by the second half. So this year, we are expecting low to mid double-digit kind of growth in MFI by MFI players, alongside an improvement in their operating ROAs. And that will also therefore drive the recovery in the MFI lenders and the underlying banks who are more exposed to MFI.
And so when it comes to the NBFC space, the rate cut cycle, which has already begun, 50 basis points cut, we have already seen 50 basis points more is what the street is expecting to come in. Which NBFC will benefit the most? Vehicle financiers, home financiers, or players like Bajaj Finance?
Our view is that vehicle financiers are best positioned to benefit from the ongoing moderation in the rate cycle, as their asset books are largely fixed rate. And so while the funding costs will reprice depending on how the duration of the borrowing mix is, but overall, from the asset side perspective, which is fixed rate, I think vehicle financiers are best placed. And to that extent, we like Shriram Finance and MMFS to play this moderation in the rate cycle.
And lastly, sir, the life insurance sector, if you look at the fourth quarter numbers for a couple of the guys were pretty much stable. In fact, the FY26 guidance that they have given also looks pretty much strong. But do you think the overhang related to the regulator's decision on bancassurance will continue to weigh on the share prices, or is the worst priced in for the life insurance sector?
I think the sector has been through a lot, and there has been a lot of regulatory changes, but the sector has shown a lot of resilience in adapting to the changes and still delivering a reasonable growth. There is a lot of potential in terms of the growth in the life insurance sector, and as you move forward, you will continue to see the stronger growth coming in some of the traditional businesses, and over there, we continue to like the space. And we believe HDFC Life, SBI Life are best positioned to play the sector.
Right. Thank you, Nitin. Thank you for joining us and giving us your perspective when it comes to the entire BFSI space currently. Well, moving on, auto space is another that has been in focus after Jefferies has come out with this note where they have downgraded their rating on Hero MotoCorp and Bajaj Auto. Let's get in, Puneet, with more details on the same.
I'll try and find some bull cases here as well, because we're seeing this note specifically on the two-wheeler space, downgrades on Bajaj Auto as well as Hero MotoCorp, and it's a trend that was largely based on the sales from December onwards visible in those numbers as well. So Jefferies downgrades Bajaj Auto to a hold from a buy rating earlier. Target price is now 7,500 versus 10,550 earlier. For Hero MotoCorp, the target price has been, it's been downgraded to an underperform rating from a buy earlier. Target price has been cut to 3,200 from over 5,000 rupees earlier. So two big downgrades here, maintaining buy on Eicher Motors as well as TVS in this particular note. Now, three key points that this note says specifically. They are saying that they are cutting two-wheeler industry growth volumes by 6 percentage points in FY26 and 2 percentage points in FY27, while largely seeing a healthy 10% CAGR over FY25 and 28, and that's seen in the premium category as well as for someone like Eicher as well as TVS. The second point that they're making is that the competitive landscape has effectively changed very meaningfully and significantly, with TVS and its domestic market share now at a 18-year high, while for someone like a Hero, their market share in the domestic two-wheeler space is the 20-year low, and hence they are downgrading Hero in this particular note. They've also mentioned that while they're cutting EPS targets by 5 to 11% for something like a Bajaj as well as Hero MotoCorp, they are seeing just some slight pressure for TVS as well, just by 2 to 3 percentage points, but very bullish on Eicher as well, and the target price is hiked to 6,700 for Eicher Motors. So TVS as well as Eicher gets the big thumbs up from Jefferies, while Bajaj and Hero are downgraded going forward as well.
Mahesh, the entire auto space, which is your top pick? Is it the auto OEMs or auto ancillaries? And if in auto OEMs, are you preferring four-wheelers or the two-wheeler manufacturers?
Our preferred pick is TVS Motor. We are optimistic for some more upside. As already explained, TVS is gaining more market share in terms of any other player. So TVS Motor is preferred. We can see some more upside from these levels, 2,850 to 2,900 odd level. And in the auto component, if we are looking for an auto component, then we are optimistic for Minda and Minda Corp. The both counter are in our watch list, and we are tracking the same. Minda, we can see some upside up to 1,150 to 1,200 odd level, and for a Minda Corp, we can see up to 575 to 590 level at least. So three counter are in our top list.
Right. The other big news in trade today was a deal between 361 and UBS. Let's get in Harsh with more details on the same.
Yeah, so I'll break this deal into three parts for ease. First is there's going to be a strategic collaboration between both entities where clients of UBS AG, which is the German, which is the Swiss giant, will also enjoy the advisory which 361 provides, and 361's clients will enjoy services which UBS AG provides. So that's the one big synergy which will play out. The second piece is with regard to how will UBS AG benefit from 361 and its growth in India. And that is going to happen through a 2,100 crore infusion of convertible securities which UBS is going to purchase from 361. So 361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore post pre-money and around 42,000 crore post-money. So they will own around 4.95% at the end of this. They will own around 4.95%. UBS AG will own of 361 WAM, which is a listed entity. That's the second piece. The third piece of it is the takeover of the India business of UBS AG, which includes also other businesses which UBS AG has been incubating in India, including stockbroking, distribution, discretionary and non-discretionary, portfolio management. All of that, including the Credit Suisse business of India, which UBS AG owns, will now be hived off to 361 for a consideration of 307 crore. The AUM of this business is around 26,000 crore. So largely a decentish kind of valuation that they've got on this business as well. So it's a three-part consolidated arrangement of sorts which has happened.
Mahesh, coming to you on this, any view on this transaction that has happened between 361 and UBS?
I think that is this is a good sign for 361, and hope from this transaction customer will enjoy their services both side of customer, and from 361 point of view we can see some upside up to 1150 to 1200 level, and collaboration sounds very good from my point of view.
Right. Thank you, Mahesh. Thank you for joining us and giving us your perspective about the markets and the stocks that we discussed. With that, it's a wrap on this edition of Top Trades on NDTV Profit. Keep watching. Stay tuned.
That's huge. That is a biggie. It's on.
गोल्ड प्लस क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर।
The second buy pick is in Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
To India specifically, I really think India has a fascinating opportunity, because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers. Hello and welcome. You're tuned into India Market Close here on NDTV Profit. I'm Harsh Saita. With me is Neeraj Shah. And let's look at the Nifty 50, how it's playing out intraday. We're up around 0.25% thereabouts, building on the gains of the last 5 trading sessions where we've stuck to the green, which is again a key positive. Let's look at the intraday chart on the Nifty. And there you go, just off the day's highs. And not a very wide band that the Nifty is trading in, just within that 200-180 point kind of band that the Nifty is trading in, and therefore in that sense it's a decentish kind of move that we've seen. Let's look at the heat map as well on the Nifty. Some buzzers here, and HUL and some stocks within that FMCG pack, including a Colgate doing fairly well for themselves, and M&M second day on the trot where it's done well for itself. So those couple of pockets, but the heavyweights within the banking pack continue to dominate. That's been largely the theme which is playing out in markets and continues to play out even today. Slightly less of a zing in terms of the advanced decline and the breadth as yesterday and what we've gotten used to. But nonetheless, the broader market's doing relatively better. So your advanced decline sitting okay-ish in that sense. Definitely a 2.5:1 kind of ratio. So therefore, nothing to complain about per se, because the broader market's largely aiding this advanced decline. Let's zoom into broader markets, see what the Nifty mid-cap and small-cap indices are doing. And surely outperforming the Nifty 50. The Nifty mid-cap index up 1%, Nifty small-cap index also up around 1%-ish thereabouts. So those pockets doing well. Even when you're looking at sectors, maybe plenty of sectors doing well for themselves. Realty and FMCG, couple of pockets doing well. You also have what's not doing well is an IT, maybe slightly softish kind of a day. Auto metals, after the kind of up move that we saw yesterday, still in the green, but slightly more tempered move of sorts from both of those. The Nifty Bank also holding decently well within this entire basket. So overall, it's a good day. The PSU banks have really come and taken center stage. In fact, if we can pull up the Nifty PSU banking chart for the intraday chart on the Nifty PSU bank, as well as maybe over the last 5 days, we've seen a good move from the Nifty PSU banks. Of course, from the highs, we're slightly off. We were up 2% plus on this index, but we're slightly off. But there are plenty of movers within broader markets as well. Neeraj, something like a KFin Tech, something like an Alok Industries on the back of numbers, plenty of movers, right? Even though it's not evident from the get-go that there are big ones.
Yeah, but 1% for the small cap 250 kind of lays out that point, Harsh. Interesting movers for sure. Sugar as a bucket has done really well. So Bajaj Hindustan, Balrampur Chini. I wonder if Renuka and the likes also are up in trade, but those two clearly were doing very well. A bit of a spike. I wonder if there is news here, but 4% up for Bajaj Hindustan. Balrampur, another 4.5% too. Renuka should come up on your screen. Maybe it's a UP-based thing, or maybe it is the broader sugar move. No, all the sugar stocks are doing rather well for themselves, so that's a bucket. Rajratan Global, Varsha spoke about it extensively, up about 20% in trade. Now for a better part of the day has been up in trade. Tilaknagar Industries, another one which is actually up about 12%, 12.5%. I wonder if HG Infra had a reaction to the battery energy storage system plans that it spoke about. Started off well, has cooled off a little bit. What's not done well? GNA Axle, Chola Financials, Sangvi Movers are amongst the stocks that have looked wobbly. Fusion Micro is down to the 4% too, as is RK Forgings, by the way. So some of the auto anchs are not necessarily having the best of mornings. So that's the other thing to keep in mind. But broadly, on an all cap index, much better advanced decline ratio, and that should augur well. Kush Bora, founder of kushbora.com, with us on the show to talk about the technicals. Kush, thanks for joining in. And for people who do not have a position, all right, what should they do on any of the key indices, the Nifty or the Nifty Bank? Can they trade it at the current levels?
Hi, Neeraj. First up, a very good afternoon. And as I've been saying for the last few days, that if you don't have a position, wait for the dip. I'll go one step ahead today and say if you don't have a position, it might not be a bad idea to either go short on Bank Nifty or perhaps even Nifty, but the Bank Nifty for that matter, or go ahead and take a put option for the current expiry. We are seeing overstretched levels on Bank Nifty as I've been speaking, at least on the very short-term time frames on the hourly charts. And the first crack is starting to appear where we are starting to see negative divergences. It's just that the PCR, is hovering around that 1.1, 1.5 mark, hasn't hit the overbought territory of 1.3. Also, if you look at the VWAPs, both the Nifty and the Bank Nifty are dearly holding on to the, intraday VWAP. That's how we usually calculate VWAP. So it's been holding on to the VWAP for the most part of the day, and hence, you're not seeing that big crack appear. But it looks like it'll probably be a matter of time before some sort of profit booking comes in. Also, perhaps this is the expiry week, and hence, we're not seeing a major reaction to the global parameters as we've seen in the recent past. And if it's the expiry day or the expiry, or we're fairly close to the expiry week, this week being the monthly expiry also for both the indices, we don't have such a strong alignment to the global indices. But once that comes to pass, once that is over, you do see, that catch-up trade happening. So if it happens, with the expiry or, before the expiry or after is anyone's guess, but it's not a bad idea to perhaps, consider a short position. Long at these levels from a risk-reward standpoint just doesn't cut it.
And you've been saying this, in fact, you said this yesterday as well, Coach, and therefore, I wonder, would you reckon that what is the downside risk to what you're likely saying? Is there still maybe a bit of more upside to go possibly before some of those downsides could play out, especially on the Nifty Bank, because you seem more bearish in that pocket?
No, great question, Harsh. In fact, let me admit, I've been a little cautious on the Nifty since 23,800, and we're up 400 points from there. Bank Nifty about 54,000. We are up about 1,800 points from there. But you know what? I'm not flustered for a very simple reason. The risk-reward ratio from my a technical standpoint or a trading strategy standpoint just doesn't allow. So it's not that you have to compulsorily go out and take a trade. Also, we did say that if you have a position, then it's not a bad idea to continue to hold on to them. But from a fresh position, you might not want to consider. Also, let's not forget that this is perhaps a liquidity-driven rally. FIIs have been net buyers for the last 4 sessions, and as we're fairly all aware now, and FIIs can also be a momentum chasers, and that's what we are seeing play out. So yes, there is a risk to it that you could see the Nifty stretch another 200 points from here, Bank Nifty another 600-700 points from here. But when the risk reward ratio is not in your favor, I mean, do you still go out and create fresh positions? Maybe if you really want to, but with a very small quantity. I mean, that's the only way if you want to play this trend. As far as I'm concerned, if the risk reward ratio is so unfavorable, I would rather sit out. And as I said, since the first crack is starting to appear, I wouldn't mind a small short trade on Bank Nifty.
Point taken. Kush, one stock in particular that I want your view on before we take your picks. M&M, it's been resilient in trade for the last couple of sessions. What's your take on this one?
Amongst the auto pack, this is the only one we like. I mean, Tata Motors, not so much. Maruti has had its moments, but it tends to fizzle out. But if you're looking at it from, let's say, a 3 to 6 month perspective, it's not a bad idea. From a much smaller time frame, you might want to perhaps look at an accumulation, not a big trading position. The reason being the stocks just crossed the 50-day moving average, and we've seen some pressure emerge around the 2850 to 2900 zone. So once that is in the clear, then you will see the momentum picking up for the stock. But up until then, there's a good possibility that the stock might continue to consolidate and be sideways. But that does give you that margin of safety that you're looking for in a stock like Mahindra and Mahindra. So yes, this is a good time to start accumulating. A positional stop near the 2600 mark, and then you're playing for 3000, perhaps even 3150 kind of levels. So yes, from a positional standpoint, Mahindra and Mahindra at current levels does look interesting.
And your picks for this afternoon, Kush?
Sure, because of that cautious view, I think one short trade has to be in the mix, and what other sector than IT. So Wipro is a short call. We've had it since morning for the levels of 234 and 230 with a stop loss around the 242 mark. And on the long side, you've got Arkin Chemicals. The stocks had a very good run over the last 10 odd sessions on the back of good volumes, 200 moving average taken out yesterday and trading above it today as well. So for levels of 665, 685 with a stop loss at the 625 mark, Arkin Chemicals is long.
Point taken, Kush. Kush, the other pocket that's doing well, and I wonder if you have a slightly different view on this one, is the Nifty PSU banks. Would those at all be different from your view of the Nifty bank per se?
So Harsh, broadly speaking, and if I just take that liberty of painting everything with the same brush, then the idea is that the entire pack has run up quite a bit in a very short span of time, and hence you could see some sort of cooling off. But other than that, I think the entire financial services space, and we've been bullish on the entire financial services space for some time. I think any kind of dip should be taken as an opportunity to accumulate. You can't go and buy Canara Bank, Bank of Baroda, even SBI for that matter at current levels. So maybe a percent or two or a little more of cooling off is when you should consider a long trade on the PSU back as well.
Okay, Dharmesh, thanks for joining in. Just quick word here. I mean, would you be a buyer in banks currently? Fundamentally, the conversation seems to be positive.
Yeah, good afternoon, Neeraj, to Kosh and to all our viewers. Yeah, definitely. I mean, this is a space which is seeing a good swing on the upside, both from trading and investment perspective. And all the macro factors are playing in for the banking space, be it the interest rate cuts, two has happened. Two more are expected. Inflation rate trajectory is down. RBI has changed stance to accommodative, and yesterday also LCR norms, which they revised. I mean, this is draft, which is yet to be implemented. But these things are auguring well, plus the tax benefit has started trickling down. So consumption will definitely is expected to go up on the retail side, maybe through EMIs and all. So my own sense is that traction will be continued, and given a choice, I am more bullish on public sector banking space than private sector banking space. Reason being, if you look at the average growth of the advances in the public sector banking space, that has been better than that of private sector banking space with the same asset quality and more or less stable kind of a NIMS trajectory. Even the deposit rate cuts were faster this time than the lending rate cuts, so that will keep the NIMS intact. And there, I think the catch-up has still to play out. Most of the public sector banks are trading at 0.7, 0.8 times price to book value 1 year forward. And there's an elbow room to go up. So like Bank of India or Bank of Baroda, Canara Bank, PNB looks attractive to me. I am just for avoiding SBI for the time being a large cap in that space. So banking is a space to look forward to for next 2 months. And let's not forget that IMD has come out with a better than expectation monsoon. So above normal monsoon, if all falls into place, this is likely to do well.
Point taken, Dharmesh. We'll switch focus from banking to actually EMS, and big boost for Dixon Tech. Reports suggest Google could shift some production of Pixel from Vietnam to India, which could garner revenue, roughly a revenue opportunity of 9 to 10,000 crore for Dixon Tech. Puneet here to contextualize that for us. 6% move on the stock, Puneet.
Definitely, and if you look at post the tariff impact, the stock was at actually 13,000 odd levels. So it's really boomed in the positive side, and as you rightly mentioned, could be because of some potential production being shifted of the Pixel smartphone from Vietnam and China essentially to India. Now the key aspect is that it is part of the de-risking strategy for Alphabet, which is the parent of Google, in terms of the sourcing of these particular smartphones, and localization of some components for the Google Pixel could also be on the cards. Now Dixon definitely would be a key beneficiary of this particular aspect because they had signed an agreement to make the Google Pixel in India back in December of 2024. Now Dixon has an indirect agreement essentially with Compal, in which they signed in February of 2024 to manufacture these phones in India. They were essentially, of course, to first manufacturing partnership essentially with Compal, and Compal is one of the world's biggest EMS players and leading manufacturer of notebook and as well as smartphones and PCs. So Dixon has a manufacturing agreement with Compal, and with that they can manufacture the phone in India. Now currently the Pixel sells roughly about 1 crore phones that they sold in 2023. So it's a sizable opportunity. If we can contextualize that in terms of revenue, even a 30% shift of production from Vietnam to India would roughly be a 9 to 10,000 crore opportunity, as you rightly said. Nomura is assuming that 60% would go to Dixon, because we also have something like a Foxconn with manufacturers the Pixel in India, but they are anticipating Dixon to be the biggest beneficiary as well, and that's one of the key aspects. So we also spoken to the management a few weeks ago, and they mentioned they're anticipating a 150 basis point margin impact over the next 2 years. So all these signs, baking in very good estimates for Dixon, and I think that's where the market is preempting some of these positive moves, which could be contextualized in this particular results as well.
Interesting. Thanks so much for that, Puneet. Dharmesh, let me come to you right away on that one. This entire EMS basket took a bit of a beating over the last couple of months at the very least. What's the sense like at this point? Risk reward favorable, or do you believe it's stretched?
Yeah, good afternoon, Harsh. I mean, the entire EMS basket has been running on the news flow, the positive news flows surrounding them, and even they have been revenue accretive as well. If you look at Dixon Technology, it's been growing at a CAGR of 30-35% for the last 10 years, and that has been maintainable. So to get this CAGR materialized in the near future as well for next 2-3 years, you have to have this kind of order inflow coming in, be it Google or be it somebody else. So otherwise you can't have the same run rate going on your top line. So I think it's a part of the business model, and they have been doing fairly well. And if you look at the EMS segment, naturally, if you speak to any of the promoters, the maximum growth they can do year on year is 35 to 40% only, because of the capacity constraint and the new technology and everything which has to be put into place. So keeping that in mind, I mean, it's a trade today, it's playing out. It can play out for a couple of days more, but just have in mind it's a low margin business, 4 to 5%. 150 basis point improvement leads to your 5.5% kind of an operating margin. And valuation, it is trading at around 160 times PE multiple. So there has to be, at a point will come when such kind of a justification has to come into play. And this was the valuation concern which had a serious sell down happening. But given the uncertainties which is surrounding the global environment, such news flows for EMS company, at least in the short term, will find bias and the trades are up. From investment perspective, I think new investment should be avoided now.
Okay, that's the view on Dixon. Dharmesh, also wonder if there's a view on some of the auto counters. Something like an M&M has done very well for itself, and you know the overall index too is up now nearly 10% from the recent lows, and therefore would auto at all feature in your bucket, something that you're looking out for?
Yeah, definitely. As a trade, it has come into the buying radar. M&M has been doing well, and that recovery index is more to do with large caps like M&M, Maruti, and Eicher Motors, which has pulled the index up. But there are pockets like two-wheeler segment. Hero and Bajaj Auto, one of the MNC brokers have even downgraded that today. I mean, yesterday they have done that. But to my mind, I think this is a right time to get some accumulation from a trade perspective, at least if you're looking for 3 months kind of a time frame. And the reasons are simple. I mean, you have the tax cut in the budget from April onwards, it will pay in your salary checks. And then you have interest rate cuts. Two has already come. One or two is expected in future. At the same time, you have this monsoon thing coming in, which is likely to be a better off. So I think with rise in disposable income and with tax reliefs happening, people will be consuming because this is the time when the consumption will happen. To there, I think with the valuation correction already happened quite a bit. It's a deep valuation correction which has happened in both Hero and Bajaj Auto. Both of them look attractive, but given a choice, I will play the India theme because it's a marriage season also. East India, North India see a flurry of marriages happening in the month of April, May, and June. So looks attractive to me for say 4100, 4200 kind of a price level Hero MotoCorp. So that is what we have recommended to our clients. I mean, yesterday only we have initiated a buy on that.
Okay. Okay. Dharmesh, rather Kush actually, first to you, a bit of a late last half an hour surge in a different pocket, which is sugar. It's just gone out of any realms of conversation, rightly so maybe, but there's a bit of a spark today in some of those names. Anything worthwhile?
Only Balrampur Chini. This is the one stock that is present in the FNO space, has a fairly decent. It's not in FNO actually anymore. Was for a while now, but has fairly enough decent volumes for you to trade in. So it's clear that 570 resistance mark. The volumes are also up, as you rightly said. The entire sector seems to be doing well, but from a technical standpoint, this is in the clear of a lot of the key averages, be it the small term or long term resistance zone, also taken out after a consolidation of 10-15 odd sessions. So from a momentum perspective, not a bad idea to maybe consider a small position in something like a Balrampur Chini for levels of 610 and about 635. And the 570 resistance will now act as a stop loss, so that should be your support. But that's perhaps the only one. The reason I say a small position is because we know how volatile this entire pack can be, and usually doesn't feature, at least on my radar in terms of calls. So if you must, then Balrampur Chini is the stock that you should stick to.
Okay. Dharmesh, any commodity plays that you are constructive on?
Yeah, not on agri, but on the metal space, yes, and that too on non-ferrous metal. Like though government has come out with a safeguard duty on steel, but to my mind, I think it's the non-metal, I mean non-ferrous space like copper, zinc, aluminum that is going to do well in the current world setup. And there, I think Hindalco looks pretty attractive. So even if there is some recession in the world, you consume more of a food. So Hindalco has an option of supplying cans to all beverage drinkers. So there, the pickup is high. Copper has been doing fairly well in the international market. The prices have been up this year till date. So that is also going to trickle down. And there are a lot of debottling practices have taken place in Hindalco plants in India. So that operating benefit will come out, operating efficiency benefit will come out there. So I think it's a decent quarter they would be reporting this time around, and going forward, it looks attractive to me. So that is one stock which we are keeping a radar on, and maybe 5-10% kind of an trading upside can materialize out there.
And Dharmesh, I'll stick with you with regard to a view on KFin Tech. It's an interesting play within financial services. And what's the sense like? Do you have a view on this counter?
See, Harsh, I have a general view. Any fintech plays which is related to financial sector, so we are completely avoiding those plays. And once one is the valuations are too high, At the same time, there are too many regulatory changes which are about to come by the RBI. So most of their profitability, which is there as of now, which seems likely to materialize in future, won't be there. So I mean, these are just on the guidelines kind of rules are there. Once they are implemented, there would be trouble, and there are many things in the up there in the shaping as well. So as a house, we have taken a call to stay away from all fintech kind of plays out there in the market.
Okay. All right. So that's the view on KFin. Yeah, quickly, Kush, if you can give us a technical view as well on KFin.
Stellar move actually. In the last four sessions, from 1,000 all the way up until 1,275, close to these levels where it is at currently. The volumes on the last three sessions have been staggering. So definitely, some heavy accumulation going on, in this one. Also, it's cleared the resistance, around the 135, 140 mark. So I think this momentum could very well take it higher. From a positional standpoint, I think, you should look at 1350 and about 1420, 1440 as the next target. So not a bad idea to hold this, but from a positional standpoint, a slightly deep stop loss, 1160, that should act as your stop loss. But as I said, all set to clock, the levels of 1400 and higher.
Point taken. So positive, at least on technical indicators, KFin Tech. Now, in terms of the earnings season, well, plenty of movers on the back of the numbers starting to come through. And let's take a look at some of the, at least buzzers on the back of numbers. Varsha here with a couple of them. Varsha.
Thank you for that. Let me start with Mahindra Logistics, wherein if you see the numbers, revenue was up 8.2%. Now this was driven by growth in third-party logistics contract, and if you see EBITDA is up almost 37%. Good uptick in margin, at 5% versus 3.9% last year, and the loss has narrowed down. So the net loss for Q4 FY25 stand around 6.7 crore versus loss of 13 crore last year. Now their supply chain management grew by 8.6%. Enterprise mobility solution remains flat at 80 crore. The B2B express saw volume recovery, and cross-border business continues to see volatility in pricing, and also they've appointed Hemant Sikka as MD and CEO. So the losses are narrowed down. Good uptick when it comes to operational metrics like EBITDA margin. Next on the list is Alok Industries. Well, the stock is up like 18-19%. Now this is on the back of the numbers that they've posted. If you see, revenue is down 35%. There was an EBITDA loss of 23 crore versus profit of 5 crore last year, and the net loss was at 74 crore versus loss of 216 crore last year. Now the net loss that you're seeing, which has narrowed down, this is on the back of good growth in other income.
Okay. Thank you for that perspective, Varsha. Kush, firstly, a quick take with regard to Alok, 18.5%, very strong move.
Yeah, I mean, the trade from a near-term perspective is done on this one. So you might want to wait up, for a correction, let's say close to the 18.5 to about 18.25 thereabouts. And if you do get a dip towards those levels is when you should consider. If you have an existing position, I would in fact suggest, booking partially, at the current level and holding on holding the rest for about 21 kind of levels. But fresh position should only be considered, at any kind of dip towards the 18.25 mark.
Okay. And Dharmesh, with regard to these logistics companies, right? They've had their fair share of headwind, but now given the fact that we're likely seeing some bit of easing with regard to at least global crude prices, which should hopefully also percolate down and impact the numbers of something like a Mahindra Logistics. Stock is down 28% in the last year or so. Even more impacted when I'm looking at it from the 52-week high. Any interest in any of these names, and is there a preference in terms of names as well?
Yeah, Harsh, I mean, hopefully is the right word. So it has not percolated yet. At the same time, they are facing their own headwinds in many ways. So, I mean, there are many segments to a logistic company. One is B2B, then another is B2C. And many of the companies are setting their own logistic systems in place. Mahindra is one of them. And I mean, there's not much juice left here. I mean, the story which started 10 years back, it has not played out to that extent because of the disruptions which has happened in this segment. And that's the reason it can be a trade for a day or two, but I don't think it's a structural, cyclical with creation kind of a buy any out there. Rather, if you have to look at logistic company, I mean, you can look at ports like Adani Port, I think is one of the best place and valuation comfort as well. So if I have to buy for a wealth creation kind of a perspective, I would rather be buying a Adani Port rather than, this logistic companies which are into B2C or B2B supply chain management.
Okay, so probably that's the better play. But thank you so much for that view coming in. You know what we're going to do? We're going to slip into a very short break. On the other side, we'll have, of course, Kush and Dharmesh, both of them still with us, and we'll take more views. We'll also have Heard on the Street. Mind you, we did one yesterday as well, as we do daily, and that one's proved to be right. So we'll discuss that piece a little bit more, and we'll take more views from both Dharmesh and Kush. Stay tuned.
The second buy pick is in Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers. Welcome back onto our special segment, Heard on the Street. Now, this one has become a regular feature of Somit getting it right. So, a couple of calls that have played out today, and correctly so. Last week, the call, Somit, with regard to Colgate and 360 ONE both. Now, a point being that with regard to 360 ONE in particular, it is a big deal, right?
Right. It is a big deal, and more importantly, it's happening at a premium, which means that, in fact, there was this funny thing that was going around on the street that UBS at one point of time had a target of around 1350 on 361, and they're buying this company at 1030 rupees. So yeah, that's the thing that was going around in the market.
Good stuff there, Soumit.
Yeah. Cool, thank you. Okay, in today's stock, if you look at IT's, and select IT name is something that has been interested in dealers. In fact, IT as an index, if you look at it, has been gaining for the last 4 consecutive sessions. Today is only Sectoral index which is down in trade, but few names which dealers are highlighting could see high delivery-based buying in trade today. That's Coforge, Persistent, and Tech Mahindra. Despite the weakness that we're seeing in big names, these 3 stocks have been gaining in trade. Apart from that, IFL Finance, buy flows on DI desk is what the dealers are indicating. In fact, a leading mutual fund has been an active buyer in trade in IFL Finance, and that is one of the reasons why IFL Finance is one of the top gainers in FNO names in trade today. And apart from that, lastly, it comes to Zydus Life and Lupin. Multiple dealing rooms today are giving positional buy calls for both these names, Zydus Life and Lupin. They believe that the worst seems to be priced in for both the counters. Few days back, both of them had seen a sharp fall in their share prices post the adverse ruling that we had seen in the US court related to one of the key drugs. But dealers are indicating that the worst seems to be priced in, and positional buy calls is something that multiple dealing rooms are advising their clients for Zydus Life and Lupin.
Interesting one.
2 specific names, that's interesting.
Yes, and you also have IFL Finance, and then you have IT companies.
Of course, yeah, but on pharma, I'm saying 2 specific names is the interesting one.
Yes, it is. And this is more to do with the fact that you had a drug suspension which happened, right?
Yeah, a few days back we had seen a sharp fall on the back of that one drug issue that had come in. But right now they believe that worst is priced in, and these couple of these stocks could benefit now going forward.
So it's more to do, I believe, with that. Yeah. So let's probably ask Dharmesh. Dharmesh, do you have a view on a Zydus Life and a Lupin?
No, I don't have a view on any of them. But the pharma as a space is a very dicey one as of now. You may be getting news flow day in and day out, and the trading activities may still happen. But I think unless Mr. Unpredictable, that is the US president, he comes out with a policy on pharma, which he has been saying time and again, there is a tariff which will be levied on that. Unless that is out, you cannot take a structural call on the pharma space. Though there are great companies out there, but I think like Arvindo Pharma or in fact Lupin itself is a good company. Sun Pharma is there. So we have our eyes set on there, but we'll trigger a buy or sell only when the clarity is there on the tariff thing, and that's hanging sword as of now.
Okay, I take your point there. And what about an IFL Finance, Dharmesh? Buy flow seen here. Interesting, the stock is also a bit beaten in that sense from the highs. It's come off substantially. Of course, the 6% move, near 6% move today is interesting. What's your take with regard to something like an IFL Finance? In fact, NBFCs in general, Dharmesh, have done well over the last few days, right? So maybe your quick take, is it a good time to buy at this point?
Yeah, definitely. Just get your companies right when you are selecting an NBFC space, because the first beneficiary of any rate cut is the NBFCs, which tend to benefit the most from any rate cut cycle setting in, and we are in for that. And one good thing which has happened for NBFCs is the collection efficiency ratio, which has gone down to 87, 88% for most of them, has shown a good uptick in the month of March and continuing April. It is now up to 92, 93% kind of a thing. So that microfinance kind of a problem, the expectation that it will spill over to other segments has not happened, and there's an improvement out there. So as a basket, it looks good. Just be a bit selective of your choices when it comes to valuation.
And what's the view with regard to IT, Dharmesh? Just tempted to ask because you've got 2 big names which have declared numbers plus given out commentary, and then you have HCL Tech coming out with numbers today. So,
see, to my mind, IT is sell on every rise. Okay. The reasons are very clear, because last 1 year, though there was stock price correction, but I was never a buyer on IT and I have been very vocal about that. Fundamentals have still not turned for IT companies. And see, in the short term, whatever tariff measures has been taken by US, it is the US which is going to suffer the most in the short term. Medium to long term, things may change over a period of time. But in that suffering, our IT exposure is primarily to the US market. 60 to 70% of the revenue comes from there. So how can you expect them to do better when They are still to come up with AI-related product. So too much of a dark cloud right now out there. Avoid it. You may get trading bounces because of some currency movement here and there and some news flow, but it's not a buying sector at all. So one sector which we are totally avoiding for any buying recommendation is the IT space.
Okay. May make sense also. Okay, fair coin. Bucket of stocks which are not doing well despite a lot of calls in the morning, and one of them is Suzlon, the other one is Adani Green. Khushbura, on both of these multiple buy calls are not quite shaping up well today. What would you do here?
So again, yesterday we discussed that Suzlon does
Hitting
look
a supply zone.
Yeah, absolutely. I mean, and it's actually coming back to that level, 15.9, thereabouts. So while it did cross that level yesterday, it hasn't sustained above that. So, you might want to perhaps take some money off the table in Suzlon. Adani Green also, you're right. There is a sideways movement going on, albeit with a positive bias, and there is an ascending triangle formation. So above 990, if the stock manages a close and if the volume support, then I think, you'll see further momentum. But up until then, I would suggest holding on to this one because the bias largely is positive. The stop loss here will be about 925. Versus this, I would rather suggest, an Inox Wind, which is actually, seeing quite a bit of positive momentum. Even today, if you see the stock is actually, recovered quite a bit from, the low point of the day. This one's also coming up to the resistance level of 178, but even that is some distance away. So you might want to consider an Inox, Wind kind of a stock over Suzlon, at least, at this current juncture where Suzlon is starting to see some profit taking.
Okay, so those are some views coming in. But let's get across and talk about our stock of the day. The top stock of the day is Colgate for us. We're focusing in on the counter because there's been some smart moves. Stock up 4% odd. And this is on the back of a UBS upgrade also, which has come through, which we spoke about last week with Somit. So let me put that out of the way. Hiral here with more on that.
Thank you for that. So clearly a UBS upgrade coming in for a Colgate. If you see in terms of their target price increase, they've hiked it to 3,100 from a 2,240, and it's a upgrade, you could call it a double upgrade to a buy from a sell as well. Now let's understand the growth narrative with regards to where Colgate goes. Overall, if you see in terms of the cycle, Colgate has come out from a disruption cycle, and this is with regards to their strategy in the premiumization space. Secondly, they're aggressively shaping up the oral care market as well, and that's specifically to do in the urban market where they are focusing on the premiumization aspect. And that is what has led to a market share reversal. If you see in terms of their market share trends as well, and this is going back to 2014 to 2024 in the last 10 years, from a 53.8% market share that they had in 2014, it actually came down to almost around 42.7% in 2019. And from there on, again, it's on an upcycle where last 2 years, or I would say from 2022 to 2024, it's in that bracket of 42.8% to a 43.4%. So that's with regards to the market share reversal that they're seeing. Now, the other strategy that they have deliberated on is normalizing the EBITDA margins. And what they've said is that they will be normalizing it in that range of around 30 to 31%. So in the fourth quarter of FY24, they did hit a high of almost 36%. But with the premiumization strategy to garner market share in the urban markets, they've clearly come out and said that they will look at margins in that range of around 30 to 31%. Now let's look at the earnings dynamics from here on. Firstly, what UBS has also indicated is that the earnings are at an inflection point. The earnings growth for the next 2 quarters will be negative. However, revival is expected to come in from next year, and a double-digit earnings growth is going to return from the second quarter of FY26. That's the expectation with regards to Colgate. Talking about the valuation story as well, there has been a sharp correction in terms of valuation since October 2024, and current valuations are seeming reasonable as compared to the sector valuations. If you see in terms of the stock price as well, it's seen a drop of almost 30% since October, and it had already risen by around 65% since 2022. So after that 65% rise, a 30% fall, and now the valuations are reasonable. So from here on, a consistent compounding story is what UBS is alluding to. Now, lastly, Few factors what are working from here on. It's the strategy with regards to by rationalizing margins in the 30 to 31% range is what is working. Their volume growth has structurally rebounded as well. The pricing strategy is also shaping up in a premiumization-led volume story. And if you talk from a current valuation perspective, it is within its long-term averages. So factors, all of them firing in favor of Colgate right now.
Yes, 360. And Dharmesh, how do you approach Colgate today? Of course, FMCG by and large has got a fairly big leg up too, per se. A clutch of other stocks are also moving. But Colgate, what's your view here?
Yeah, Neeraj, as far as Colgate is concerned, it does give you a trading opportunity right now. I mean, within the range, it can give you a 7 to 10% kind of upside. The story, I mean, the threat which happened when the Patanjali came into the play, that is no longer there. It is back to its normal, consistent growth story as far as market share is concerned. And valuations are pretty reasonable. If you look at a company which is throwing you an ROE of say 70-75% with 30% plus kind of an operating margin, available at less than 50 P multiple. I mean, this fee for less than 50 P multiple can easily go to 55 to 60 P multiple in the times in which we are trading this market as of now. So you don't know when the adverse news can impact the market, but this stability of consumption is likely to be there with Colgate. So yeah, a decent buy. I mean, just for a seasonal buy for 3 to 6 months, it looks good to me. Say 2,900 or 3,000 kind of a price target level.
Okay, Dharmesh, we'll leave it at that. Thanks much for taking the time out. Really appreciate your time.
Thank you so much.
Okay, metals is okay. I mean, there is a Lloyd's which is doing well, but not every metal name is doing well for itself. But there is a surge in specific pockets. Now, I want to bring up Avalon Technologies. That stock is up 9% in trade. Big surge in trade today. I wonder if there is a specific reason for this to happen or no. But clearly, when we said that some specific tech names, persistent, etc., are getting it, Avalon is a different kettle of fish, of course, but it's gotten a very large move going today. So certainly something to watch out for. Kush Bora, any thoughts here on Avalon after consolidating near 600 at a point of time when the rest of the tech pack has been kind of quiet? This one has given, what, nearly 50% returns from the March lows.
Absolutely, it's an outlier. And even now, if you ask me, I think the momentum is here to stay. There is still a bit of upside left, at least from a trading perspective. So you could still see the stock moving to 950 and about 995 kind of levels, in the coming days. It has still not hit overheated territories. And what's interesting is that after a steady up move over the last 2.5 months, the volumes today have spiked up. So yeah, I mean, for all the money, there could be a trigger or a news that might just perhaps come out. But as I said, even from a near to medium term perspective, 950, 995 moves cannot be ruled out. Keep a strict stop loss near the 860 mark.
Got it. Okay. Kush, quick word. If any of the metal names excite you, steel in particular.
The one that does, I mean, from metals, overall is the one that you've already mentioned, Lloyd Metals. In fact, if I'm not mistaken, the last quarter, this has also seen some, uptake in terms of the FII buying as well. Price moves have also been very encouraging. Right now, it's coming up close to the resistance of 1350. But I suppose once that is taken out, 1400, 1450 odd levels are very much on the cards. So Lloyd's has definitely been on our radar for some time. We've initiated a couple of calls, a couple of times, calls on Lloyd's Metal as well. The other one that is looking good is Jindal Steel and Power. If you look at it, the move has been quite contrary to what the rest of the sector has done. In the last couple of days, it's taken out all the key averages, be it the near or the medium term ones. So this move could well continue for levels of 935 and 960. And the stop loss comes in at about the 890 mark. So Lloyd's Metal and Jindal Steel and Power, these are the two that I have on my radar.
Well, and metal certainly in focus, but steel in particular. A positive development that has happened is that India has imposed 12% safeguard duty on steel imports. Duty's been the talk of town since last year. and the 12% number was first recommended in March this year. We are now joined by Mr. Sandeep Pondrik. He's Secretary, Ministry of Steel, to give us his view on all the developments. Sir, thanks so much for taking the time out. Is this the first or the second of the many moves that the country would keep on doing in order to quote-unquote safeguard the domestic steel industry?
So yes, as you know that this is a provisional safeguard duty. DGTR had recommended provisional safeguard duty of 12%. So government has accepted that recommendation and Ministry of Finance has notified that yesterday. Now DGTR will finalize its investigation, hear all parties and give its final recommendations approximately around August, I would expect. So then government will take a final decision both on the period of duty, that is how long they will be in place, and secondly on the rate of the duty. So this is a provisional decision for 200 days. After the DGTR's final recommendation, government will take appropriate decision on safeguard duty.
It's 12% numbers, sir. I mean, since morning we've been speaking to people and there have been debates about the number. So is this 12% a factor of the pricing differential that exists, which I presume was about 18%? So how has this number been arrived at, sir?
So basically the industry, the steel industries, they represent before the DGTR about the injury being caused by low cost imports and dumping. DGTR takes that data into consideration, makes an investigation, and then basically arrives at a number in which, in its opinion, is adequate to safeguard the interest of the domestic industry. DGTR has provisionally found it to be 12% based on whatever data was presented before it by the industry as well as whatever data DGTR has. If certain new data is presented or certain new facts come into consideration, then DGTR can take that into account while giving its final recommendation. We also have to see that steel is basically not an end product mostly. It's used as an input to end products. So that also government has to balance that the cost of end products also remains reasonable while simultaneously protecting the domestic industry against low cost dumping. So it's a balancing act for the overall economy.
Mr. Pondrik, this is Harsh also joining in. What's the take like with everything evolving globally? Because there's plenty of moving parts. Especially from China, because a lot of this will depend on how China responds with regard to everything that's happening. What's your quick take with regard to the impact of the global situation?
So basically, I will only talk about the steel sector. Out of about 1.8 billion ton capacity in the world, 1.1 billion ton is with China. India is at number 2 with 200 million tons roughly. So yes, the Chinese exports or cost of their exports impacts the international market. What we have seen in the last year is that of the 9 million tons imported into the country, steel imports, 3 major countries were contributing the most: China, Korea, and Japan. So if because of the international situation, the international prices of steel go down further because of excess production or other reasons, then it will have an impact on imports in India too. And I'm sure that when the DGTR makes its final investigation, they will take that into account if there are any changes in the situation. For now, I would think that the present duty seems reasonable for the domestic industry.
Got it. My final question, sir. If indeed this tariff war stays the way it does, and if indeed the exports of some of our neighboring countries and otherwise to US or the other end consuming countries, which were the top consumers in the past, doesn't quite happen in the same way, there might be more supplies that might be exported / dumped into our markets and other markets too. So are we open to adding substantial other forms of duties as well in the ensuing next 6 to 9 odd months, if need be? Is that a consideration?
I would say that so one safeguard duty, which is on all imports, irrespective of from where the steel is coming, so that has already been imposed. There is second, which is a basic custom duty of 7.5%. That's already in place. It doesn't apply to countries with which we have free trade agreements. So about 60% of imports are from FTA route, so it doesn't apply to that. Third is basically if from some countries low cost steel is being sent to India. Certain anti-dumping investigations are in place. 2 investigations, the DGTR is the hearing has been completed, so they are almost at the final stage. One is for hot rolled coil from Vietnam. The other is one more steel grade from 2 countries. So there the government will basically DGTR recommendations. Let us wait for what the anti-dumping investigations lead to. There are 2-3 types of steels where anti-dumping duties and countervailing duties are already in place for specific countries. So that is one. I think another thing which government is trying to ensure is that we do not get low quality steel. So while cost is one parameter, other thing which the country has to ensure is that because we are ensuring that domestic steel adheres to BIS standards, we would also want to ensure that whatever is imported is of BIS standards. So that's another way to discourage low quality imports into the country from certain countries. So these are all the measures being taken by government to ensure that only quality steel is produced or imported, and second, that domestic steel industry, especially in view of the fact that we are the only major economy where double-digit consumption growth is taking place for last few years, and we need to add another 100 million tons of capacity in next 5 to 6 years. So that will basically need capital from the industry, and for that we will have to ensure that they get a level playing field on the international market.
Points well noted, Mr. Pondrick. Thank you so much, sir, for joining in today and giving us the perspective.
Okay, thank you so much.
That's, a proactive sounding Steel Secretary talking about all the measures that have been taken and could be taken in the future as well in order to help the domestic industry, capex plans and more. And the steel stocks have had a fairly decent start, but since then, SAIL and some of the others have certainly cooled off for sure. We took a view on metals, so we'll skip that. Move on to the next topic, and that's Hero MotoCorp. It's in spotlight as the stock has corrected after brokerage from Jefferies downgraded it and cut the target price by up to 37%. Now, Puneet Johnson to talk about the bull versus bear case for Hero Moto. Puneet.
Well, thanks for that. Definitely the key trigger today was the Jefferies note that's taking just the sting out of the stock today. And the key aspect is, what they are penciling in is essentially they've downgraded the stock to an underperform rating from a buy earlier, target price now at roughly about 3,200 from 5,075 earlier. Now the key aspect, is slowing domestic sales for the company, and that is one of the key aspects. They've also cut the EPS target by 5 to 11% for Hero MotoCorp in FY26 and anticipating a slower growth in this year. While on the bull side, currently the valuations are just 15 times price to earning for FY26, the lowest it has been in the last 5 years, and hence it could be a very interesting opportunity going forward as well. The second bull and bear case for Hero MotoCorp, we have seen that the company has launched multiple premium motorcycles in the 200cc range, as well as the new scooter, which is the Zoom 125. The 160 is also on the way, so they're increasing the premium share, which should help revenue growth as well as margins going forward. But the market share of the company currently is at a 20-year low in the domestic two-wheeler space, and exports is a very small percentage for Hero, so it has nowhere to hide in terms of outperformance, and the company's sales growth essentially has been very low. So if you look at the third and final bull and bear case for the company, it's posted the slowest sales of just 4.9% amongst the other 4 listed peers. The highest was for Eicher Motors at 13% for last year, so it's a huge differential in terms of growth. We mentioned the valuation for Hero in terms of comparison. Bajaj is at 23 times price to earnings for FY26. Something like TVS is over 37 times. But I think this will be driven essentially by the growth prospects for something like a Hero. We're seeing the scooter segment is doing better than the bike segment, and hence that is also weighing in on Hero. So essentially there's nowhere to hide for the company, but currently Jefferies downgraded the stock today in trade today.
Okay, thank you so much for that very comprehensive view, Puneet. Kush, quick take with regard to a Hero.
Well, the stock's actually corrected quite sharply, 78.6% retracement. Actually, it's taken support there and it's attempting a revival. Compared to the peers, this doesn't stand pretty. So, if I were to pick, then I would actually go with something like an Eicher Motor or a TVS. Hero would perhaps rank third just above Bajaj Auto. So that's where you are. But if you have a 6-12 month kind of a horizon, with a stop loss around the 3,500 mark, or much higher levels of 4,100 and perhaps even 4,400, you can consider. Momentum will be missing, but from a bottom formation and a recovery move from a 6 to 12 month perspective, this could turn out to be a good buy.
Okay, interesting. All right, thanks so much, Kush, in fact, for joining us this afternoon. We'll let you go on that note. Thanks for coming in and speaking with us. But with that, we'll slip into a very short break. On the other side, fresh views coming in. We'll have a couple of new guests and we'll take top buy today, sell tomorrow picks as well with them. Stay tuned.
The second buy pick is in Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company. Okay, welcome back. You're watching India Market Close here on NDTV Profit. Neeraj, one thing that stood out, today morning was the fact that 361 announced a multi-pronged transaction. But the crux of that transaction was the vindication of the fact that Indian business, at least from a wealth management standpoint, seems to be doing quite well, because if UBS AG is looking to invest a 5% stake in 361, largely means that industry as a whole, 361 in particular, but industry as a whole also seems to be headed in the right direction, right?
Well, the market leader is speaking, so let's go across to Karan Bhagat, founder and MD and CEO at 361, who joins us right now on the show. Karan, this is Neeraj here. I hope you can hear me.
Hi Neeraj, how are you? I can hear you.
Okay, just a second. Maybe I couldn't hear Karan. Okay, Karan, can you give me a count again, please?
Can you hear me?
Yeah, loud and clear. Karan, congratulations on this, and thanks so much for joining in and speaking to us. Having seen what you've done since 2008, this doesn't come as a surprise. I'm sure the ambitions are larger. Could you take us through the crux or the reason for this transaction to happen? And then I have a part two, which is what's the way ahead?
Thank you, Neeraj. Thanks for all the kind words. I think the reason for the transaction is quite simple in some senses. I think the first and the most important reason for the transaction is to ensure that we continue to give our clients the best potential platform across both their Indian assets as well as some of the assets they want to invest overseas. Secondly, obviously, from a culture perspective, both UBS and 361 have had client centricity at the heart of their offering. And not only that, I think just the way of doing business in terms of advisory, asset allocation, building an investment process. I think UBS AG has had tradition and history over the last 30 to 40 years. I think we obviously would do well to learn from them. I think both those things combined together with the culture of and way of doing business are important tenets and principles of kind of setting up a collaboration agreement. Once these two things obviously are set in place, then the collaboration agreement really comes in terms of more specific opportunities, which would include our clients being able to access the global platform of UBS in a more productive and a more prolific way, as well as UBS global clients being able to access India in a more accurate way through 361. And obviously, to ensure that both of us are on the same page, we've kind of entered into an exclusive agreement for this purpose. And by virtue of it being exclusive, we've also gone one step ahead and ensured that the UBS AG India business is kind of transferred to us. And at the same point of time, UBS AG has ended up taking a 4.95% equity stake represented through warrants in the India business. So all in all, I think from a principles perspective, first principles, getting the reason and the objective and the alignment right. Second, getting the culture portion right. And once these two are set up, I think the rationale for all stakeholders, employees, clients, as well as shareholders become important and relevant. And once these are achieved, really, we need a strong collaboration agreement to get the maximum value.
Maybe cursory question, but does UBS AG stop at 4.95 current? Is this the initial transaction, and could there be future transactions to follow? I'm not saying there will be, but could there be?
Honestly, it's an open question, and obviously, I think the answer to that question is there are no specific plans now. Having said that, that does not preclude a possibility of it. So honestly, there is nothing decided now, neither a yes nor a no. I think, as I said earlier, for us, operating on first principles is important, and no reason why we shouldn't grow together, provided we get the operating first principles right into execution.
Right. Karan, Harsh Saita also joining in. Karan, quick question with regard to what do you do immediately with the 2,000 crore which you're receiving from UBS AG? Is there a plan?
So I think, Harsha, the money would come in post regulatory approvals. I think it's a 6-month odd process, anywhere from 3 to 6 months. I think of the 2,000 crores, obviously, I think 300 odd crores kind of goes into buying the UBS AG India business. We also kind of transfer a small part of their loans to the clients, but for that we don't necessarily need equity. But out of the remaining 1,700 crores, pretty much like what we did with the QIP, I think 50 to 60% would go into kind of enhancing the capital position of our lending arm. The remaining 20%, 25% would go to increasing a little bit of the capital market brokerage margins. We've just acquired a business called BNK Capital, which is also awaiting regulatory approvals. And the last 20-25%, we will use as sponsor capital for our alternates business, 10 to 15% as sponsor capital for our alternates business, as that kind of continues to grow faster than what we had initially anticipated.
And one question more from a management perspective, Karan, what changes?
So right now, apart from the collaboration agreement, there's really no management change. So what we've done is we've set up what we're calling a coordination committee, really to look at the progress of the collaboration items. So senior leadership from our side, senior leadership from UBS's side would be on the coordination committee, and we would meet at periodic intervals to ensure that the synergy benefits which we set out for ourselves can come through very positively.
Karan, just wondering, is inorganic, is this an opportunity that presented itself because it's been there maybe for some while, correct me if I'm wrong, and you've taken it because it came at the right values to you, or is this the way that you grow the business faster?
To be honest, I would first look at the inputs. I think values and output, and then in everything we do, inputs have to be more important. And to be honest, I think, as I said earlier, things like client platform is an input. Okay, that's an input for our business. Ability to attract the right employees is an input to our business. And maintaining the right culture and things which are valuable to us and being able to give the right advice to our clients is an input for us. So I think these three are the inputs, and I believe all three are a big tick for our collaboration with UBS AG. And if the three inputs are there, I think the outputs kind of express themselves. So in a sense, the price honestly is an output of those inputs. So I not really a function of price. I think it's more a function of the time, the need for it, and the right inputs coming together.
Karan, just throwing in a macro question, but just trying to do that. When you did what you did back in 2008 or 2009, as the case may be, right? Did you foresee Indian wealth management industry to come the way it has, and for you to grow to the size that you have and do such a collaboration? And part two of my question, therefore, is from here, when almost everybody seems to believe that India is truly arrived, per capita moving up, number of millionaires, billionaires moving up, where do you see this moving, let's say till 2030 or beyond that, as you can envisage?
No, I think the answer to the first question is not really a macro question. It's a very good question, though. I think, to be honest, the answer is no. Okay, there's no way we would have imagined, number one, the company being so large, number two, the industry being so large, and number three, also us playing such a large role in the industry, leave alone doing a collaboration with UBS. So I think in retrospect, all three things are a good positive thing. When you look back, we think good about it. Obviously, if I was to imagine it differently, I would have done a lot more things differently. But that's for me potentially another day. In coming back to your macro question, I think I'm very confident on the Indian markets. I think there are three things which will kind of really work well. I think first, obviously, the per capita income will continue to grow. And, generally speaking, India's investment and savings culture is very, very strong. Generally, India is a commercially savvy market. So more often than not, most investors get what they are doing. Second, I think we are a phenomenally well-regulated market. I think SEBI, RBI, everybody put together has really been able to convert most of the units into a financial instrument. Most of it is regulated, and most importantly, most of it is in electronic form, where the ability to settle the trade is really something which is more or less bulletproof. So with this kind of a regulatory framework where settlement's not a problem. Exchange is quite convenient. I think then the only thing really left to monitor is price risk and ensure that we are able to communicate to clients properly, and things and the right things kind of get offered to clients. So I'm very positive on that also. And therefore, coming to your fundamental question of the growth, I think therefore businesses which kind of continue to do the right set of things without kind of trying to overachieve, have the following opportunity, right? So I think, the markets itself grow at 8, 9, 10% a year. I think the GDP growth along with the growth in financial savings will add another 10 to 15% every year. So effectively, if we execute well, we've got a 9 to 10% growth in the broader assets you already have. You acquire another 10 to 15%. You can very clinically grow at 20, 25%. And capital markets is a business which is very, very unique because, out of the 25%, 40% of the growth in a sense is kind of coming by itself. And together with this, obviously, you can grow your number of clients which you service. Today, we only service around about 3,600 clients or 3,500 clients on the ultra high net worth side. My guess is the number of such families in India would be 40 or 1,000. So we have lots of inputs to grow on. I think the assets under advice being one, second is number of clients being the second, and third is geographical growth. And all of these three, in my mind, are definitely possible. And if you can continue to grow at that 20-25% clip, manage your costs well, manage your stakeholders well, which would include employees and clients, I think broadly speaking, businesses can grow at a clip of 15 to 20% a year.
Very interesting. Thanks so much, Karan. Been a great pleasure speaking with you.
Yeah, and just congratulations on charting such a fabulous script in this wealth management piece that 361 has. Kudos, Karan, on that.
Thank you. Thanks to the team. Thank you. Yep. See you. Bye-bye.
Bye.
You broke it up well, but 6% higher, Harsh, now.
Correct. And interesting perspective there, Neeraj, from perspective that you have a US AG looking at an Indian company. UBS AG themselves are veterans in the industry of sorts, looking at an Indian company and valuing it at maybe 10% higher than what yesterday's close was. And thereafter putting in significant money behind the deal as well. So that's the other thing that really stands out. And joining us now, Sudeep Bandyopadhyay, Chairman, IndiTrade Capital, and Nilesh Jain, Head AVP Technical and Derivative Research at Centrum Broking. Sudeep, thanks for standing by very, very patiently. Let me come to you first with regard to 361. Not sure how much of that conversation you had a chance to listen in on, but give us your perspective. One is 361 in particular and this entire transaction that's played out. Stock is up 6% today. But outside of that, wealth management in India as a business, of course, related party of sorts, you being one of them. But what is your sense at this point? Is it a good time to enter some of the listed names?
Well, Harsha, I did catch a part of the conversation, and financialization of savings is happening in a big way in India, and the trend is irreversible. It's going to continue at a rapid pace in the near future. Yes, India is a saving nation, and that does help the cause. And because the financialization of savings is happening now, instead of money lying in bank accounts and under the pillows and all, things are moving to the financial market, whether it's in mutual fund or in the insurance products or in equity directly. I think that's a good news for the wealth managers. I would say 361 is in the right place at the right time, and so are some of their competitors. The opportunity is huge. And we are continuously adding more and more people in the HNI category in India, and that gives them a scope for expanding exponentially over the next many years to come. So yes, absolutely positive of this industry and 361 as well. Of course, you have to look at the valuation at which you are entering, and try and enter at a valuation which is kind of a reasonable, so that you can make your gains if you are buying the wealth management stocks which are listed. So to that extent, you need to do your diligence at the point of entry and things like that. But fundamentally, from a long-term perspective, this business looks fantastic.
So within capital markets, is it wealth management? Could it be AMCs? Could it be pipe companies, exchanges, or brokers? 4 or 5 buckets there. Which one looks the best, or a combination of all of these could do the trick?
Well, Neeraj, I think combination. As far as exchanges is concerned, I like MCX. I think in the commodity space, there is a lot of expansion is expected to happen and is going to happen. And MCX being the grabbing the market.
We have to cut across to JD Vance addressing the media.
All children at his beautiful home. I've been amazed by the ancient beauty of the architecture of India, by the richness of India's history and traditions, but also by India's laser-like focus on the future. And those things, I think this appreciation for history and tradition and this focus on the future is very much something that I think animates this country in 2025. Now, in other countries I visited, it sometimes feels like there's a flatness, a sameness, a desire to just be like everyone else in the world. But it's different here. There's a vitality to India, a sense of infinite possibility, of new homes to be built, new skylines to be raised, and lives to be enriched. And there's a pride in being Indian, a feeling of excitement about the days that lie ahead. Now, it's a striking contrast with too many in the West, where some in our leadership class seem stricken by self-doubt and even fear of the future. To them, humanity is always one bad decision away from catastrophe. The world will soon end, they tell us, because we're burning too much fuel, or making too many things, or having too many children. And so, rather than invest in the future, they too often retreat from it. Some of them pass laws that force their nations to use less power. They cancel nuclear and other energy generation facilities, even as their choices, the choices of these leaders, lead to more dependence on foreign adversaries. Meanwhile, their message to their friends, to countries like India, is to tell them that they are not allowed to grow. Well, President Trump rejects these failed ideas. He wants America to grow, he wants India to grow, and he wants to build the future with our partners all over the globe. And when I look at this audience, or when I visit this incredible country over these last couple of days, I see a people that will not be held back. Now, the most profound responsibility I believe that all of us have is not to ourselves, but to the next generation, to make sure we leave them with a better society than the one that our parents and our grandparents gave us. And this is the world that America seeks to create with you. We want to build a bright new world, one that's constantly innovating, one that's helping people to form families, making it easier to build, invest, and trade together in pursuit of common goals. Now, I believe that our nations have much to offer one another, and that's why we come to you as partners looking to strengthen our relationship. Now, we're not here to preach that you do things any one particular way. Too often in the past, Washington approached Prime Minister Modi with an attitude of preachiness, or even one of condescension. Prior administrations saw India as a source of low-cost labor on the one hand, even as they criticized the Prime Minister's government, arguably the most popular in the democratic world, and as I told Prime Minister Modi last night, he's got approval ratings that would make me jealous. But it wasn't just India. This attitude captured too much of our economic relationship with the rest of the world. So we shipped countless jobs overseas, and with them our capacity to make things. from furniture, appliances, and even weapons of war. We traded hard power for soft power because with economic integration, we were told, would also come peace through sameness. Over time, we'd all assume the same sort of bland, secular, universal values, no matter where you lived. The world was flat after all. That was the thesis, and that was what they told us. And when that thesis proved false, or at least incomplete, leaders in the West took it upon themselves to flatten it by any means necessary. But many people across the world, and I think your country counts among them, they did not want to be flattened. Many were proud of where they came from, their way of life, the kind of jobs they worked, and the kind of jobs their parents worked before them. And that very much includes people in my own country, the United States of America. Now, some of you are aware of my own background. I actually didn't plan to talk about my background at all until last night at dinner while my children mostly behaved. We gave them an A- for behavior with the Prime Minister. The Prime Minister said, I have one request. I want you to talk a little bit about your background. And so I wanted to do that. For those of you who don't know anything about me, I wanted to talk about it. I come from, and I'm biased, the greatest state in the Union, the state of Ohio, a longtime manufacturing powerhouse in the United States of America. My home specifically is a place called Middletown. Now, it's not a massive city by any means. It's not Jaipur, but it's a decent-sized town and a place where people make things, which has been a point of pride in Middletown for generations. It's filled with families like my own, some of whom called us hillbillies, Americans who came down from the surrounding hills and mountains of West Virginia, Tennessee, and Kentucky to cities like Middletown in pursuit of the manufacturing jobs that were creating widespread prosperity for families all across America. They came to Middletown in search of what we call back home the American dream. In Middletown, my parents raised me. My grandparents raised me. They taught us to work hard. They taught me to study hard, and they taught me to love God and my country and always be good to your own. My granddad, who I called Papaw growing up, he typified that. Late into life, he worked as a steel maker at the local mill, and I know India has a lot of those. Papaw's job gave him a good wage, stable hours, and a generous pension. All that allowed him to support not just him and my grandmother, but his own daughter and grandkids with him. Now, by the time I came around, money was awfully tight, but he worked hard to make a good living for all of us. Now, I know Papaw and Mamaw were grateful for the way of life their country made possible. Their generation bore witness to the formation of America's great middle class. And by creating an economy centered around production, around workers who build things, and around the value of their labor, our nation's leaders then transformed their country and made thousands of little Middletowns possible. The government supported its labor force. We created incentives for productive industries to take root and struck good deals with international partners to sell the goods made in the United States of America. But as America settled in to world historic prosperity it generated, our leaders began to take that very prosperity and what created it for granted. They forgot the importance of building, of supporting productive industry, of striking fair deals, and of supporting our workers and their families. And as time went on, we saw the consequences. In my hometown, factories left, jobs evaporated, America's middle towns ceased to be the lifeblood of our nation's economy. And the United States, as it became transformed, those very people, the working class, the background of the United States of America, were dismissed as backwards for holding on to the values their people had held dear for generations. Now, Middletown's story is my story, but it's hardly unusual in the United States of America. There are tens of millions of Americans who, over the last 20 or so years, have woken up to what's happening in our nation. But I believe they woke up well before it's too late. Now, like you, we want to appreciate our history, our culture, our religion. We want to do commerce and strike good deals with our friends. We want to found our vision of the future upon the proud recognition of our heritage rather than self-loathing and fear. I work for a president who has long understood all of this, whether through fighting those who seek to erase American history or in support of fair trade deals abroad. He has been consistent on these issues for decades. And as a result, under the Trump administration, America now has a government that has learned from the mistakes of the past. It's why President Trump cares so deeply about protecting the manufacturing economy that is the lifeblood of American prosperity and making sure America's workers have opportunities for good jobs. As we saw earlier this month, he will go to extraordinary lengths to protect and expand those opportunities for all Americans. And so today I come here with a simple message. Our administration seeks trade partners on the basis of fairness and of shared national interests. We want to build relationships with our foreign partners who respect their workers, who don't suppress their wages to boost exports, but respect the value of their labor. We want partners that are committed to working with America to build things, not just allowing themselves to become a conduit for transshipping others' goods. And finally, we want to partner with people and countries who recognize the historic nature of the moment we're in, of the need to come together and build something truly new, a system of global trade that is balanced, one that is open, and one that is stable and fair. Now, I want to be clear, America's partners need not look exactly like America, nor must our governments do everything exactly the same way. But we should have some common goals, and I believe here in India we do, in both economics and in national security. And that's why we're so excited. That's why I'm so excited to be here today. In India, America has a friend, and we seek to strengthen the warm bonds our great nations already share. Now, critics have attacked my president, President Trump, for starting a trade war in an effort to bring back the jobs of the past, but nothing could be further from the truth. He seeks to rebalance global trade so that America, with friends like India, can build a future worth having for all of our people together. And when President Trump and Prime Minister Modi announced in February that our countries aim to more than double our bilateral trade to $500 billion by the end of the decade, I know that both of them meant it. And I'm encouraged by everything our nations are doing to get us there. As many of you are aware, both of our governments are hard at work on a trade agreement built on shared priorities, like creating new jobs, building durable supply chains, and achieving prosperity for our workers. In our meeting yesterday, Prime Minister Modi and I made very good progress on all of those points. We're especially excited to formally announce that America and India have officially finalized the terms of reference for the trade negotiation. I think this is a vital step. Thank you. I believe this is a vital step toward realizing President Trump's and Prime Minister Modi's vision, because it sets a roadmap toward a final deal between our nations. I believe there is much that America and India can accomplish together. And on that note, I want to talk about a few areas of collaboration today, how India and the United States can work together. First, perhaps most importantly, to protect our nations. Second, to build great things. And finally, to innovate the cutting-edge technologies both our countries will need in the years to come. Now, on defense, our countries already enjoy a close relationship, one of the closest relationships in the world. America does more military exercises with India than we do with any other nation on earth. The U.S.-India Compact that President Trump and Prime Minister Modi announced in February will lay the foundation for even closer collaboration between our countries. From javelins to Stryker combat vehicles, our nations will co-produce many of the munitions and equipment that we'll need to deter foreign aggressors. Not because we seek war, but because we seek peace, and we believe the best path to peace is through mutual strength. And the launching the Joint Autonomous Systems Industry Alliance will enable America and India to develop the most state-of-the-art maritime systems needed for victory. It's fitting that India this year is hosting the Quad Leaders Summit this fall. Our interests in a free, open, peaceful, and prosperous Indo-Pacific are in full alignment. Both of us know that the region must remain safe from any hostile powers that seek to dominate it. Growing relations between our countries over the last decade are part of what led America to designate India a major defense partner, the first of that class. This designation means that India now shares with the UAE a defense and technology infrastructure and partnership with the United States on par with America's closest allies and friends. But we actually feel that India has much more to gain from its continued defense partnership with the United States, and let me sketch that out a little bit. We, of course, want to collaborate more. We want to work together more, and we want your nation to buy more of our military equipment, which, of course, we believe is the best in class. American fifth-generation F-35s, for example, would give the Indian Air Force the ability to defend your airspace and protect your people like never before. And I've met a lot of great people from the Indian Air Force just in the last couple of days. India, like America, wants to build, and that will mean that we have to produce more energy. It's more energy production and more energy consumption. And it's one of the many reasons why I think our nations have so much to gain by strengthening our energy ties. As President Trump is fond of saying, America has once again begun to drill, baby, drill. And we think that will inure to the benefit of Americans, but will also benefit India as well. Past administrations in the United States of America, I think motivated by a fear of the future, have tied our hands and restricted American investments in oil and natural gas production. This administration recognizes that cheap, dependable energy is an essential part of making things and is an essential part of economic independence for both of our nations. Of course, America is blessed with vast natural resources and an unusual capacity to generate energy, so much that we want to be able to sell it to our friends like India. We believe your nation will benefit from American energy exports and expanding those exports. You'll be able to build more, make more, and grow more, but at much lower energy costs. We also want to help India explore its own considerable natural resources, including its offshore natural gas reserves and critical mineral supplies. We have the capacity and we have the desire to help. Moreover, we think energy co-production will help beat unfair competitors in other foreign markets. But India, we believe, can go a long way to enhance energy ties between our nations. And one suggestion I'd have is maybe consider dropping some of the non-tariff barriers for American access to the Indian market. Now, I've talked about this, of course, with Prime Minister Modi. And look, President Trump and I know that Prime Minister Modi is a tough negotiator. He drives a hard bargain. It's one of the reasons why we respect him. And we don't blame Prime Minister Modi for fighting for India's industry. But we do blame American leaders of the past for failing to do the same for our workers. And we believe that we can fix that to the mutual benefit of both the United States and India. Let me give an example. American ethanol, we believe made from the finest corn in the world, can play a tremendous role in enhancing our partnership. And I know our farmers would be delighted to support India's energy security ambitions. We welcome the Modi government's budget announcement to amend India's civil nuclear liability laws, which currently prevent U.S. producers from exporting small modular reactors and building larger U.S.-designed reactors in India. There's much that we can create, much that we can do together. We believe that American energy can help realize India's nuclear power production goals, and this is very important, as well as its AI ambitions. Because as the United States knows well, and I know that India knows well, there is no AI future without energy security and energy dominance. And that brings me to my final point of collaboration. I believe that the technological collaboration between our countries is going to extend well beyond defense and energy. The U.S.-India Trust Initiative that President Trump and Prime Minister Modi have launched will be a cornerstone of the partnership in the future. It'll build on billions of dollars of planned investments that American companies have already announced across India. In the years to come, we're going to see data centers, pharmaceuticals, undersea cables, and countless other critical goods being developed and being built because of the American and Indian economic partnership. And I'll say it again, I think that our nations have so much to gain by investing in one another. America investing in India, and of course India investing in the United States of America. And I know that Americans, our people, are excited about that prospect, and that President Trump and I are looking forward to stronger ties. Americans want further access to Indian markets. This is a great place to do business, and we want to give our people more access to this country. And Indians, we believe, will thrive from greater commerce from the United States. This is very much a win-win partnership. It certainly will be far into the future. And as I know this audience knows better than most, neither Americans nor Indians are alone in looking to scale up their manufacturing capacity. The competition extends well beyond cheap consumer goods and into munitions, energy, infrastructure, and all sorts of other cutting-edge technologies. I believe that if our nations fail to keep pace, the consequences for the Indo-Pacific, but really the consequences for the entire world, will be quite dire. And this, again, is where India and the United States have so much to offer one another. We've got great hardware, the leading artificial intelligence hardware in the world. You have one of the most exciting startup technology infrastructures anywhere in the world. There's a lot to be gained by working together. And this is why President Trump and I both welcome India's leadership in a number of diplomatic organizations, but of course in the Quad. We believe a stronger India means greater economic prosperity, but also greater stability across the Indo-Pacific, which is of course a shared goal for all of us in this room, and is a shared goal for both of our countries. Now, I want to close with one last story, or maybe a couple of stories. So, you know, my son Ewan is 7 years old. He's our firstborn son. And yesterday, after we had dinner at the Prime Minister's house, the food was so good and the Prime Minister was so kind to our three children that Ewan came up to me afterwards and he said, "Dad, you know, I think maybe I could live in India." But I think after about 90 minutes in the Jaipur Sun today at the Great Palace, he suggested that maybe we should move to England. So you take the good with the bad here. But I want to talk about Prime Minister Modi because I think he's a special person. I first met Prime Minister Modi at the AI Action Summit in February, and we had a lot of important discussions on AI and other policies to prepare for. The Prime Minister also managed to figure out that my son Vivek was actually turning 5 years old on the trip. This was in Paris just a couple of months ago. So think about this. Amid a huge international policy conference, he took the time to stop by where I was staying, wish our second son, Vivek, a happy birthday, and even bring him a gift. Ush and I were both genuinely touched by his graciousness, and we've been even more impressed by his warmth since we arrived in India. Now, it's interesting. Some of you may know that when you're a politician, your kids spend almost as much time in the limelight as you do, and the great things about kids is they're brutally honest. They're brutally honest with everybody, whether you want them to be or not. And our 7-year-old, our 5-year-old, and our 3-year-old baby girl, Mirabelle, it's interesting. They have only really attached themselves to, they've only really liked, I should say, they've only really built a rapport with two world leaders. The first, of course, is President Trump. He just has a certain energy about him. But Prime Minister Modi, it's the exact same thing. Our kids just like him. And I think that because kids are such good, strong of characters, I just like Prime Minister Modi too. And I think it's a great foundation for the future of our relationship. I could tell when Prime Minister Modi came over a couple of months ago, and I believe today that he is a serious leader who has thought deeply about India's future prosperity and security, not just for the rest of his time in office, but over the next century. And I want to end by making a simple, overarching point. We are now officially 1/4 into the 21st century, 25 years in 75 years to go. And I really believe that the future of the 21st century is going to be determined by the strength of the United States-India partnership. I believe, thank you. I believe that if India and the United States work together successfully, we are going to see a 21st century that is prosperous and peaceful. But I also believe that if we fail to work together successfully, the 21st century could be a very dark time for all of humanity. So I want to say, it's clear to me, as it is to most observers, that President Trump, of course, intends to rebalance America's economic relationship with the rest of the world. That's going to cause, fundamentally will cause, profound changes within our borders in the United States, but of course with other countries as well. But I believe that this rebalancing is going to produce great benefits for American workers. It's going to produce great benefits for the people of India. And because our partnership is so important to the future of the world, I believe President Trump's efforts, joined of course by the whole country of India and Prime Minister Modi, will make the 21st century the best century in human history. Let's do it together. God bless you and thank you for having me.
The second buyback is a Naukri info edge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands.
Hello and welcome. You're watching Market Express and I'm your host Himakshi Bahugna. Now let's get straight to the show, viewers. Markets end on a high note. All sectors barring Nifty, IT, energy and oil and gas trade in green, with Nifty Realty charging the sectoral action. Now Nifty Metal rises to highest level since April 4. Market breadth concludes Tuesday's session in favor of advances. Nifty Bank takes a jolly ride as investors turn optimistic on strong quarterly results. In fact, expectations of further rate cuts, with the Reserve Bank of India signaling its intent to ease liquidity conditions, is also fueling investor appetite for banks. Now, the Nifty Bank went as high as 55,900 levels in trade today. Gold prices cross 1 lakh rupees per 10 grams, breaching record high levels. Now, this rally is largely driven by global uncertainties shaking confidence in dollar, thereby turning gold into a safer choice. Moreover, President Donald Trump's criticism of Federal Reserve Chair Jerome Powell has sparked fears among investors, driving them towards safer assets like gold. And as gold continues to glitter and shine, jewelry stocks react in excitement. Shares of Senco Gold, Sky Gold and Kalyan Jewelers India rose on Tuesday as the yellow metal hit a lifetime high amid tensions between US and Fed Reserve Chair Jerome Powell. Now, in some good news for the Indian steel players, the government imposes 12% safeguard duty on steel imports. The safeguard duty, or the temporary tariff, is imposed to curb cheap imports. Now, the government first decided to put 12% duty in March this year. The safeguard duty rate will be effective for a period of 200 days. Now, analysts believe that safeguard duty imposition has removed key overhang on Indian steel stocks. Himadri Specialty released its Q4 results yesterday, where the company saw sales volume decrease by 3% on a year-on-year basis. However, value-added products helped growth and aid margins. EBITDA margins were driven by high-value specialty products. Pitti Engineering is another company which released their Q4 numbers. Now, the company experienced a sales volume jump of 50% on a year-on-year basis. The interest cost also shot up by 36%. Net profit of the company was mostly impacted by which led to lower other income. Now, Anant Raj in its quarter results clocked a strong 22.2% rise in revenue. All other key metrics grew substantially as well. EBITDA grew by over 36%, margins came in at 26.3%, and the net profit for the March ended quarter crossed 50% higher than 119 crore rupees. Coal India has signed a 16,500 crore MOU with Damodar Valley Corporation to set up two 800 megawatt power plant in West Bengal and Jharkhand. Now, this is a joint venture with a 50-50 agreement between the two companies. The Damodar Valley operates in West Bengal and Jharkhand. Brigade Enterprises is all set to develop a 175 crore rupees project in Bengaluru. The project is in Malur region of the Silicon Valley. Now, the plot is spread over 20 acres of land where they will develop a 450,000 square feet of space. HG Infra emerges as the successful bidder for setting up the battery energy storage system in Gujarat. The company will build this battery energy storage system for Gujarat Urja Vikas Nigam. They have been sanctioned to build 300 and 600 megawatt out of the 500 and 1000 megawatt plants and will complete the project in 24 months. Jupiter Wagons has announced that its Jabalpur plant has been closed for the past 15-20 days due to unavoidable circumstances potentially impacting production and operations. Now, the company said it's taking all necessary measures to resolve the issue and is confident to come to a resolution with a very short span of time and normalize the production. ICICI Security partners with Tata Consultancy Services to upgrade its retail trading platform. Now, this collaboration aims to deliver high-performance trading solution that caters to evolving market demands. TCS currently manages nearly 30% of the retail trading volumes in India. The Ramco Cements Board is scheduled to meet on April 25th to discuss and consider raising funds through the issuance of non-convertible securities. Now, the company has emerged as a well-renowned cement manufacturer across the country. Headquartered in Chennai, the company manufactures cement to meet the diverse requirements of its customers, along with ready-mix concrete and dry mortar products. The shares of IndusInd Bank fell over 6% on Tuesday. Now, this fall was triggered by a report that suggests that the lender will conduct a second audit to probe a 600 crore discrepancy in accrued interest income from its microfinance portfolio. Now, it is noteworthy that this investigations come on the top of the ongoing forensic audit by Grant Thornton Bharat examining irregularities in the bank's forex derivatives portfolio. Shares of Mumbai-based arcade developers rose in trade after the company posted its Q4 business update. The company recorded 773 crore in pre-sales in the financial year of 2025, which was over 19% from the year-ago period. Now, its collections for FY25 increased 21.8%, and the total area it sold amounted to 2.49 lakh square feet in FY25. Bajaj Auto share price declined as much as 2% to 8,075 rupees. Now, share price declined as Jefferies downgraded the stock to hold from buy, while it cut target price to 7,500 from 10,550. Now, India's two-wheeler sector, which had shown signs of recovery post-COVID, is again witnessing demand pressure. Jefferies flagged muted retail registrations, high inventories, and weak inquiries from dealers as key concerns, despite upcoming demand tailwinds from income tax cuts and PSU wage hikes. Solar manufacturer Waaree Energies shares jumped 6% on Tuesday ahead of the company's expected declaration of their financial performance for the quarter ended March 31st. Now, as per the Bloomberg, Waaree Energy is likely to post a net profit of 496 crore rupees and a revenue of 4,028 crore rupees for the fourth quarter of fiscal 2025. Now, analysts also forecast the EBITDA of the solar manufacturer to be 736 crore and margins at 18.3%. In a bid to ease liquidity in the system, the Reserve Bank unveils easier liquidity coverage ratio norms. The norms allow banks more time and flexibility in compliance while aligning new liquidity coverage ratio norms with global standards, effective April 2026. Now, the RBI has granted time till April of 2026 for compliance. A lot of brokerage firms have turned positive after RBI's liquidity norms were changed. Morgan Stanley said that this will improve liquidity coverage ratio by 6 percentage points and improving the loan growth by 1 to 2%. Macquarie and CLSA also issued positive responses on the new guidelines, saying that new LCR guidelines will boost liquidity. RBI Deputy Governor gets another year of extension effective May 2025. He was appointed in May 2021 for a period of 3 years. Now, this is his second consecutive one-year extension since his 2021 appointment. He oversees fintech, IT, risk and payments at RBI. He also previously served as an IMF consultant. As gold prices touched lifetime high on Tuesday, veteran banker Uday Kotak weighed in on the precious metals' long-term performance, this time with a nod to eternal Indian saver, the Indian housewives. Now, the Indian housewife is the smartest fund manager in the world, he said in a post on X, adding that governments and economists pushing high deficit spending might learn a thing or two from India, a net importer of store of value forever. According to a recent report by UBS, India's consumer sector is showing signs of a strong rebound. Supported by several positive developments, the report suggested that the sector, which has underperformed in recent years, is now positioned for a recovery as multiple factors align in its favor. UPS, in fact, expects earnings in the consumer sector to grow by around 13% in FY26. Now, this projected recovery is largely driven by improving earnings, income support measures, and more attractive stock valuations. Finance Minister Nirmala Sitharaman on Tuesday said that India must be prepared to tackle the challenges and seize the opportunities emerging from a changing global order, and assured businesses of the government's ease of doing business reforms. She said that as we lay the foundation for a developed India, we must stay committed to long-term goals without losing sight of the present realities. The global order is changing. That poses challenges, but also opportunities. We must be prepared to tackle the former while seizing the latter. Now, as per Pearl Global, India's textile industry may not be a beneficiary of extra tariffs on China. The company believes that China's better alternatives are Indonesia, Cambodia, and Vietnam over India. It reckons that cotton garments could be the only space that could see some benefit, as India does not have sufficient raw material flow for all textiles. The Reserve Bank of India has now allowed minors aged 10 and above to open and manage savings or term deposit accounts on their own. Children below 10 years of age can open them through their parents or legal guardians, while those aged above 10 will now be allowed to operate independently depending on the limits and terms set by the bank as a part of its management policy. India continues to be Morgan Stanley's top pick. We think that weak global markets can cap absolute returns, but on a relative basis, we still look better positioned. Dovish RBI policy, sluggish oil prices, and likely Indo-US trade deal act as some key indicators to the positive outlook. Petronet LNG has appointed Saurav Mitra as its new director and chief financial officer effective from April 22. Now, the 56-year-old, an associate member of the Institute of Cost Accountants of India, succeeds Vinod Kumar Mishra, whose tenure ended April 18. Now, Mitra brings over 30 years of finance experience from Indian Oil Corporation and Lanka IOC, where he served as CFO, driving financial strategy and business growth. Well, with that, viewers, it's a wrap on Market Express today. But stay tuned to NDTV Profit as there's more lined up ahead for you all.
The second buyback is a Naukri Info Edge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
The Nifty and the Sensex closed higher for the sixth consecutive session, with broader market indices outperforming their benchmark counterparts. ITC and HUL emerge as the top gainers in the Nifty. Meanwhile, IndusInd Bank closes 5% on reports that its board has appointed EY to conduct a second forensic audit, triggering investor concerns. For the fourth straight session, gold price rises by 1,899 to reach an all-time high of 99,178 rupees per 10 grams. All of this fueled by continued safe haven demand. US Vice President J.D. Vance in his address highlights the changing nature of global trade, says both America and India have finalized on terms of reference for bilateral trade between both the nations and will be watching out on how both countries can work together in the future. The Delhi High Court sharply criticizes yoga guru and entrepreneur Ramdev's attacks on Hamdard's popular drink Ruh Afza, says his remarks calling it Sharbat Jihad were indefensible and had shocked the court's conscience. The Enforcement Directorate files a prosecution against journalist Mahesh Langa against the Prevention of Money Laundering Act. The ED had initiated money laundering probe based on an FIR. Hello and welcome. This is Profit 360 on NDTV Profit. I'm Sanjana. Along the next half an hour, we're going to bring you the latest on markets as well as national and international news. So first up, let's take a look at how the markets fared today. The Nifty and the Sensex closed higher for the sixth consecutive session, with broader market indices outperforming their benchmark counterparts. Now, Nifty Realty was the day's top sectoral performer, driven by gains in Phoenix Mills and Oberoi Realty, while financial services, PSU banks, and the media continued their upward streak for the sixth straight session. We also saw Nifty Auto and Pharma advancing for the third session in a row. Meanwhile, not all was well. IndusInd Bank closed 5% lower after its board appointed EY to conduct a second forensic audit that has triggered investor concerns over the bank's governance and financial transparency. My colleague Varsha now joining us with the highlights on this and a detailed market roundup. Varsha, over to you.
Well, Nifty and Sensex ended in green for the day. Nifty and Sensex ends higher for the sixth consecutive session. Now, ITC, HUL are the top gainers for the day when it comes to Nifty 50. Nifty mid cap 150 and small cap 250. That means broader markets ended higher for the day. Dixon Tech, Max Healthcare were the top gainers when it comes to Nifty mid cap 150, while Alok Industries data patterns were top gainers in Nifty small cap 250. Well, Alok Industries was buzzing on the back of earnings that the company posted on. If broader market indices outperformed benchmark indices, and Nifty Realty, if you see, registered as top sectorial gainer for the day, led by Phoenix Mill and Oberoi Realty. Nifty Realty, financial services, PSU banks, media ends higher for the sixth consecutive session. Nifty Auto, Nifty Pharma ends higher for the third consecutive session, while Nifty Oil and Gas, IT snaps 5 days gaining streak. And if you see IndusInd Bank, which closed 5% lower, now there's a reason. This was after it closes 5% lower after board appointed EY to carry out a second forensic audit, and EY will investigate rupees 600 crore discrepancy related to accrual of interest on microfinance portfolio, and EY will check for lapses and fix accountability. Reports suggest that it is not an issue which spans for multiple years.
And we have a quick update coming in right now. IndusInd Bank's internal audit department has launched a review of its microfinance portfolio following concerns that have been brought to its attention. The IndusInd Bank has come out and clarified, saying that EY has been engaged to assist the audit team in the process, though the firm is not conducting a forensic audit. This clarification coming in right now. Now, this review signals a heightened focus on risk assessment within the bank's microfinance segment. And this is what we're seeing right now, just after reports actually emerged as of last evening, and a little actually today towards market hours, where we just saw IndusInd Bank's performance dipping 5%. I also have Harsh Saita joining me in the studio with more. Harsh, we're actually seeing a clarification coming in from IndusInd Bank. This is potentially after, you've gotten a second audit, but now clarifying that it's not a forensic one instead.
Yeah, it's not a forensic one, but I'm not so sure as to how kindly the market will take it in any case, because whether forensic or not, this doesn't give comfort in any form or shape with regard to how processes are at IndusInd Bank. Really, the question that market participants have been asking from the point of time when the derivatives issue has happened is whether processes in specific are okay or not, and this kind of vindicates that processes within the bank are not okay, so it doesn't give any comfort whatsoever. They also, as part of their clarification, haven't quantified the extent to which the problem is with regard to the microfinance book. Now, mind you, reports in the morning suggested a 600 crore hit, which is roughly 1% of net worth, and roughly, if I were to do the maths, roughly around 0.2% of the net advances of IndusInd Bank as it stands. So it's a small amount in relative terms, but nonetheless, it doesn't give any sort of comfort to investors.
Thanks, Harsh, for that insight. I'm also going to bring in our colleague Vishwanath Nair, now joining us on the phone line, who has been relentlessly tracking this story right from the beginning. Vishy, let me come to you. Now this clarification coming in, Harsh here giving an insight that it may not necessarily mean that it's going to allay investor concerns, but take us through what the clarification actually means and what does this entail now?
So, Sanjana, basically the clarification is simply this, that there is a concern within the microfinance book. Remember that IndusInd Bank has had similar issues in its microfinance portfolio not very long ago. Back in 2022, the bank had disclosed that due to some technological issues, it had accidentally opened 81,000 new accounts and had disbursed money without any customer consent. So that was already a problem which had gone through a process of investigation, and then the bank had decided whatever it had decided to do to essentially provide for those loans. But in this case, this microfinance concern is coming from the accounting department of the bank. Remember that the accounting department of the bank has already faced issues within the derivatives portfolio, where the bank had reported a 1,979 crore worth of a hit on its balance sheet because of the discrepancy. In the microfinance portfolio, they have not clarified the amount that is involved here, but of course news reports are suggesting 600 crore. We need to watch out for what exactly comes out of this entire process. This is an internal review where EY is assisting the internal accounting department, the internal audit department, and then once some kind of outcome comes out of this, we will see exactly how the bank is going to deal with this problem. But suffices to say that this doesn't look good, doesn't look great for the management, which has already been in the news for all the wrong reasons. So one more issue for IndusInd Bank.
So, Vishwanath, let me understand this then. Is this audit part of a broader regulatory push in the microfinance sector, or is it a bank-specific corrective measure that we're seeing?
So, as far as the microfinance sector and the regulatory push is concerned, so a lot of that has already gotten over. It started somewhere around September, and since then these issues have more or less been resolved at this point in time. And actually, the banking microfinance book was not part of this entire debate whether there was any over-lending. So whether it be IndusInd Bank or IDFC First Bank or AU Small Finance Bank, all of these banks have sizable microfinance books. The concern was not whether they were over-lending or over-leveraging their book. The concern, however, was that the quality of the microfinance book was suffering because customers inherently were not able to repay their loans. So therefore, this may not be linked to the core microfinance conversation that we were having not very long ago. This seems more like an IndusInd Bank problem because remember, this is coming from the accounting department. So there is something at the bank, if news reports are to be believed, there is an issue with the way interest accruals are happening on these microfinance loan accounts. But the bank has, of course, not clarified that yet. We'll probably find out a little bit more when they come out with their quarterly results. At that point in time, the management will have to address the press and will have to answer questions. So we'll find out then exactly what the issue with the microfinance portfolio is.
Okay, so then if I were, what kind of potential risks or discrepancies can this audit uncover, since we are clarifying, and of course IndusInd Bank coming out and clarifying, what the nature of this particular audit, and then could it lead to operational or policy changes within the bank?
operational policy changes will have to come. So remember that Grant Thornton is already doing a similar exercise with respect to IndusInd Bank's derivatives portfolio. So part of their job is also to suggest ways to improve the accounting of that specific book. But now that concerns are emerging within the microfinance department, a similar exercise will likely be taken. And then a probable review of the entire bank's accounting processes and why such gaps are being identified at the bank will probably take place. And at that point in time, you will see the bank come out with certain measures to try and curtail that. That will, of course, have to be directed by the board, and then the management executes it. Remember that the CEO of the bank, Sumant Katpalia, his tenure is ending in March. So he has about 8 months left at the bank. We'll have to see how exactly he covers for these issues within that time frame. The management, the board of the bank also has to find a successor for Sumant Katpalia. That process will also take place in a few months, hopefully by September or October, when the bank will have identified a potential successor, which the RBI then will have to clear as the next CEO for IndusInd Bank. So a host of changes are coming at IndusInd Bank. As far as the impact is concerned, now remember that we don't have a sense of what the amount is. All we know is that 600 crore has been highlighted by a news report at a very popular economic news daily. So let's assume that is 600 crore. Financial impact may not be that severe. The problem more is of a governance nature and the nature of the quality of accounting that is happening at IndusInd Bank.
Vishwanath, thank you so much for bringing us those updates and clarifying. This is as IndusInd Bank's clarification coming in regarding this very crucial audit. Moving on, India's 361 WAM Limited has joined forces with UBS AG in a significant partnership to boost cross-border wealth management. Now, as part of the agreement, 361 will acquire UBS's India wealth business for 307 crore, while UBS secures a 4.95% stake in 361 through 2,112 crore worth of convertible warrants. To break the details down and implications of this deal, let me go across now to my colleague Harsh, joining me in the studio for deeper insights into what this means for India's wealth management space.
Well, it's a big vindication of sorts, Sanjana, with regard to what it means for India's wealth and asset management space, because deal value at roughly 42,000 crore post money, which is roughly a 5% stake, as correctly mentioned, of 361, and therefore in that sense a huge vindication not only just for 361 but also for the India wealth and asset management opportunity which is available, because UBS AG putting in money is surely a big deal, but it's also about the larger cross-sell opportunity for both parties. UBS AG gets access to a quality advisor in the Indian market is how they are putting it, and 361 getting access to UBS AG and its client base sitting abroad, as well as UBS AG's their expertise with regard to markets abroad and investments globally. And therefore, some of those synergies will also likely play out. Of course, it will take some time for us to fully understand as to how much of that is actually translating. But to try and get a better pulse of what the rationale is behind everything that's been put together, let me bring on board Mihir Doshi, India country head at UBS, to give us a better perspective. Mihir, first off, great chatting with you. Harsh here. I want to first start off by asking you, what's the rationale behind this? What's the end goal, and how do you all believe synergies will start to play out, and how quickly?
I think, Harsh, in your preamble, you already took the thunder away from me. You said everything which I was going to say on the rationale, etc. But I think the rationale for this transaction, as well as why we believe it was worth doing, was on three pillars, right? The first pillar being what you said earlier, cross-border collaboration. I think the opportunity for 361 clients in India to avail of what UBS, amongst the world's largest and best wealth managers in the world, brings to the table is one collaboration which we see clearly over the long run. And simultaneously, for our NRI clients, our global Indian clients, 361 provides an opportunity in terms of all their products for our clients offshore. So I think it's a win-win for all our clients. At the center of this transaction was obviously clients and employees, and clients clearly will benefit from this transaction. So one was the collaboration part. Two, of course, the second pillar in this transaction is we are taking our onshore business and transferring it into 361. Again, it's great for our clients who we have. They'll get access to the 361 products, and our team will be part of the 361 wealth team. And the third pillar, which you mentioned, is the stake we're taking. I think for us to be part of the India story over the next 1, 2, 5, 10 years, this is the start of that opportunity by taking the stake in 361, because we do believe very strongly in the India story, and this way we play it via the stake. So, I think on all counts, collaboration, taking our onshore business and making it part of transferring into 361, and then taking a stake into 361 gives us the long-term story.
Right. So very well put in terms of putting it in a nutshell, but let's unpack this a little bit more, Mihir. If I were to ask you, is there some sort of a benchmark that you all are already looking at in terms of how this collaboration is going to help in terms of numbers, both for UBS as well as for 361? Is there some sort of a thought process behind the extent and how large the opportunity size is for you all?
Sure. So two things, right? Of course, in our discussions on why we're doing this, we have put together collaboration agreements. We have thought about what the opportunity is, the size is, what we like to target over the next 26, 27 to 2030. Over the next 3 to 5 years, what we want to target, we have thought about it, and that's, we have a game plan in place. And how we will harness that, we plan to put together a small committee, with myself and head of wealth on our side, and as well as senior management, current and senior management from 361, to ensure that we actually follow through on this discussion. It's just not, oh, we've taken this investment and now let's see where it goes. We will actually want to monitor and ensure that the collaboration is taking place and we're meeting, the milestones which we like to see achieved. Obviously, especially on the onshore, offshore part, there are regulatory constraints or regulatory, I guess, there's the LRS money, there's the RBI allowed entities being set up, GIFT City the potential. So I think there are multiple ways of addressing it. The target audience, target size market is known to us. We'd like to have a good market share of that. And over time, hopefully, as a group, evaluate how we're doing and how we're succeeding in ensuring that we have the type of market share we like to have. So yes, we do have a process in place, and we do have some benchmarks in place where we'd like to see this achieved.
Sure. Mihir, the way this has been structured clearly looks like a longer-term partnership, right? And your own commentary to suggest that you'll have benchmarks all the way up to 2030 clearly suggests it's a longer-term partnership. Is there a thought process to acquire a larger stake within 361? Because you've acquired this at a substantial or sort of a discount to at least yesterday's close. Today, of course, the stock rallied on the back of this, but to yesterday's close. And therefore, is there a thought process to acquire a larger stake within 361? Is that at all on the table?
That's a question which has been asked us by many. I think as a first process, having the collaboration, I think, which is a critical aspect of working together. Let's get that off the ground. And is anything? And by the way, the price was which we acquired the warrants at 1030. I think is there a desire? Is there an interest to increase our stake? I think everything's on the table. I think genuinely speaking, if you ask Karan this, you ask my colleague, the head of wealth, who is also in town right now, the answer we would give is we'd love to see this partnership grow. And in that growth, if it means we get an opportunity to increase our stake, we would look at that. But I think, like I said earlier, let's get the collaboration in place. Let's get the benefits on both sides, and then we'll look at what next.
Point taken. Mihir, when I'm looking at this, even from a value perspective for UBS AG, you've put in a 2,000 crore. what's the kind of value you seek to derive out of the upside that 361 has to offer? So why does 361 stand out versus others? Why 361 is essentially my question.
I think when we were evaluating the options we had over the last 12 to 15 months, we looked at various other options, right? And I think the way we felt it was 361 was a wealth manager who's kind of aligned with the client focus that we have, the type of business they do, the type of interest they have in going global, and our desire to have a more impactful local player. I think that was probably the big attraction of 361. We were excited by the fact that their business model or what they were doing in India is what what we do overseas and vice versa. So I think it was really ensuring that we had at a meeting of the minds of two institutions who look at wealth in a similar manner. And as you can see, we've gone with a standalone wealth management firm, and which is clearly focused on wealth, which is probably a most important part for UBS in the global franchise too.
Taken. Thank you so much, Mihir, and wishing you all the very best with regard to this collaboration, and many congratulations for closing this. Indeed a big one, and markets responding to that. But thank you so much for giving us that perspective.
My pleasure, Harsh. Thank you for having me.
Cheers. So Sanjana, frankly, interesting conversation with regard to how he looks at both the wealth management business in India, and clear vindication with regard to what 361 is doing and how wealth management in India is taking shape. So
absolutely, and although I think he was careful about saying that we're going to let the collaboration first hit the ground, but definitely eyeing something bigger and better in the future. Thanks so much for that, Harsh. Let's take a look at how gold is doing. Prices are skyrocketing, crossing 1 lakh per 10 grams, fueled by heightened global market uncertainties. The yellow metal is witnessing an unprecedented rally, with pure 24-karat gold now priced over 10,000 per gram in major cities including Delhi, Mumbai, Kolkata and Chennai. So for more on this record-breaking surge, let me quickly go across to my colleague Pallavi with the latest on market trends and investor sentiment, joining us on the phone line with more. Pallavi, over to you for all of the details.
Hi, Sanjana. Robert Kiyosaki, the American author, had said that commodities such as gold and silver have a world market that transcends national borders, politics, religions and race. And, it does appear to be true looking at what's happening currently. As I'm speaking to you, I'm currently in the very bazaar. Like other retail markets in the country, gold prices here too have surged to historic highs of over 1 lakh rupees for every 10 grams. What's happening behind this gold rush? There's, of course, the uncertainty behind Trump's retaliatory tariffs. Central bank buying continues to be strong, as does strong ETF demand. All of these factors continue to push up prices. And here, in fact, given what traders and dwellers here are telling us, they actually expect the prices to continue to climb up still. Current prices are reshaping consumer buying patterns. The central bank has adopted a more measured buying pace, even as the strategic importance of gold reserves intensifies. Corporate retail jewelry sector has seen, strong growth from January to March. Looking ahead, according to the World Gold Council, seasonal and wedding-related purchases are expected to continue to support domestic gold demand this month and going on to the next month. Investor interest is likely to strengthen as gold's appeal as a safe haven asset and portfolio diversifier continue to heighten given the global economic uncertainty and financial market volatility.
Pallavi, thank you so much for that. Continue to give you updates on this very interesting story as gold prices continue to skyrocket. With that, I'm afraid it's a wrap on Profit 360. Stay tuned to NDTV Profit for more news and updates.
The second buy pick is in Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers. Hello and welcome. You're watching Know Your Company. Today we're going to be covering Ashiana Housing, real estate play, of course, and an interesting one. It's a sub 3,000 crore in terms of market cap. And what I want to know and why we're featuring Ashiana Housing today is I want to try and understand. They've come out with their provisional numbers for FY25. There's been a slight bit of a miss in terms of that number. So whether there are any regulatory and approval challenges which are cropping up with regard to this company in particular, with regard to existing projects. That's the first piece I'm going to try and zoom in on. Second one I want to really understand is with regard to pricing and outlook for FY26 and the near term thereafter, whether there has been a significant shift in terms of either of those metrics, demand and pricing. The third piece I want to understand is they have around 2,100 crore of GDV which needs to get executed, which is roughly 49% of what has already been received by them with regard to this execution of GDV. GDV being gross development value, and therefore all the development that they are doing should lead to some amount which is 2,100 crore to be recognized in the near term. How quickly are they going to recognize that? The approval status of existing projects, whether there are absolutely any approval delays that we are seeing at this point. I want to also understand the cumulative gross development value currently, because that as of now is not available in public domain. Something I want to understand. New projects which are being considered going forward, what are the growth levers and how is that looking? Mind you, roughly 12,000 crore of execution is what they've guided for. That will come as part of our analysis, but that's something that you should know, given the fact that we are looking at the gross development value in cumulative that they are currently sitting on, is what I want to understand. Now, the last piece is with regard to capital allocation. They're sitting on some amount of cash. They're also sitting on some amount of debt. The debt number, frankly, is very low. How are they incrementally allocating capital, and therefore what are the return ratios at which they are deploying capital is something I want to understand. So those are some reasons behind why we're going to be zooming in on Ashiana Housing today. Interesting play in the real estate space. Let me start off by explaining what the company does. In terms of Ashiana Housing, it's a mid-sized real estate developer, and it was incorporated in 1986, listed on the BSE in 1993, and thereafter listed on the NSE in 2011. It's specializing in residential projects in tier 2 cities. It's a prominent player in developing housing for senior citizens. Now, in terms of segments, they are into the kid-centric home segment. They are into senior living home segment. So this is one real estate player which is developing a niche of sorts within these pockets. Premium homes is the other place where they are playing, and elite homes is where they are playing. So those are the 3-4 clusters that they are currently focusing on. A really wide geographical presence. Now, again, this is unique from a small developer perspective. Not too many small developers have such a wide range in terms of geography that they cover. But just look at some of those names, all tier 2 plus cities. So again, it's tier 2 plus, it's wide ranging, and it's in these specific pockets that they operate in. Something that you should keep in mind as we speak about the company even as a whole. That's the future projects, that's projects in the pipeline in terms of saleable area, but the gross development value of those projects will be crucial, and we'll understand that when we speak with the management. Now, in terms of what are the KYC metrics that we'll look at when we're speaking about Ashiana Housing. And I'm going to start off with the first metric, which is operational metrics, which we generally look at in real estate companies. Thereafter, we look at income statement and cash flow. We'll combine those two metrics. Balance sheet is the third metric, and return ratios is the fourth. Thereafter, we look at shareholding pattern. We look at street cred. We look at the outlook going forward, what the guidance seems to suggest. And last off, we'll compare the valuation at which this currently sits at versus some of the other players that are there in a similar market cap kind of space. So that's how we've kind of split up the metrics, and we'll hopefully dissect all of that for you by the end of this this show. Now, in terms of who's joining me, we have Anushi Vakharia joining me on this show to try and break these metrics down. Anushi, firstly, welcome. Good morning. Wanted to first start off with those operational metrics that we always look at when it comes to real estate companies.
Of course. So before we go with the income statement for real estate companies, it's important to focus on how the booking values have fared in terms of how the area booked has looked at. So if you see the growth in the last 2 years or so, we've seen at a muted growth of around 2% in terms of how much area has been booked. We saw in FY26-25 this number standing at about 26.97 lakh square feet. While in terms of value of area booked that we are looking at, here we have seen improvement in terms of where the land value is concerned. We're looking at a growth of around 8% in FY25, of course, aided by higher price realizations as well. In FY24 and FY23, there had been a substantial pickup in terms of these growth numbers that were there, around 37% of a growth last year. So overall, this is the picture that we are seeing over the last 4 years or so. But let's also talk about the fourth quarter, what has panned out for the company. In terms of area booked, we're seeing about a 20% of a dip in this number. While if you look at the value of area sold, that stands at 574.7 crores, seeing about a minus 33% of a dip as well. Do note that the company had guided for a 2,000 crore of overall pre-sales for FY25, of which it was shy of by around 63 crore. It reached a pre-sales number of 1,937 crore. So in terms of where the key operational numbers are looking at, that's what we are seeing. But Harsh, let's also talk about the income statement, right?
Yeah, let's do that. And it's not a very impressive looking income statement, also from a perspective that you will likely see that for real estate players, the execution is chunky, so something to keep in mind. FY25, when I'm looking at the numbers, not impressive at all. In fact, trailing 12 months, FY25 ended 9 months, which is not reflecting in the graphics in front of you is just about 600 crore in terms of top line. But outside of that, it's grown at a fairly healthy clip of a low base. Mind you, for a 3,000 crore market cap company, it's doing about 1,000 crore in profit after tax. The EBITDA margins have gone up from 7 to 10 odd %, and the net profit also has gone up in similar kind of stead, as you can see. And for FY25, as I did mention, not a very impressive set overall, at least up to 9 months. So some bit to be done